Everybody, welcome back to Mad Money. We are just going to be hanging out, talking some Q&A. God knows what else. Feel free to jump in, talk any questions or answers or whatever you need. More than happy to hang out. We're just going to let some folks. Now we're actually starting to see some folks on Twitter join in. That's pretty dope. That's really cool. Okay, I'm curious how much that's going to change over time. They're actually able to comment as well. That's pretty neat. So hopefully we'll be able to garner a little bit more of an audience. I know I have some folks that only follow me on Twitter, and I also know I have folks that only follow me on YouTube. So it's nice to be able to get a community chat going on. For those of you guys that have not been on here before, or this is the first time it's on Twitter or what have you, we do a Cashflow Chronicles quite often, and that's Tuesday through Thursday. But that being said, we will be moving to a second channel. That link will be in the description below this video. So if you guys would, and I'm sure I'll mention it again when we have a few more folks joining in, because we're up to about 30 or so right now. But just click on that bad boy, and we'll be able to host some folks over there eventually and get monetized. And me and Chris can continue this adventure towards continuing to become a standalone business and hopefully do this 3, 4, 5 times a week. Why am I buying 500 shares of Tesla this week? I only invest in TSLY. It's the only thing I do. Full port. I have over 7 figures in TSLY. But hopefully you guys will get some joy and love. We got some folks that are part of the money gang. We got Hot Dean. What's going on, my guy? And Pfizer, do I have thoughts? Let's maybe think about this. Maybe I'll jump into some of the numbers and see as to why it is being absolutely obliterated in terms of the stock price. And eventually we'll hopefully see if Hot Chris wants to join us. It's no obligation to him. Obviously, he had to take care of some business after Finance Junkies. So we might not see him. And also, this was very impromptu of a conversation. So anyway, let's just hop into answering some questions for you guys. The market's been up really well for me personally. So hopefully you guys have been able to do the same. This is one of the reasons why I'm more of a just buy and hold sort of kind of guy. I do make some trades in and out of the market, but it's very rare and few and far between. But to me, it's one of those things where you can't predict when things like this are going to happen. I mean, nobody really thought that the mention of, let's just say, the FOMC. Yeah, okay. So Hot Chris is going to go get some dinner with the missus. That's perfectly fine. Let me just message him back and go get dinner, my guy. We'll do it tomorrow or Tuesday. Cool. No problem there. What was I going to say? So yeah, I mean, nobody really thought that the FOMC was going to come out, or Jerome Powell specifically was going to come out and say, hey, we're going to be out here cutting interest rates, more than 3 times next year, and then everything would move. Everyone really thought that, well, this is going to put a damper on everything before the Santa rally. But here we are, markets up and to the right. So far, so good since the end of October timeframe. And luckily for me, I had some 472 SPY. Let's just do the last 3 months. I had some 472 SPY calls. Luckily, I bought those back at a penny, just in case after hours things decided to get a little wild. They didn't. So luckily for me, I was able to keep on to those bad boys. I have 479 covered calls for this upcoming Friday. So we're hopefully going to be able to do that. I have some TQQQ. What bad boys do I have? Let's just make sure I'm not going to share screen or anything for that. So let me just pull up on the other side. What I think I have the 54s. Let's check. Let's see where everything's at. I was just amazed that Amazon's about $1.50, which is pretty crazy because I have 360 something shares of that, 367 shares of that. So let's just see. So yeah, the SPYs have 479s, TQQQ calls I have the 53. So I'm up 15% on those covered calls there. 13 contracts of that because, of course, I have 1,300 shares of TQQQ. What other calls do I have? The 70 call on Shell. I need to roll that bad boy. That's for January. I'm up 72% on those bad boys. And then my Pepsis, I have a dollar or $175 cover call on my Pepsi shares. That's up 30%. I'll probably keep that burning. And then let's see, my Baba cover call for February, the 120s, those are up 80 something percent. I might roll those down. I might roll it down to the 110 range and see if I can get a little bit more burn on that bad boy. But so far, things are good, man. The portfolio is looking really healthy. I'm at like 70% of my short-term goal, which is really, I mean, I'm just trying to get to a place where I can split the portfolio 50-50 between two very significant asset allocations, one being equities and one being like real estate. And so they can almost have like two businesses on their own and really moving towards a common goal, which is, you know, I guess the goal is, what's the word I'm trying to look for? Project 8 figures. I don't know how to say it appropriately, but I guess that's just what it is, right? Is this Project 8 figures. So that's the goal. And so being 32, going on 33, I mean, I'm nowhere near a meat cabin or anything like that, but I'm on the path, the war path to try to continue up growing that ladder. And it's been a lot of fun. So far, so good. I love talking about stocks. More and more people at work are starting to recognize that I'm the guy on Matt Money. Not really the guy, but more and more people started to check in and talk to me about stocks, which is really cool. So let's just run down the list. We got Hot Johnny. What's going on, my guy? We'll talk about Pfizer today. I'll hop into it, see if I have any initial thoughts. We already talked about the TSLY, full port on that. Make an ETF. That's eventually the goal, man. With all the love and support that you guys hopefully will provide to me and Chris over the years, that's the hope. That is the hope. And for those of you guys that don't know yet, I mean, we're trying to do that with the second channel. Now we got like 40 some people in here. Just do me a quick favor and let me just share this on here. Do me a quick favor and I'll post this link in the chat as well. Do me a quick favor and give this bad boy a follow. Cashflow Chronicles TV. Me and Chris, that's where eventually we'll be moving over to. We'll be doing that. That's where we're hopefully going to be able to create all this income, share the public portfolio, all that. And that's the hope, is eventually grow that bad boy, similar to what Finance Junkies have done for their sake. So if you guys would just give that an opportunity, link is in the chat. So we also have, let's just see, Matt Money wondering if you have dealt with Civitas Resources at all, ticker symbol CIVI. Company is buying back shares and offers almost a 3% dividend. I haven't. Might be one that we can talk about today. We got Hot Tevis coming on through X, my guy. Charmin, yeah. For those of you guys that are missing that joke, watch the end of Finance Junkies today. It's pretty funny. Any thoughts on macro regarding student loans? Data came in that 8.8 million federal student loan borrowers haven't made a payment in November. Well, they probably just forgot to turn on their auto pay. Just kidding. I'm sure most people don't do auto pay for student loans. I just want to say I'm just very grateful that I was able to skip the whole student loan thing. So unfortunately for me, my parents paid for my college, and I repaid them by spending nights until 2-3 a.m. in the library getting my degree. And so luckily I've been off on a good foot, and instead of having to repay student loan debt, I've been able to put that in the market and do relatively well. So very, very thankful for them. Every chance that I remember about it, I always thank them because it was such a gift. So I mean, I think that I don't think that student loans will be forgiven. It's been already knocked down several times in the Supreme Court, but I think it is what it is. I think we're going to continue to see delinquencies, not just in student loans, auto loans, mortgage payments, and things of the like. And I think that's just what happens when you have such an aggressive move in the federal funds rate. So I think what we're going to see is 1Q will probably be a lot of announcements similar to what you guys are saying here, which is student loans are not being paid as quickly as expected. People are foregoing. They also might be using this as an opportunity to what am I trying to say here? An opportunity to refinance if they have the ability to um, hold off on that. So I don't really know. To be very honest with you, this is probably something and a good topic of discussion for my friends over that do the FinTech Weekly, SoFi Weekly on Fridays, Tevis and Tanner and co, because they focus a lot on this. Like this is a big piece of the SoFi piece and FinTech piece. Janelle, thank you for joining from X. Was Rocket Lab latest launch a success? Why the negative stock reaction? Dude, I think I've been invested now since March of 2021 for Rocket Lab, and that's just the way the cookie crumbles for the stock. I mean, people always anticipate that every time there's a launch that there is going to be a positive sentiment. And so since I've owned the stock, I've been part of probably close to 20 launches, if not more. And if that was the case, there's 5% or even 10%, I'd be up 100%. But unfortunately, stock, generally speaking, stays flat or goes down a little bit. And that's just the way the cookie crumbles. I think people thought that this one might be different because they had an anomaly that happened in September that caused the second stage to lose control and abort early. And so with that, I think people anticipated that this one was going to send the stock to the moon. But to me, it's just business as usual, right? They've launched 40 odd rockets before into orbit. And so didn't seem much of a difference. It's just getting back on track. So I'm really just curious to see as we enter 1Q, if they're able to double the revenue or get close to doubling the revenue going into 1Q. Really, really hope that they're able to do so, because that'll be a huge catalyst for the stock going forward personally. I really didn't know that. Forget what you asked, Zach. Make an ETF. Yes, that is the hope. Yes, for your guys' super chats, your guys' joining the membership, the money gang, as I like to call it. That's what Dean is part of. That's why you see a little symbol next to Dean Pierce's name. And you have a few others in there, like Austin, 26K Palantir, and a few others. They have that little symbol next to their name. So that all that money, that's just I think it's like $2.99 or something a month just to support the channel. All that money gets reinvested into the public portfolio, which are at about $1,000 so far. And we might have actually gotten paid some divvies on Friday. We did not get paid divvies on Friday. I was hoping to. On the 15th is generally a big dividend month or dividend day for me in my personal portfolio. So I was hoping the same would happen. Unfortunately, no. But really cool to hopefully go down that path. But it is expensive to launch an ETF. So with that, the hope is eventually to do that with Chris and maybe some like-minded. And I at least know that if we create an ETF company or like a capital firm, there's at least going to be 2 ETFs, right? I'm going to have my kind of ETF, which is probably going to be, don't want to spoil it too much, but mine's probably going to be mostly SPY and then a few speculative investments that tries to have that even keel macroeconomic, just holding capital for SPY, and then a few 4 or 5 large bets that will be taking place. And so it's probably going to be an 80-20 or a 70-30 split. And the hope is to outpace the S&P not on like a annual basis or anything like that, but over the course of like 5-10 years. And that's through taking those big bets. And once those big bets pay off, take a portion of that capital, if not all that capital, sell it and put it into the SPY looking for a new opportunity. And so the hope is to kind of keep that 80-20, 70-30 balance, but knowing that on a quarterly basis, it might dip below that, all with the hope of outpacing the SPY, and all in the meantime, probably writing very, very far out of the money covered calls to be able to generate a little bit of income and hopefully give a little bit of a distribution as well. So we'll see what happens with that in the long term. And I don't want to speak on behalf of what what Chris would do. But the hope is eventually to get to that point where that, and also to create private real estate investment trusts, or even maybe public real estate investment trusts if the real estate portfolio gets large enough. But that one needs a little bit of time, because you need at least you need to structure things pretty aggressively. Like you need more than 100 people to be invested for it to be a REIT, and then no more than 50% can be owned by more than like 5 of the owners or 6 of the owners or something like that. So you need a pretty substantial amount of capital and also a lot of people to be involved. Because obviously I can't just be like, hey, I'm starting a REIT and own 80% of it, right? I would need, and I couldn't like bring Chris and Amit and Carlos and Vitalia along or something of the like, and have us collectively own 60% of it, and then the other 95 people own the other 40 or something percent of it, because that's just not in the cards, right? That's just how the law works. So very curious how eventually we can do that. Fell asleep on the stream. All right. Meta Mike, you were the man, the myth, and the legend. Hot Trav, my guy. Midwest Cannabis has over 100 shares in video. He's rich. Subbed, LFG. Love you. Thank you. Let's just see what progress we're making. Little refresh button. My goal is to get close to 250 by the end of this stream. So if you guys could just walk over there, do a quick sub, that would mean the most. Chris Vader Patel, I agree. Thank you for subbing Midwest Cannabis. That's the man. 40% of people for student loans did not make a payment. Interesting. So I did take a quick look on Biden's motorcade. He seems to be okay. It doesn't look like they were like ramming into it, but let's just take a quick look. I can't spell motorcade. Take a quick look. And I don't know why Google keeps showing up like my it's strange. I don't know why Google keeps bringing up my YouTube this way. Advertisement within an advertisement.
Out of breaking news, a car crashes into President Biden's motorcade in Wilmington, Delaware.
Yeah, we know what happened as the president was leaving his campaign headquarters. Take a look.
Mr. President, why are you losing to Trump in the polls?
Wrong poll.
You see it there. President Biden was quickly ushered into that paced SUV. SWAT officers were on scene and police were seen talking to the driver. He was inside his car with his hands up. It's unclear what caused that crash and whether it was an accident or intentional. But as you can see, it was raining at that time. The streets were soaked. This is a breaking story. Once we get more information, we will update you.
I'm surprised.
Interesting. Well, that was the latest, the one that I had seen. So I don't know necessarily what the heck is going on with respect to that. But yeah, hold on. Hell yeah. Sorry. Just a text message from a couple buddies here. So Hot Dean, you're the man. Interest is accruing, though it doesn't make sense not to pay it unless you can't afford. I would agree. Maybe people are just hoping that they can keep their money and there'll be student loan forgiveness and they won't ever have to pay, right? I think that there's a lot of that. And I think that might end up being something that we talk about, or even in a presidential election topic as we get closer and closer to these debates. Like, if this persists and it goes into January, February timeframe, well, I'm sure this is something that will definitely be talked about, and I'm sure the debate whether or not people can't afford it or whether or not they're actually just waiting for forgiveness. So I'm very curious as to see the reasoning for that, or maybe people just forgot because they haven't been paying it for so long. Yeah, And what were they talking about with the Senate on Finance Junkies? There may or may not be some video of people breaking into the Senate floor and doing mischievous things, we'll say, Miss June. And knowing you from Finance Junkie Con in Vegas, you are a very, very sweet lady. And so I won't say explicitly what it is. And I don't think that it's something that you would see in your travels on the internet, just knowing what your search history is like. But yes, it is probably not something for your eyes because of how innocent you are as a woman. But there are some people out there that probably know exactly what I'm talking about. There was some, what's the word I'm looking for? I'll say canoodling. Is that the right term? There's some canoodling after hours on the Senate floor, and it was filmed and uploaded to the internet. So something that you might find on an internet website with the initials PH, and maybe that'll help. Heard he was Biden was wearing a diaper in the car. I hope that the driver that got in the accident was wearing a diaper. I'm sure the Secret Service did not play very kindly to him, because who knows, right? That might be an opportunity like that. That may or may not, as they alluded to in the accident. I'll try to keep apprised in the background to see if I have any other updates come through. But it looked like it was just kind of an accident, right? Because everyone seemed pretty calm when that news reporter had showed up and took a look at that crash. It looked like an old Impala from the early 2000s. Not an old Impala like the 80s. Those things were sick. I wish I had an old 80s Impala. Put it on make it a slab, slow, low, and banging with those wild ass wheels that you see in Houston. The mess would be contained 100%. We got some more people joining through X. This is cool. I'm really liking to see the people joining through X. This is pretty cool. It's the first time I'm seeing it thus far. So that's a new one. And I'm sure that's an Elon special. So you have another individual joining from X. What's going on, my guy? Drive that damn Jimmy into the ramen shop, dude. Dude, Midwest Cannabis and his Jimmy always fucking gets me, man. Think you mentioned you invest in Tesla. How do you feel about TSLL, the 1.5 leverage for long-term play? I do not invest directly into Tesla. I have exposure in Tesla through investing in the SPY, but I do not have direct exposure to Tesla. Yes. Yeah. The Biden thing so far, no story. I mean, I don't necessarily think poorly about people investing in Tesla. I just think that for me, it's a little bit overpriced. I think that the margins will continue to come down, but I've been saying that since 2019, 2020, and I've obviously missed out on a crap ton of gains, right? So, you know, if that's sort of thing, I just don't see it. And, you know, I talked about this with somebody else. You know, I wished a group of investors luck, and not in a negative connotation way, just in general, about investing in PYPL. And they were all like, what do you mean? Like, you're not invested? Could have sworn. And I'm like, that's the thing about investing, man. Like, you don't need to be invested in every stock. Like, you don't need to be swinging at everything. And that can be a blessing and a curse, right? Because, you know, but I think that there's so many opportunities out there that you really need to pick and choose what's the appropriate one for your portfolio, right? It's personal finance for a reason. So just because somebody talks highly about PayPal, you have to think, like, does that fit into my genre? Like, does that fit into who I am as an investor? And to be honest with you, like, I'm trying to shrink out of more mature companies, right? I'm trying to shrink out of the PayPals and stuff of the worlds that maybe are kind of maturing assets. Now, if PayPal came out with some super innovative payment method that brought it up since the 2000s, then sure, maybe. But like to me, I still am under like the mentality of if PayPal was still great, why would Elon and many others have sold out of it, right? They use it as their leapfrog into their other ventures. So, if it was such a great company, why would they sell out? Why would they sell it to PayPal, sell it to eBay, right? Like it just doesn't make sense to me if it was that great of a company. And it might have been because it was so there were so many hands involved at that point that they didn't have as much control. They just wanted to take their money and go off and do their own individual things. Or, I don't know the whole story, but everyone has done extremely well from that opportunity. But obviously Tesla being one of them, right? So I think people just need to think about, where they align with their investment strategy. And, not everything needs to be an investment. Anyway, subscribe from your new channel. Saw me on X. That's awesome. Yeah, I'm curious to see, because X is always continuing to up the ante with respect to how they're doing the streaming piece. And so I am kind of curious. Let's look at it together, how it shows up on X, because it used to be I didn't even have the opportunity to stream on X in the past. And here we are, 7 viewers live, and we're a couple seconds behind, but overall it showed up 409 people. So it's now a little bit of a streamception going on, because now it's going to go more and more and more, which is actually kind of cool. Let's see, before people get bored and start clicking off, how many streamceptions we can do, because in another 10 seconds it's going to be a stream within a stream within a stream within a stream. So it's like the amount of layers that they went down in Inception overall. And all I can say is when they got to that point that I'm just disappointed in myself. No? You don't remember that part where they were just talking about disappointed? All right, this is where I'm going to lose people. So they're having gay sex. Yes, that's to put it bluntly, June. That is, if you're wondering what they were doing on the Senate floor, there you go. There you go. A little hot dog toss. Jeez. All right. Is there any option plays that you were considering currently? Option plays all the time, man. That's the beautiful thing about options. And people like to make the pun, oh, it's options, but that's the thing. Options provide the opportunity for leverage, provide the opportunity for income, provide the opportunity for insurance, hedging. And so there's so many different avenues for options. It's insanity. And so I think that people most of the time they just assume, and the most times people are just like, oh, I'm going to buy long options and they're going to go to the moon. But it's like the opportunity that you have with options is very much dependent upon what you want to do. And so you could do anything with it. You could put on 4-leg options trades like butterflies and everything of the like to keep stocks within a certain price range, like a strangle or a straddle. If you want the stock to move in a certain direction, like you could straight up to say, if it's something that you want to do, make money if Palantir goes up or down by a certain amount by 2026. You're like, all I know is that Palantir is not going to stay at $18, and you could pay and make money if Palantir goes up or down. So for me right now, the real ones I'm only considering, and I might continue to do this one, which I need to record how well I've done. So there's this underlying bullish call strategy that I heard about, which tries to track the the inflow of capital into the S&P 500. So that's basically, I'll show you guys, because this is kind of a perfect perfect deal. So we're like on the 18th. So buy, it's something where you pretty much buy a month out and you buy an at the money SPY. And I'll keep track of this. So far, I'm 2 for 2, but it's also been a bull market, right? So you'd basically buy one of these for $7.39. And what you would do is two things. If you make a profit of 50% on this contract, so in this case, it's, am I sharing this? I'm not sharing this. Hold on. So we're talking about buying the 470 SPY call for $7.39. So $7.39 times 1.5. So what you would say is in 20 days, and I would put a limit order on this as well. So I'd buy it, put a limit order for $11.10. So within 20 days, so basically until January, early second week of January 8th, 9th, something like that. If the price is $11.10, I would have it sold, and I'd have a limit sell order on this to get my 50%, which so far of the two contracts I've done, that's what's happened. But keep in mind, it's been a very bullish market the past couple weeks. Or if I get to the 8th or 9th of January timeframe, sorry, sleepy baby, I would roll it another 30 days out. So what I would end up doing is, let's say the market rolls around and it doesn't really do anything. By the time I get to probably the 8th or 9th of January, I would look another month out. So I'd look for, and at that point, they'd probably have more February contracts, but I would look at the February again, and I would say, okay, February at the money, in this case, it's a 470, and I would buy this contract, and then I would keep the ball in the air. And the hope is that most of the time, right, if you look at the S&P 500, most of the time, it's going up. So let's just take, most of the time, there is the absurd, every once in a while, large pullbacks to which, you have a multitude of things when you look at options contracts, which is, it's being priced off of the volatility. It's being priced off of the movement of the underlying. It's being priced off of a lot of different things. So worst case scenario, over the course of, say, 5-10 years, the majority of your money is going to keep going up. And it's not to say that you have to do everything in this, right? So I've now profited. I bought one contract the first time, one contract the second time. Both came out. So it was like $300 profit the first time, $350 profit the second time, because both contracts were like $6 or something like that. And I need to go back and like actually track it, because I think that this could be something I do long term, but eventually it's going to get to the point where, and at the moment, I'm just like stacking that cash on the side, just doing one contract. It's going to get to the point where I start doing two contracts, right? And I'm going to do that after I get enough of a profit margin, and eventually, keep that money and that profit to the point where I've made enough profit to pay for a third, right? And the hope is that I'm never going negative on these contracts. I basically want it to just be another stream of income to help. And the gentleman that I saw do this, whether or not he was lying or not, said he got, over the course of an 18-month, 2-year track record, about a 1,200% return. So 1,200%, let's just say, if you start with, let's just say $600, and you do 1,200%, that'll turn $600 into $7,000, $8,000. And so eventually, if you continue to double up on that, right, and turn that into a $1,200 investment or a, whatever type investment, it'll eventually continue to kind of grow legs, right? And so the hope is that it's never going to be its own let's just say 15 or 20% of the portfolio. It might eventually, who knows? Maybe it's like the strategy. And, but the thought is like, it'll always be something where you're just bullish. And it's something that, for me, I'm already bullish in SPY as it is. I have close to 500 shares of it, and I'm going to continue to try to get to 1,000 here in the next couple months, if not a year or so. And so that's just by continuing to consolidate down the portfolio. And so with that, it's just going to be another opportunity to continue and have another segment of the portfolio that generates a little bit of legs. Is there any value left in investing in the Magnificent Seven going into 2024? I think so. I think that Google and Amazon are still undervalued here. Now, I guess it all depends on what your time horizon is. Is it by the end of 2023? Then I'd say, dude, I don't know. It could go up, could go down, could go to zero, But to me, if you were to look, say, 5-10 years out, I still think Google is massively cheap. And Chris and I talked very very eloquently about Google and its expected returns in price to earnings over the coming years. Let's just say Google grows its EPS on its own by 5%, right? On an annualized basis for the next 3 years, which I think is conservative. So 5% per annum for the next 3 years. And then also, they're buying back about $60 to $70 billion worth of stock per annum as well. And keep in mind, like, that's not all they're doing. They're still investing $25 billion of CapEx into the business as well. But let's just say that the company stays at 1.7 trillion. You're talking about a $1,700 billion market cap. Divide that, or let's just say 70 divided by, 70 divided by 1,700 is a 4%. So they're buying back effectively 4% of the float per annum. So after 3 years, they're going to go from, I think they're at like a 5-something% EPS right now. So instead of that, divide by 0.88. So that alone will increase the shares outstanding, or the EPS, by close to 14-15%. And then you have the 14-15% annualized growth. I mean, I just think that this thing is just going to continue to be an absolute monster, because like 1.05, 1.05. So just alone in EPS growth, which I think is being conservative, you're going to get 6.5, 7 EPS, and then divide that by, let's just say you're able to get 12% of the shares bought back outstanding. You're going to be, in 2 to 3 years, a 7.5 earnings per share, and that's probably being conservative. Now multiply that by 20, you're looking at 150. I think 20 is probably light for Google. I think it could trade all the way up to 25. And so that alone gets you to $186 a share. And here it is sitting at, let me just make sure I'm not sharing that screen. I'm not. We are sitting at, for Google, 132. So, and that's being light, right? That's an EPS growth of 5. So let's just say we're sitting at 5.6 EPS, because I think that's where we're at. In fact, let me see if I can research. What was their most recent EPS? Advanced chart. Sentiment chart plus. It's somewhere around that. So we'll just say 5.5. Let's just say you're able to get a 1.1, so like a 10% EPS growth. This is probably on the higher end. So you do that for 3 years, for fiscal year 24, 25, 26. So that gets you to $7.50 EPS. That alone, before any buybacks, let's just say, is a 25 PE. So that's the 186. Very similar to what we had when we just had the 5% EPS growth from just revenue growth, right? Now let's just say you also include the 13% share buyback of the stock. That gets you to an 8.5 EPS per annum. Multiply that by 25, you're looking at $211. So I think overall, the company continues to outpace, I think, what everyone's thoughts are. I think everyone is still sitting there thinking that Google, Amazon are done. And I refuse to believe it. I think they're going to continue to become more and more efficient over time, because most of the time and lately, they've been focused most of the time, let's just say of the past 5 years, they were focused so much on growth because of what happened during the pandemic. So many people rushing to YouTube because they were staying at home 24/7. Amazon people were starting to get used to not going to the grocery store, ordering things at home. I just got an Amazon delivery earlier for groceries, stuff like that, where people are now used to these things. The fact that these guys, even though people have gone back to work pretty much full time in the majority of cases and are in an office and not reverted back to less usage of Amazon, less viewership. And there was less viewership, right? I mean, it's evident based off of people's live streams and stuff like that. From a finance perspective, e-game, esports business perspective, a lot of that has been in decline comparatively to the pandemic. But the increase of, and this is very similar to percentage of sales e-commerce, the increase compared to where we were, and this is very similar for, I think, viewership in like YouTube and stuff like that. So the increase that you're observing in e-commerce and total sales is a very straight line, right? Let me just make sure I'm sharing. I am. So that change is a very, very straight line. And you saw this massive jump from 12% to, in the second quarter of 2020, during the midst of lockdowns and everything like, a 16.5%. Now this is, I think, total US sales. But even now, yes, we retraced and went back down to 14%, but we're now back on this normal trend that we started back in the early 2000s. And so for people to say that Amazon is done, for people to say that Google is done, when you have more and more people going online to be a percentage of total sales in the United States, is pretty asinine for people to say. And so Amazon will be a $1 trillion revenue company, I would say, within the next five years. They're going to break close to 600 billion this year, of which 100 or so billion is coming from AWS. The rest is coming from international and US e-commerce sales. And so to me, thinking that, and that's still the fact that like Amazon is still focused on growth. They focused for 6 months on efficiency, and their earnings per share skyrocketed to a point where people were like, oh, like Amazon can make money. It's like, of course, Amazon can make a crap ton of money if they actually focused on it. Amazon cash flow from operations. Let's just pull it up really quick. Is this the one I want? Revenue and profit. Operating income. Is this annualized? That's fine. You get the idea. So they were so focused on, basically, this is the trailing 12-month operating income. They were so focused on growth, eventually they started eating themselves, basically. and actually had declining like quarter over quarter operating income. And now they focus. They're like early 2022, mid 2022. They're like, okay, we've grown so fast. Obviously that's what this big hump is here. We've grown so fast. They were predicting, way more warehouse footprint, everything to like. So they were just like, go, grow, 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 because you saw how quickly it went from 12% all the way to 16%. And then everything kind of pulled back a little bit. So with that, they had to pull back a little bit on the collar of their growth. So they were canceling warehouse contracts, stuff like that. So with that, you started to see them absolutely skyrocket again in operating income. And so this is trailing 12 month, right? So keep in mind, like it's never going to be, that quick of a turnaround. But the fact is like they always go through these lumps of growth to, sustaining, then to growth, sustaining. And so I think we're on the next leg up of Amazon getting to a place where they're going to get closer and closer on a quarterly basis to $1 trillion in annual revenue. And when that happens, I think everyone's going to be there like, oh, but they're not making so much money. It's like, well, just wait until they decide to actually make it a priority to make operating income. Because for now, they can just focus on non-GAAP operating income. And at the end of the day, they're just going to continue to they have so much cash on hand and everything the like. It's just like, how much cash does Amazon have right now? Other metrics, price ratios, prices, number of employees, other ratios, quick ratio. What do they have? Assets, cash on hand. Like this is like for people that think that Amazon doesn't make money. It's the same thing with like Apple and Tesla and all these other companies when they're like, doesn't make money. It's like on a net income basis because they invest so much. They can depreciate a lot of things. So on a net income basis, it doesn't look like they're making a lot of money. But if that's the case, how are they able to go that quickly into having $60 odd billion worth of cash on hand? And so when you look at it, this is the way to look at it, right? What's the operating income of the business? Let's make sure I'm sharing. What's the operating income of the business? And on a trailing 12-month basis, you're seeing on an operating income basis, they're making $26 odd billion. Got it. Cool. Awesome. What is the actual net income? And this is where you can start to depreciate things and, write things off because you invest so much money. Look, you're only making, let's just say, $20 billion. But we just saw they were making on an, operating income basis, look at this. So like you're talking 60 some billion dollars on an earnings before interest, taxes, depreciation, amortization. So it's just astonishing that people think that these guys aren't making money. It's because of the amount of depreciation that they're able to write off. It's pretty comical. It really is pretty comical. And we're at 554. And this is on a trailing 12-month basis, right? So keep that in mind. So we're at 554 on a trailing 12-month basis. I'm anticipating on a quarterly, we're going to cross 160. So where were we for last year, fourth quarter? We were at 150 last year. So in the fourth quarter, obviously for Amazon, because of Christmas and seasonality, is always the biggest. So I'm anticipating we're going to easily see 160. But then that ends up meaning that most of those quarters next year are going to be in the 140 to 150 range. So next year, fiscal year 24, I fully anticipate we'll be at $600 billion. And growth is increasing again, right? Like you have to think it went through this large cycle for Amazon of growing during the pandemic. And then everyone started going back into the office, working from home. Now it's getting to a place where it's normalizing again. where we're actually growing the amount of e-commerce that we're doing and stuff of the like. It had to get over that hump of normalization and regression from that all-time high. Anyway, I also agree. I don't think Biden will run next year. Do you see Celsius becoming a monster equivalent? And have we already seen the multi-1,000% return as it's been public since 2010? I think personally, going into Celsius, one of the things that I recognized is their international sales leave much to be desired. Now, that could be a pivotal point. Let me pull up Celsius stock. That could be a pivotal point in the company. If they're able to execute and get really good margins, in fact, they're back down to $49. This might actually be one. Somebody was asking specifically about leaps and any options that I see out there. When Chris and I covered this one a few months ago, it was a $13 billion market cap, and now it's back down to $11 billion market cap. This is one, and I know a few others have started to kind of think about this stock as well. I know Tevis looked at it and a few others. If they're able to sustain, the problem is with some of these companies is like they show up, everyone loves them, then they fall out of favor and they die. And a lot of like fast casual restaurants are like that, right? Like Jack in the Box was really big, and then something happens. Chipotle was really big, then they got smacked down due to some E. coli scares, and then things have now progressed to a point where they're still doing extremely well, right? And obviously it was prudent to probably back then get back and invest in the stores. But I think of so many concepts that have come along that have hit the market strong and then disappeared, like Cozy and many other concepts that people thought were going to go to the moon and then disappear. And my fear is like, will Celsius be one of them where everyone's drinking them and then it just disappears and waits for the next trend? But for this one, it seems like it has some staying power. My fear is, though, will it capture in the international markets? And the reason why I'm curious about that is if you look at Celsius's 10Q, Celsius filings, report, current report, 10Q here. Look, international. And then let me share my screen. Share. Notifications, SEC, view filing. Here we go. Okay. So international. Okay. So this is hard to see, and it's really out there. But here's your revenue source, right? And this is for the first 9 months of 2022. So great revenue growth year over year. $475 million last year comparatively to this year, which is over 100% growth, right? Because it's 475, you double that, you get to 950. So over 100% year over year revenue growth for the first 9 months of the year through the third quarter. Most of that is coming from your U.S. sales, North America sales. $448 million last year out of $475 million, and $930 out of $970. So only $40 million. So about 5%, maybe 4%, is coming from non-U.S. sales. How is that growing? Well, let's just do some quick math, and then let me just double check that I'm sharing. I am. Okay, good. So some quick math shows me how much we actually grew year over year, or fiscal year 22 to date versus fiscal year 23 to date. So we went from basically 32 million this year to date, from 23,540 divided by 23,540. We increased 34% in Europe. We went from basically 4 million from about 3 million. About 44% in Asia, and then other, which I guess that's South America, and so 43.24 divided by 102 divided by 102, but a 300% increase in basically ex-US, ex-Europe, ex-Asia Pacific. So maybe this other revenue is maybe Africa, or maybe this other revenue is South America. But regardless, you're still growing at a fast pace in the US, and you're growing at a fast pace outside the US. $11 billion company. So let's look at these numbers then, right? So the revenue is good. And you know that your so let's just see net income here. So net income was about, for this quarter, $1.86 per quarter. So let's just say pretty quickly they can get to $8 per quarter. That's for the 9 months. Okay. So for the first 9 months, they're able to get to $1.86. So it's 186 cents divided by 3 times 4. So that's basically $2.50 per annum, and it's growing at a pretty quick pace. So right now it's trading at $49 divided by 250, because they're on track to make about 250 in EPS this year. And if you remind yourself, let's just pull this bad boy back up. So this year alone, they're on track to make $2.50. Let's pull up the year to date. This year alone, fiscal year 23, they're on track to make $2.50 in earnings per share, and they're trading at $49. So what does that mean? Take the $49 divided by $2.50, you're at about $20 price to earnings. At a company that's growing this quickly, if you're able to continue at that pace, let's just say they grow by 30% next year. So instead of 250, next year they make 325. So let's do 49 divided by 325. So technically, if you were to buy it and they actually do grow earnings per share next year by 30%, then you're buying it basically at a 15x multiple for fiscal year 2024 income. Now, I can't tell you what they're forecasting for fiscal year 2024, 2025. So let's just see if they have, I know they have their earnings report. Let's see if we can go through that briefly. So this is their 8K. So up 100% year over year, which is what we knew. Gross profit was up 147%. So not only are they growing revenue at 100%, but their gross profit, meaning that their gross profit margin is getting better. Probably because they have SG&A, and when you have some like normal, generally speaking, the more that you make, sometimes your gross margin goes up because your underlying, you have sales, general, administrative costs, and stuff like that. So last year they lost $2.46 per share in the third quarter. This quarter they're making 89 cents. So let's just say, for example, that their gross margin went up from 41%. Let me just double check I'm sharing. Yep. Their gross margin went from 41% last year, this quarter, to 50%. And now they're actually able to make a little bit of money. But their adjusted EBITDA. So if you start looking at EBITDA as well, which is the actual cash through the door, let's just say they're able to grow that and let's just say they're able to keep it at this amount. Times that by 4 quarters, that's $400 million in EBITDA. They're an $11.6 billion company divided by the 0.414. So even on an EBITDA basis, if they stay flat, they don't grow, their price to EBITDA is 28. Now, if they do continue to grow at a pretty impressive pace, I will say, then, they're looking pretty healthy. Looking very healthy. So this is their trend, right? I mean, are they going to slow down from here? It'd be hard pressed for me to say like it rolls over, but it's possible, right? It's possible. So, and their international is yet to really take off. One thing that now I'm realizing, though, is that their international sales were more, and they look like they slowly dropped off. So I'm curious what happened. Curious what happened with that. So Amazon, Celsius is the highest selling energy drink, 21% share. The energy drink quarter, Monster owns 18.6. That's pretty interesting. This is for specifically the US. Amazon Q3 sales were up from 15 to 22 million. So up 42% year over year. Interesting. What is their income growth first 9 months? So 83 million a quarter, 70 million attributable to stockholders. So I mean, if they're able to continue at the pace, and that's the thing, is like it ends up looking pretty cheap if they're able to continue at this pace. And I actually have thought about, now that they've taken a dip in the share price from when Chris and I talked about it a couple weeks ago, down to $50, maybe taking an opportunity to look, because it was retracing. I think back when Chris and I were talking about it, it was sort of hitting this peak here. Or maybe it was like in this 57-ish range, and now it's back down. And I think a lot of this has to do with some sell-off in the family that owns the most of it, the most shares. So let's just look. I mean, you could write an opportunity at the money. At the money might be too aggressive, but buy something there. I don't know. I'll have to come up with an opportunity, but I could foresee it, especially if they don't have anything else to really spend their money on. That's a good one to look at, because then they could eventually end up doing buybacks or dividends or something like that. Y'all did a poop under Biden, lowest unemployment in 70 years, highest GDP, 5.3, better than Trump, high real wages, high labor productivity, record stock market. Interesting. Hate the slabs. Hate the slabs. Live when there's still an NFL game on, because that's what I do. Love seeing different perspectives in every topic. Challenge your mind to think in different ways. I feel like you're talking about me. PayPal. I mean, hey man, no problems if you like it. It's just I'd rather invest in something that, innovating, and it's kind of been a little stagnant, Drive that Jimmy to City Ramen in Royal Oak, Michigan, for sure. Hey, I said I wish them the best. I'm not saying I think they're on to something, right? Share buybacks, and the EPS growth is actually going to be pretty good for next year. It's just I'd rather look at something else. I had to come to YouTube and search your channel name. Well, it could be a good opportunity now, 72 people in here, to reshare in the comments section the new channel name, the new channel. I'm hoping to get to 250 follows by the end of the stream. So I just put it in the chat box there. Not saying you're long PayPal, but it's in value territory. So I'll take the free 18 to 15% appreciation with small allocation. I don't think that that's bad. I do not. Take your 10, 15% and get the hell out. I don't disagree with that. But I think some people think it's going to go back to 150 and I just don't see it. I do not. Hey, thanks for the folks joining. Continue to join here on X. Much appreciated. Do I own either MasterCard or Visa? Seem like great long-term hold, but the valuation is high. I used to have Visa after the pandemic, or during the pandemic, rather. I bought some Visa when it was rather cheap, and then I sold it, and I think now it's probably rolled up into my SPY position. But I did. I think I made a little bit of money, just like I made money on Boeing. I bottom picked a lot of great companies. JP Morgan in the high 80s, Boeing in the high 80s. The pandemics, man, when the market gives you an opportunity, it gives you an opportunity. You got to take advantage of it. I don't know what you guys are talking about. Oh, MasterCard. Oh, yeah. MasterCard and Visa. Yep. Agree about Google. That's good. I think that Google's a good one, man. Me and Chris seem to concur about that one. Discover Financial Services was also cheap 45 days ago. More room to run. Let's check it. Let's check her out. DFS. I used to hold DFS back in the day. I also used to hold Amex back in the day. I had Discover, I think, when it was in the 50s. Many moons ago. Yeah, Discover took a pullback, like a lot of financials here. Wow, big pullback. From 120 to 80. Goes to show you, man, sometimes you just got to buy. When things represent, do you think Discover was going belly up? Gets you to think sometimes. How high do you think the NASDAQ will go? I mean, I don't really care about tomorrow. I don't really care about, next year. I think that the SPY and NASDAQ will double by 2030 to 2032. I think that I track SPY more than I track the NASDAQ. But I think SPY will go to 10,000 by 2031, 2032. NASDAQ, I think, will go to 28 to 29,000 by 2031, 2032. That's kind of where I'm at. I think they'll double. There's so much opportunity, so much efficiency to be made. Diversity is key, just like always. Spread risk out. I think it all depends on whether or not you know what you're doing. If you don't know what you're doing, I think spreading your money is out there. But I think if you have done your due diligence and you're confident enough, and there's no blind sides, which that's the hard part, there's no blind sides to your analysis, then you can super hyper focus on specific categories. But that's the problem, is like I've been burned so many times thinking that I understand something and then recognize I missed something, That's part of the problem. Let's check in on our friends on the Twitterverse. So I see people continuing to join in, but I don't know if they're joining the stream. We've got 3 viewers on the Twitterverse, the Xverse. So it's kind of cool to be able to see. I wish I could just see the same for like the YouTube people that join in. Amazon is your favorite stock. I like it. When I think about companies like Amazon and Google, I look at them and I say, well, they're almost 400 shares a piece for me. And I say to myself, do I think that they're going to double or triple within the next 5 to 10 years? And the answer is yes. I think that Amazon will at least 2.5x from here. And so I think it'll double. I think it'll be a $300 stock, $350, $400 stock here by the end of the decade. And then it's going to be $150,000 position for me. And the thing is like Amazon, they might get to the same place that Google is, where it generates so much cash, they have to buy back stock. And if that's the case, and I'll be ecstatic. But Google, I mean, if they continue to generate the amount of cash that they are, it's going to be silly, because, in 10 years' time, they're going to buy back, 25 to 30% of the shares outstanding, Vanguard Global and the State Street Emerging Market Fund is in your 401k at work. It's not bad. VT, it's got its time and place. Nothing wrong with that. I think American equities right now are probably prime. Emerging markets, depends on what markets, I would say. Better than premature, eh? Better late than premature, sorry. I'm still in the S&P Copycat Fund and other tech-heavy large cap fund as well. Asian market is really down right now, but don't know how fast it can recover. When Asian markets, do you refer to specifically Chinese? What market specifically, Miss Jean? Did we ever talk about ET? We've talked about ET off and on a few times. We've actually had a good friend, Stephen Fiorillo, and maybe that's a note that I can have on Tuesday for Stephen to join us. Let me message him right now to have him join us. Fiorillo. Stephen, you are, and this is all caps, you are joining us on Cashflow Chronicles on Tuesday or Wednesday if you are available. Exclamation point. Misspelling a lot in there, but it's in there. All caps. All caps, no cap. You know what I'm saying, my guys? And I'll also send him a voice note. I think he's an iPhone guy. Oh, wrong Steven. My guy, I am writing you a voice note while I'm on stream. I'm an hour and 12 minutes and 40 seconds into this stream, and people are asking about energy transfer. Please let me know if you can join us on Tuesday, Wednesday. I would love, let me just make sure I'm not giving everyone in the world. Okay, cool. I'm not giving everyone in the world my Amex number. Yes, I know you were supposed to come on, when was that? The Tuesday, Wednesday before Thanksgiving, and we never actually got around to your article. If you have another article, please bring that up. Otherwise, we could continue to talk about your previous article that you wrote before Thanksgiving, but would love to have you on, my guy. And I haven't seen you in a while. Good job on the finance weeklies, fintech weeklies that I've seen you on. And I'll talk to you soon. Let me know if you could show up on Tuesday, Wednesday. Love you. Bye. Cool. Keep. I always keep my voice notes. People are, if you don't keep your voice notes, I fear for your safety. And most of the time, I'd like listen to that back because I like hearing myself talk, as you guys know. Nord Stream, I assume you're talking about, down. Europe is depending on US for gas, and it's about to get cold over there. Yes, and that's why Hot Chris and I, and actually, I'm going to go into a deeper conversation. Maybe if I can get Steven to agree. He also probably has work tomorrow. It's probably, I don't have work. I took off until the end of the year because I've yet to take any vacation. That's a lie. I took a week of vacation, but I've 4 weeks now that I'm 10 years in at the company. And I only took a week so far. So I actually am going to lose because I didn't take any before I left for Christmas. I took the last 2 weeks off, and I'm actually going to lose 5 days because I didn't use all 4 weeks this year. But I'll get to carry over a week. I've been carrying over a week since I started. But anyway, Yes, this is part of the reason why Chris and I are very bullish on Next, Tellurian. I'm very bullish on Shell, which is an LNG focused company. Total, very LNG focused. I think they're going to continue to do extremely well. Energy Transfer Wednesday night. You heard it here first. Hot Steven got back to me. Cool. I will put that in the books. What else? What else? So yeah, with this, I think, Energy Transfer is going to be around. There's going to be more and more pipelines that need to be built to be able to get some of these LNG terminals up and about. So here you go. Amazon R&D 300% more than Apple, right? I don't know. Zocold, what's going on, my guy? Hope things are going good. I think Apple is turning into a value company. Let's see. Apple price to earnings ratio. Let's see on macro trends. Do they concur with Junebug? Dun, dun, dun. So the price to earnings is sitting at about a 32, whereas previously 2012 to 2019 timeframe, it was trading at about a third to 40% of that, almost half maybe. So I guess it all depends. Hanging out at close to 200 bones. Let's look at their operating income. Am I sharing? Okay, double check. It's taking its time. Making my way downtown, walking fast. Hard to believe that Apple is growing its earnings. All right, we are looking at revenue. Let's look at operating income. So operating income over the past few quarters, let's just look over the past 18 months. So down 4%, up 4%, so flat, down 13, down 5, basically flat, now up 8% on a year-over-year growth basis. And so on a quarterly basis, though, we're looking at 29, 28, 22, 27. So on a trailing 12-month, it's been kind of hanging out. But yet the stock price, if you look, so over the past 18 months to 2 years, the trailing 12-month has been flat. But yet the stock continues to go up and to the right. I think the only thing that can explain this is probably this graphic here. And this helps a little bit because there's a lot of buybacks that occur at Apple. And so keep in mind, when you buy back a lot of stock, you can grow your EPS even though your income is flat. So what they've been doing, it looks like, the trailing 12-month, it's been hanging out at 6. So last 18 months to 2 years, the earnings per share has been rather flat, but growing slightly due to, looks like, share buybacks. And the reason, let's just take a quick look at shares outstanding. Let's just see. What does this show us? Making my way through the clouds. And I need you. I might get demonetized. It sounds so similar. So we're at 26 billion shares outstanding for Apple. You could see they buy about 2 to 6% of the shares on a quarterly basis. year over year. So they were at about 26. Now they're at about 15. So over the past 10 years, they've almost bought back. Let's do that math. How much stock did they buy back? 15.83 divided by 26 and what? 26.5. So they've bought back 40% of the float. So if you divide 1 by 0.6, that essentially is a 66% increase in the stock price just from share buybacks over the past 2 years, right? And then you think, right? So let's just do some quick math. Cool. Let's humor me for a bit. Where's all the money in growth coming from for Apple? Let's just say July 2013. Let's just look at this together and do some math. So July 2013, June 2013, we're looking at $16 a share versus where we are today. So we're at 196 divided by 16. So 196 minus 16 divided by 16. That's an 1,100% return. Okay. So what has happened since then? So we had a 66% increase due to share count reduction. Got it. So that's understandable. Let's see if I can keep track of all this in my mind, because this will be fun. I did the same thing on AutoZone, and it was a lot of fun. So this is 66% of the growth, right? Is just from this alone. Now we're going to do the net income, because that's where the earnings per share comes from, right? So net income in June of 2013 was 37 billion. So 37.7. We are now at 97. So 97 minus 37.7 divided by 37.7. That is 157% increase. Got it. So 157% increase. And then we also have that's EPS. I'm looking for financials, price ratios, price to earnings ratio. Got it. So we were at, from a price to earnings ratio back then, an 8.57. Let's double check we're sharing. 8.57 back then. And today we are at 32. So 32.2 divided by 8.57 divided by 8.57. So sorry, 32 minus 8.57 divided by. So that's a 275% increase due to specifically the EPS, the price to earnings ratio, right? So you can't see this, but let me share my screen with the calculator. So we went from a $16 stock price in Apple in June of 2013. So effectively 10 years ago, to today being $196. So that itself was an 1,100% rate of return, right? So about 11x. So 2.75x of that has been from price to earnings. We know that 1.6 times of that was what was it? 1.6 was the increase in total earnings. And then you have a 1.66, whoops. A 1.66 times of that being, did I do my math appropriately? Probably not. 2.75 times 1.6 associated with whatchamacallit, 1.6 associated with the earnings growth. And then maybe I'm not doing, oh, you know why? So what was it? It was like 97 divided by 37. So that's a 260%. And then the EPS went from, it was like 32 divided by 8.3. Whoops. So it's a 385. So times this by 1.6 and then times this by, what was it? Basically 2. And you can kind of start to see where you get that 1100% from, right? You start combining all those things together. So it's like the earnings is only tripled or gone up by 250%. So it's like, well, what happened? It's like, well, you bought back 40% of the shares outstanding. So you basically double that in terms of the share growth, share price growth. So, and then also your price to earnings multiple has gone up by 300 some percent. And so you start stacking all those things together, and that's how you get the 1100% return. And I need to do more like better mathematics on that, but you start to understand that very quickly, going back to specifically the price to earnings ratio, if Apple started to trade once again like a value stock, a price to earnings of say 8 or 10, the value of Apple would probably go back down to $50 because you'd still have, don't get me wrong, you'd still see growth, right? So you still would have all the shares that have been bought back. You've also increased the earnings by 200%. And so the stock would still probably be worth $48 to $50, even if the PE went down to 8.5 or 9 again. But now you have way less shares, so 40% less shares, and you also have twice the income, 3 times the income comparatively back then. So anyway, a little bit of a thought. I don't think that it's a value stock right now. Sorry. Do I own Tesla or Google? I own Google outright. I don't own Tesla. Wheel Deal's all about Celsius right now. Does he? Is he? I just now got that walk run joke. I did not catch that. Did not. Thanks for the in-depth answer on the Mag 7. Invest in Amazon and Meta, but agree the value at the moment is Google. I would say Amazon as well to an extent. My guys, George with a J, the guy that is part of the Money Gang, as well as Dean Pierce. What's going on, my guy? I'm about half an hour behind on these questions. They do have a Celsius does have a distribution deal with PepsiCo. Will that not fade? I mean, Pepsi owns, I forget what it is, a portion of Celsius, just like Monster owned a portion of, or Coca-Cola owned a portion of Monster. Yes, drinks go in and out of trends so fast. Think of Tab or Clearly Canadian and Shasta. Don't know any of those. The nurses love it. Can't buy the drink in Dirty Canada. And I'll likely buy the stock as soon as possible, looking for a 10 billion entry point. Maybe write some secured puts on that one. Canada's the next big move. We'll have to talk to Hot Tevis about that one. Soon the loonies will start pouring into the balance sheet. Look out in the boot. I'm going to go Moose Maringland. Hot Luke, what's going on? My guy. Garcia joining from Twitter. I once again think of the what's the name? the Bernie Sanders meme. I am once again pleading for you to join us over on the new Cashflow Chronicles channel. And I just put the link in the description. Can't believe how much people pay for drinks. I remember when bottled water first came out, everyone thought it was a scam. It still is a scam. I think about that all the time. Anyone here heard of Premier Protein? My sister introduced that to me the other day. Pretty interesting. Any specific reason why Celsius stock has been falling? I heard that maybe it's a thing to research really quick. Why has Celsius stock been dropping? And I heard it's because the family let me see. Revenue growth. Should you invest? No, that's just a bunch of. Let's see. Uh, 3-for-1 stock split. Family selling. Let me see if I can find it. Nah, I can't find it. But yeah, that's what I've heard. I've heard that the family, the founder, unfortunately passed away recently, and people are splitting up his shares, and some people would rather take the cash than the shares. Would I rather invest into Amazon or Google? I personally think that there's more of a moat, and I'm going to get slapped for this, and I'm sure if Chris sees a clip of this, he's going to be upset with me. But I think that a moat is better around Amazon at the moment, not from an AWS standpoint, but from their e-commerce business. And I truly believe that their e-commerce business is not really what is getting valued at Amazon right now. I still think it's the AWS business and the income that generates. But I think that there's still so much love that needs to be distributed in the e-commerce business for Amazon that I think that is where a lot of value lies. So that's just me, but I know that Google has a really good moat around search as well. But I think that there's a lot of skepticism as to how search might be interrupted with AI. Had to do a family member selling, perfect time to take a position. George with the J, 100%. That's what I heard, word on the street. I know I'd rather own Google given their work on quantum computing. That's also true. Chris talks quite a bit about that, and he thinks that they might actually be a front runner when it comes to that as well. Think Bellring brands could be the same Celsius of protein shakes, potentially. Have I looked into Synopsis? I have not. The brand strength isn't going anywhere near as strong as. Hot Tevis joining again. No, man. That's you. That's you. That's the hot mofo. Make sure to join Hot Tevis and his membership group for Fridays, but he also does a lot of talking about SoFi. So for you folks that are big into SoFi, be sure to hang out with Hot Tevis all the time. Kaiser, when Palantir to zero? I ask myself that all the time, man. I keep seeing all these negative articles on Twitter and YouTube about how it's basically a clown company. They don't actually do anything, but for some reason, the government still gives them contracts. I'm just trying to understand it myself. You know, I know I use it, and I have knowledge about how to use Foundry, not to the extent as maybe some people would like, but I have that kind of knowledge. But yet, somehow, these randos on the internet know more than I do about using Foundry and that it's going to zero. Yo, Matt, you know there are other channels called Cashflow Chronicles? Well, it is what it is. That's what Chris wanted to call it, and Chris gets what he wants. And we'll have to fight to the death. We will have to fight to the death. Who will win? There can only be one. There can only be one. Google is very interesting. I concur. Microsoft's your favorite stock along with NVIDIA, but I've been adding Google thanks to Chris and Matt's insights. Hopefully it's not due to our insights, but also you concurring with the due diligence and an agreement, and hopefully it aligns with your risk tolerance and your time of horizon and all those other things. Steven will ET phone home. Yeah, Steven did ET phone home, and we will have Hot Steven on Wednesday. Lunch soon. Yes, my guy. Happy holidays, my brother. What are you doing tomorrow? I took the week off. So message me, or I'll message you after this stream, and we'll have to get lunch. Matt, I might be starting up a big dividend portfolio 2024. Steve is helping you behind the scenes build it out. Would love to chat about it soon. Yes, and I know exactly why. I'm not going to say it on stream, but yes, we can definitely have that conversation. I'm free all week. I took off, and I'm off until the new year, so feel free to reach out to me. Tavis, that would be a good episode, small caps and dividends for 2024. Maybe that's something me and Hot Chris can handle on Tuesday, maybe tomorrow. Chris and I are thinking about going to 5 days a week. So maybe I let the cat out of the bag too soon, but we're thinking about it. We're contemplating it. We're seeing good momentum, and so coming on 5 days a week might be good. But we'll leave that to the new year. But yes, I agree. I that's where I started. My foundation was dividends. So making a full dashboard on it and doing a mini series, maybe once a month update, following the footsteps of the GOAT Div Investor YouTube icons. I don't think I'm part of the GOAT Dividend Investor YouTube icons, but if you need a spreadsheet, I have you, my guy. As you guys probably know, I am a huge spreadsheet sucker. So I actually used to sell my dividend income spreadsheet, and then got in a partnership with somebody with it, and we were selling it together. We were doing pretty good, and then we parted ways, and so I just never got back to selling it on Shopify after that. But we had a good store, and it was making some pretty good money, and helped a lot of people. That was the most important piece, was helping people visualize their dividend income and show it. And I actually just went through my dividend income for the December timeframe throughout all of 2023. And I think I'm forecasted to end up at about 21-ish, 22,000. So we'll have to see what ends up coming through at the end of the month. But I basically updated from August to December. And obviously December's not finished yet, but I think we're on track to make about 21 grand this year in dividends, which is pretty cool. Less than it was last year or 2 years ago, I forget. But if I can decrease the focus on dividend pairs and still be at 20 grand a year, I'd be okay with it. John Blake, miss you, and now I wonder. Interesting. I don't know if he's talking to Hot Tevis. Join the dark side and pick up some tea. I don't know about all that. Maybe you mean TELUS and not AT&T. You buy Monster and Celsius from Costco and Sam's and sell them to your coworkers through your community fridge. Hey, man, it's not a bad idea. Exxon is your side chick. PE of 10, Pioneer acquisition and Permian Basin, 3.7% dividend yield, $20 billion buyback, lithium mining, carbon capture, Palantir customer, etc. Don't forget Guyana in there, my guy. Guyana, huge cash flow machine for Exxon. Brief little conversation about that. Hess noted that they're going to get about $1 billion worth of free cash flow, from each of the FPSOs they put into Guyana. There is currently 5 sanctioned, 7 or 8 to be envisioned, 3 in operation, So if you think about it, for Hess alone, that was about $7 to $8 billion in free cash on an annual basis that they would be getting per boat, not per boat, overall from Guyana, and they're still exploring with a above 85% success rate in the area. So much exploring to continue to do in Guyana. Exxon owns about 50% more in Guyana than Hess does. So that means more than $1 billion in cash flow, free cash flow, might I add, for Exxon per boat. So keep that in mind for them. Never noticed this before. Matt has a really soothing voice. My guy. Thank you. That means a lot. I think it might just be the microphone because nobody's ever said that about these streams before. I was just rewatched the stream where you and Chris AutoZone this morning. Yeah, that's a really good one. That is a really good one. I think that's one of our better ones. The Grok Chat GPT of financial education. Far from. Am I paying you guys? Are you guys on payroll? Why are you guys being so nice? I better not be getting invoices. Cactus jelly, funny, but make that money. Thanks, Matt, for the review. Absolutely. I don't know which one you're talking about. Late night vocals with Manny Mula. Hot TJ, up and bored. Listen to Matt talk about a company that isn't growing much because they're so damn big, but they print money like crazy. So much money, they're able to buy back 40% of their shares in 10 years. Matt, the smooth jazz money. I like that. They, I forget what it was, but somebody, I've been watching Reacher a lot on Amazon Prime. Shout out to Amazon again. That's another thing. Sorry. That's another avenue. I don't think people. So I watched the end of the Reacher episodes. It started going through all the credits. The amount of different languages that the credits were in was mind-boggling. The amount of different, because obviously most countries use the Greek numerical and alphabet, right? But not everyone does. Like Russia has their own. They have their own characters in Southeast Asia. So, and even other parts of Europe as well have their own characters, Hebrew, all that. I'm looking through it. There's like 25 different credits talking about different actors that are doing the voiceovers and stuff like that. That is why I think Amazon will continue to persist internationally, is because they're focusing on the customer, and the customer isn't just American. The customer is everybody, from anybody all the way up to Fiji, all the way to Argentina. That is exactly who Amazon's customer is, and everybody in between. So I think that's a huge testament to making sure that nobody gets left out. Oh, but quick story about this one. So why I was talking about Reacher was he's really big into jazz, and then the other detective is really into rock. So they start getting in an argument about jazz, rock, and it made me think about the radio station when I was growing up that we'd maybe listen to, I don't know, 5% of the time, 10% of the time. I grew up outside of Philadelphia, and so I was always really soothed by their little, what's the word, intro or outro or whatever. And the station was called WJJZ. And it'd be like, WJJZ 106.1. And I always just that always rang. And it always just it slapped. It slapped hard. I loved it. And so that's part of the reason whenever I would listen to jazz, that would be the reason, is that outro just, I know it's something simple, but chat is be popping. Dollar General might be a value trap. Temu is destroying their market share. That plus shoplifting concerns and deflation hitting bottom line equals just be careful. Well, let's take a quick opportunity because I've been giving Dollar General some time to soak. and not like Mormon soak, like legit soak. So down pretty substantially. So from 240, 260 down to 105. So they basically went down 60% and have now retraced back to 50%. So let's look at year to date. They are down 50% year to date, 47% overall. They're up to 130 bones. So instead of Apple, let's look at DG. WJZ 106.1. Oh, we're looking Dollar General. General. All right. So everything's at about $130 price. So let's look at revenues. Let's just double check we're sharing. We are sharing. Okay, so trailing 12 month 40 billion. So they're growing. Oh, we're growing. Pretty good, by the way, as well. So we're not slowing down. Quarterly up to 10 billion a quarter. You could say they hicked up maybe over the past year, but we'll see maybe when Christmas comes out. So what about net income? I don't like that. Let's look at EBITDA, because net income can have little. Oh, there it is. So why on a trailing 12 month have we been flat for the past 3 years or so? So their margins have been getting attacked, right? So why that? And so let's see, is their gross profit doing okay? So gross profit's there, right? So gross profit is growing. They're like a 30-ish, 35% gross profit margin. So that's not awful. But here is where it's getting interesting. So the EPS. So what's going on with the EPS? How are their shares going? So they're buying back a lot of shares. Got it. So they're buying back shares. So on an EPS basis, it's looking pretty good. Net income has been stagnant, though. I mean, we know why, right? I mean, their margins are going back to where they were pre-2018. They climbed during the pandemic. So maybe that's what it is like, were they able to just maybe charge more? So how's their ops margin? Let's look at their gross margin. Gross margin, yeah, the 33% like we talked about. Normalizing a bit. I get it. So yeah, we're making about 12 billion out of 38, so makes sense. So an ops margin, they just need to hire more people. Like, how's the EBITDA margin? Yeah, it's going down too. And I know their debt's been going up. Yeah, so I think that's I'd like to look into how many stores they have. Because personally, my mother, about 3 years ago, moved out of the Philadelphia area into a smaller town. Did this just go blank for you guys too? That's strange. So I'd like to do a little bit more research on store count growth and things like that. So I might come back to this one because it looks like to me gross margin's there. So you're at 31% gross margin. Operating margin's going down. So get that. Net income margin, though, net margin is taking a pretty big hit. And I'm wondering if reason being is they're spending a lot of CapEx, in which I've seen that their CapEx, let's just see, do they have that in here? I feel like they have to. Oh, God. Financials, prices, margins, other ratios. Why is this freaking out? Other ratios, return on equity, other metrics, number of employees, dividend yield, margins, revenue, profit. Do they have that? Shares outstanding, cash flow, prices. They don't have. They don't really have capex. But if we just look into the cash flow, and then I'll leave it there because I think I know maybe what's happening is let's just see. So this is annually. Sorry, this is annually since 2013. So net income has grown pretty substantially. Total appreciation, got it. So net cash. So stock-based compensation has grown from 21 million to 72. Cash flow from operating activities. Sorry, cash flow from financing activities. Okay. So they went from investing about 500 million, and then after the pandemic, they went to start investing basically about $1 billion to $1.5 billion in this most recent year. And so with that, it looks like they took on debt. So I think what people are upset about maybe for Dollar General, and I need to do more research, like I said, is I think people are upset that the EPS has been flat. So there's that piece. And that they've been investing a crap ton of money into the business. So there's that. But let me just take a quick look again at price ratios. What's their EPS? So EPS is getting to a point where it's like 13, and even if they stay flat, it's relatively cheap. So I guess that's the thing, is like they keep buying back the stock, right? So it's not that the earnings is massively skyrocketed, right? Because if let's look at the shares outstanding again. Other metrics, other ratios, no. Revenue, profit, shares outstanding. They bought back over the past 10 years, 12 years, 346 million. So 220 divided by 346 minus 1. So they bought back about 35% of the float outstanding. So, I mean, that increases your price to earnings and stuff. I don't know. I'd have to do some work. I think that reason being is they're taking on a lot of debt right now, and people are no bueno about that, and they're not seeing the growth. And my question is why aren't they seeing the growth from the new stores, right? Do they have to establish some time before you really get to a place where? So that to me just is what's a little peculiar as to what's this 1.5 billion going to? Because if you think about it, 1.5 billion, that should mean that if over time those stores generate a pretty good chunk of change, 30% ops margin, that should hit your EBITDA, right? Anyway, just some thought there. Yes, Merry Christmas. Getting close to all. Does anyone actually use Temu? Temu, I invested in a company called Wish in the past, and I got burned pretty heavily on that one. So if it's the same high marketing budget, stuff like that, I'll probably stay away. Only addictive gamification for Roy's breakdown seems like a game changer. Puts on Celsius, I don't really like the prices. 40% is your target to acquire, or $40. Let's check it. Let's check it, TJ. My guy. Because I might be with you, my friend. I don't know, man. 49 bones. Like, I can't. Even at 49, is it really that expensive for you, guy? I don't know. Let's look a month out. What are we talking? What are we talking, TJ? 25 center. So let's see. Let's do some mathematics. So $25 for $4,000 on hold, times that by 12. That's a 7.5% yield. On your cash. I'd probably get closer. TJ, that's out of the money for you, though, guy. That's kind of far. Normally, you're more of a guy that writes it at the closer to the money. You really must not like the stock. Because I even would go to 45. Like, I know that this thing could dip, but is it guaranteed to dip? That I don't know. But so I would take the $45 guy, and you're going to get $95 for that. Times that by 12, that's 25% per year, you know? Do you really think it's going to dip that much more below 45? I mean, you could be right. Because that's a what? 13% move. It's at 49 right now. 10% move versus a 20% move. It has to go down to 40 bones. You know? You could be right, my guy. I don't know. That one, but I might have to write some puts on it as well, or I might just buy leaps. I really don't know. Maybe I'll write a double put and use the capital to buy some leaps, but I feel like I don't think I'll have enough. I don't know. I'll have to think about the way, because I definitely want to get into Celsius. Started getting back into REITs like SCHH, but they have jumped. They have jumped because debt is going to be cheaper and cheaper. Started to use Timo that made it addictive like crack for the app. Not my thing, but it'll drive sales. Robin Hoodification of shopping. Very appealing. Eyeing Celsius, but still doing DD. What is this? 38% profit margin. Didn't know it. I'll have to check it out. I'll have to check. I'm not sure whom you guys are talking about. Sorry, I'm trying to follow. Timo does a social shopping where you get deals if you shop with your friends in China. Wonder if they'll try that in the US or not. Interesting. Nurses do like Celsius for sure. So do hotel workers. Okay. It's heading that way in the US, I think, but for now, lots of mini games, invite your friends, etc. For Temu, specifically, I'm thinking done very well, and I hate it, but it's really for PayPal branded, plus bought a few items. Amazon and Google, both amazing. I slightly own more Amazon, though. Can't disagree with that one. Didn't know there was a PayPal connection. Yeah. Money Matt, appreciate the insight. You're the man. I appreciate you. And the logistics at Amazon is building UPS and FedEx will have some competition. 100%. Dude, love the Celsius. Bought 3 cases to take back to Canada. It's contraband. My guy, don't get locked up. We need you. I have both Amazon and Google. You can't lose. I concur. Temu is burning cash for growth right now. Only time will tell if it sticks. That's the thing. Sometimes, like Wish was literally every dollar they were making was putting into marketing. And when they stopped the money for marketing, trailing 12-month monthly active users went down pretty substantially. Sell shares. Yeah, dude. Whenever you take a flight down to the US, just bring some money back or bring some Celsius back, and could be it. Need to set up a GoFundMe for Tevis's bail. Jesus. I hope not. Love pounds here to send at these prices to add more shares. Concur. Thunderdome over Cashflow Chronicles name. There can only be one, my guy. Nice Highlander reference. Yep. Sorry, I know I'm behind, guys. Put the link in the chat. Let's chat. We all up anyway. Sure. Kev, thanks for showing up. You took the week off. Swing by Toronto. I don't know if you can handle that, guy, but that's an offer. I might. 5 days a week. Yeah, man. Hopefully. Wheel trackers a shit. We got Hot TJ. My guy.
What's up?
How are you feeling, my friend? What are you doing, man? It's like almost 11:30.
I know, man. This is the time that I do all my work. Wife's asleep, and we've got a lot of money on the sidelines going into this week, Matt. And I'm just I want to deploy some of it so I can just increase my my return for the year, right? Trying to pad the numbers, if you will, but I don't want to get caught with my hand in the cookie jar either. So, let's talk about Celsius for a minute, though.
Yeah.
I've got a lot of open cash secured put. Well, not a lot, but let me pull up one of the spreadsheets here.
Yeah.
The big Robin Hood. Here we go. This is it. See if I can learn how to do this thing here, man. I do this. I go live almost every day, and I still don't know how to use this thing sometimes.
Not me either.
Can you put that on the screen, my man?
Yeah, man.
So let me just make that a little bit bigger for us. There we go. So Celsius, what we got cooking with Celsius right now is we've got 25 cash secured puts at 48.33. So we're just cash grabbing.
Uh-huh.
Collected 28.75. Are you familiar with Alpha Spread?
Not so much.
Okay, so I subscribe to Alpha Spread. Gives you like a generic DCF and intrinsic value calculation on stocks. So for people like me that don't know how to do that math like that quickly, I rely on software to just kind of give me a starting point, if you will. And but it gives you a lot of valuable information on companies, and that's where I found that insiders have sold almost $1 billion worth of shares in the last year. Mm-hmm. And as an investor, that gives me cause to pause. I'm like, mm-hmm. Dude, if you're not like Anthony Noto buying a bunch of shares, kind of giving me the playbook, it doesn't get me that excited to want to acquire these shares right away. You know what I mean? For sure. So when they're selling, why should I be buying, right? Like in my mind, that's just something real generic that I utilized over the years that really does me well. But right here, what I'm just doing is I'm just cash grabbing, dude. This is my second cycle. You know, we collected 950 on the first cycle, gave back 100, so we profited 850, and on this one we got 28.75. And I'm looking to close out at like 80 or 90%. I have absolutely zero interest in owning Celsius at these levels, but if I go sell a cash secure put at 40, that's my target price. I'm going to get peanuts. And I think you did on your stream earlier showing it's going to like a 7% return.
Right.
That's not where I want to be. So, but I'm just, I'm playing a game where I'm selling a cash carry put on a company that I'm willing to own, but I'm not necessarily willing to own it at these levels, but I want to get paid to kind of watch it, if you will. And I'm really hoping it dips, dude. And my cash carry puts kind of get under pressure and I can roll them down. I would take ownership of the first batch at 40, but I wouldn't load up unless it was closer to 40 or at 45. But I really wouldn't load the boat until I was like sub 40, because have you looked at the chart, man? It's gone up substantially.
It's gone up. Yeah. I tend to not try to look at charts, though. I mean, to me, charts are secondary. I know a lot of people rely heavily on technicals, but I'm more of a fundamentals guy at heart. But obviously, that doesn't happen very well when you're looking at things like Bros or Palantir and things like that. So
no, I'm with you. I'm fundamentals over technicals, but I do utilize technicals, specifically like the moving averages, just to give me a good idea of where to sell a cash carry put in a covered call and be kind of comfortable. It can give you a good entry point. But that being said, I mean, the fundamentals is what you have to utilize to decide whether or not you want in on the company anyway. I mean, this company is growing 100% year over year, which is exciting. And they're really, really small, but they're on a higher trajectory than Monster was at this stage in the ball game. And I think the reason is, Matt, in my opinion, how do I stop sharing this screen so we can get can you get the full screen up there or no? There we go.
What do you mean?
No.
I mean, that's
So I think what they've done that's really, really unique is they've appealed to both sexes. Because like when I think of Monster, I think of like the UFC. I think the way they've branded themselves, it's more of a male-dominated customer, if you will.
Yeah.
Their target audience, their target market, I feel like is just more male than anything else. And then if I think of Red Bull, I think of like those New Year's Eve celebrations where Evel Knievel is doing some crazy shit, or the guy's jumping off the plane into a net. Like it's just... It's a very niche market, whereas I think Celsius is kind of branding themselves as like this semi-healthier energy drink, but the women are really into it as well. And the beautiful thing about that is they're, a little bit more than half of the population. So I think they've been really, really smart in that aspect. So that's what really, really appealed to me, because initially when they were like pushing Celsius on my channel, like for me to look into it, I was like, bro, it's like another fad drink, like people, like these things come and go. I can think of, like I was real big into Bang a couple years ago now. I won't think about it. I did a couple of Monsters. I didn't really like them. There was one called Rockstar back in the day that I was kind of into, but it was like just here one day, gone the next. But I think that this one might have a little bit of staying power, and they got really, really good margins. I think PepsiCo is their distributor now, and they're just doing the international expansion now. I think in 2024 they're going into Canada, and they have a wide array of drinks, man. Like their SKUs is really, really large, which I don't know if that's a good thing or not. But I also do like that. I like the fact that they don't manufacture their own product. They use a co-packer. So like they're focusing on the part that makes you the most money, and that's the distribution and the sales. And it's interesting, man. Have a look at it. But I look at Alpha Spread, and it gives me all these charts and figures and stuff. And what I like is that they're a profitable company already, and they're growing a mile a minute. So whenever a company grows really, really quickly and it's early, Matt, as you know, their valuation is going to be really frothy, and you got to give them time to grow into their valuation, a la Palantir.
Yeah.
That's why companies like Palantir are they're hard to deal with, because it's like, okay, you're only giving me 17% year over year growth, but if a couple of things fall in place, you could be giving me 30 or 40%. So it's like, what am I willing to pay for that growth potentially? And it's just, that's what makes investing fun, dude. It's not that cut and dry on these companies that are growing hand over fist.
Yeah, I think the thing that's part of why you're making so much money off of these things, though, right? Is the volatility aspect of it, right? Because so I mean, you kind of have to look at it, and so anybody kind of listening to the conversation, it's easier to guarantee the win or manufacture the win on something that might be a lot less volatile, but what you're going to be getting is probably pennies on the dollar compared to what you're looking at. I mean, you do crypto miners, you do Palantir, you do these companies that, oh, dude. Speaking of
What's up,
speaking of money,
Debbie?
little impromptu guy, but yeah, I mean, when you're looking at stuff that's so volatile, it's going to be a lot more money to generate. Hot Tevis, what's going on, guy?
What's up, boys? Been
Man,
watching for the past
all
2
good,
hours.
dude.
Stamina.
He was kind enough to come on my channel, and we talked all things Tesla.
Did he convince you to
The
buy
only thing
more?
that's annoying about Tesla is we just can't get that sexy entry point again, and it's one of those things that you just feel like you're underweight a company, and you know that it's going to go to the moon at some point. But it's like you don't necessarily want to overpay right now because you feel like Elon can say something really stupid and then he's going to give you the deal of a lifetime this one last time. So we're holding out for that stupidity. I just don't know.
You might be holding on for a while, DJ.
I don't know, dude. I want to get it. I want to get it right at 200, dude, and it went there. But I had already committed all of this money because I got caught bad with Enphase. I was down when we were in Vegas. Guys, I was assigned a shitload of Enphase, and when we looked at the portfolio that Monday, we were down $750,000 on that acquisition of Enphase initially. So I had to what am I going to do? Obviously, I'm going to sell covered calls, but now I'm going to have to sell them below my assignment price, and I had to just really put all my attention into that, and then all the while, freaking Tesla starts running up again, and I lose that play altogether. But Enphase thankfully has bounced, and we're actually even on the Enphase now, and I'm gonna trim half my position at 175 because it's just so lopsided right now in the portfolio.
Of all people who you would expect to not be in Tesla, Steve is getting in Tesla.
Yeah, dude, he hates the valuation, but I think that at some point you just can't deny what
getting in, man.
Doing. Look at the Cybertrucks. The Cybertruck's just fun. I don't think that thing makes money for a while.
He's not getting in for the Cybertruck. Get this.
The Model 2.
He's getting in for the bot.
The bot. What is it called? Optimus? Is that what it's called? Or the humanoid or something?
Exactly. Yeah. It's just the potential of the bot alone. Wow. So you're everybody's in, man. You're missing the boat, TJ.
Yeah, except for Maddie, I guess. Well, you're not in, TJ, at all?
No, I'm in. No, dude. Tesla, we've got shit. Let me look at the tracker. I'll tell you. Tesla is.
I actually hopped off the chat about a little bit about Celsius, man. I tried this thing. It's like crack. It's liquid crack. It's so good.
Do you think is it that good? I mean, I don't know. I'm more of a potent guy. So you're more of a health nut than I am, TJ. Obviously. So
2,200 shares, guys, of Tesla total.
That's what you have. Okay.
2,200. It's just I really wanted to be a 5,000 share position. I just haven't had the balls to get there. Just to be honest with you. It's hard, dude. It's so hard to commit a pretty substantial portion of your capital to something when if there's 100 seasoned investors arguing about the stock and the valuation, it's literally about a 50-50 split. And it's not unanimous. Like, hey, Apple, they might not be growing, but they're printing money hand over fist. They ain't going anywhere. You know what I mean? So it's like, okay, cool. I know that I'm not going to lose money because this company will just buy the damn float if something happened to the shares, right? Or like PayPal is kind of what they're doing, or Google is doing. They're free cash flow machines. But Tesla is, I just feel like I don't know what they're going to do. You know, are they going to focus on profits, or they're like, I don't give a shit about profits. I'm going to hammer the competition. It's just, there's a lot more execution and uncertainty with Tesla over the next 3 to 5 years, over 10 to 15 years. Did I want to be on record on this channel? Any channel I go on, I want to be record on saying I believe that Tesla will be the most valuable company in the history in our lifetime. I do believe that that's going to happen, and I have a time frame on it at between 2030 and 2035. So I think it's going to happen really, really quickly because they have so many damn levers to pull, and they don't all have to hit, dude. Just a couple of them have to hit. And that is what is super, super exciting. So I asked myself, okay, I have this game changer stock. I have a lottery ticket here. Is 2,200 shares enough so that it's life-changing money? That's always the big question that I ask myself. Like, how high could this go? Could you do the Kathy Wood thing? Does it go to $4,000 from here? Like something retarded, right? Like, I don't know. But is 2,200 shares enough, or do I need to like scale back like my beloved SoFi and move those monies over, etc.? Because I've like really manufactured the win on SoFi right now too. And it's just, dude, investing, when you imagine your own portfolio, guys, it's like, I know you'll see people like me that, we're up a couple $1 million and we're all transparent and it's exciting. But dude, it's there's a lot of intricacies to it, and it's hard to just, you got to be an allocator of money at the end of the day. And it's very, very difficult when you only have so much money to work with.
Mm-hmm.
And man, it's tough, dude, because if I'd have done riskier shit, guys, I'd be up another $1 million for the year if I would have just stuck with my miners. But
yeah, easy to say that now.
I have like a little bit of hair that still grows. That shit would have stopped growing. It would be too irresponsible. So I wanted more boring shit in the portfolio in my mind.
So do you sell covered calls on Tesla?
Yeah, I have. Dude, my cover calls for Tesla are for all of them. Every single one of them in all the portfolios are for January of 2025 at 300. And I just sell one cover call a year. So next year I'll go from 300 to like 350, and I'll play that game. So they're just buy, hold, and hopes that give me one dividend check a year. Because Tesla, you can't sell cover calls weekly and monthly, bro. I don't know how many times I've tried, and you just can't, because the stocks is just too, when it moves, it really, really moves. And I can't do it. But with that kind of shares, I generate $70,000-$80,000 a year in premium off of one transaction.
300 for 2025, CJ?
Bro, it's easy money right now. I'm up at 56% on those.
Roll those, man.
Huh?
You're gonna have to roll those.
I know, but I'm long Tesla. That's the thing, dude. Like, when you're selling a covered call and you're legitimately long, I don't give a shit about to roll this thing for the next 10 years. I'm in, bro. I'm not trying to sell these shares. Like, it's like SoFi. I'm not trying to sell at least half of my batch until we get to that. What's the magic? The parachute, is it $27 or something like that?
25 is the lowest tranche.
Yeah. So half my shares are gone at 25, because at that point, the weight in the portfolio would just be absolutely stupid. And I gotta move that money over to more boring, stable shit. Because at that point, preservation of capital becomes a real thing as well. So let's talk Celsius, though. You want to talk Celsius, guys? Because, dude, this thing, bro, I've got a case right here. Bro, I really think they're paddling crack, dude. Like, I'm not an energy person, by the way. Like, I'm wired. Y'all see me. I'm wired already. Like, I don't need help. But, dude, this damn thing, dude, it gives you the feel goods, and you don't get, like, all jittery or anything. And that I've never been able to find in another drink.
Yeah. Yeah, that's why I wanted to try it, too. And the thing is, I posted this on X comparing it to Red Bull, because we don't have Celsius up here. And so when I went down to Florida,
in 2024, you guys will, I think.
Red Bull had 80 milligrams of caffeine, and this thing had 200. But Red Bull left like an aftertaste, and I just didn't like. It was a much more intense taste, whereas this thing was like, honestly, like flavored sparkling water almost. It was so light, where I feel like I could have woken up in the morning and just had one instead of a morning coffee, and it would have been great, And I could never imagine something like that with like a Red Bull. I would just get nauseated immediately. And so I got hooked on these things, man. I started to try all of these different flavors, and it's just, I don't know, if somebody doesn't drop of a heart attack or something like that, then I think we're in business, boys.
I think so. I mean, the thing that I guess I'm a little bit misunderstanding at the moment is why they are yet to grow so substantially ex-US, meaning, in Europe and Asia and South America and maybe Africa and Australia. And it might just be the fact that they need Pepsi to kind of bring them along. That might be what it is, right? It's just, I just find it very surprising.
Their distribution channel was they would go in a store and they would just like set it up directly with the store. I forget what these little acronyms are. Like, I think y'all had that guy in your channel, Tevis, that talked about that. But now they have PepsiCo that's like their main distributor. But there's conflict there because they own Gatorade. So I think that might take that whole hydration market off the table for Celsius, which is a big market as well. So there's gimmies and gotchas with everything, you know.
I don't think so, man. Like if Pepsi owns both, then it's dealer's choice, right?
I mean, I don't know what kind of deal they have with Gatorade. That's why I don't like to speak on things that I'm not willing to research because I don't know. I leave that kind of shit to you guys.
I think, Matt, with regards to your question, like they strike me as very much still in their infancy with regards to the scale of their product. I could be totally wrong on this, but I mean, they're growing over 100% year over year. Why try to bend over backwards to rush to international expansion where you have still such a total addressable market to tackle in the US, especially in countries like Canada, where it's 1/10 of the population and 10x the regulation? You know, like why would you do that to yourself?
That's a good point. That's actually a really good point, right? Yeah, why expand too quickly elsewhere?
If I had to go, if I were Celsius and I had to go to Canada and it's literally 1/10 the population and I had to deal with Health Canada's like regulation, I have to now modify the formulas for the cans to reduce and I'm just saying, screw that. Like I'll just expand more internally in the States and just try to hit more stores in more states.
Right.
That's a good thought.
Can you share this right here real quickly, guys? How do I do it? This guy. No. This guy. So this is from Alpha Spread, and we can go through. You guys are going to understand these. Are you familiar with Alpha Spread or no, Tevis?
No, sir.
Yeah. So this little website or whatever, they just put out really, really good information. They give you generic intrinsic value calculations. It's like a relative versus. They have a combination model where they're using like DCF and something else, but it's really, really cool. And they give you all of these metrics. But do you look at the historical, like the profit of this company, they're a little bit undervalued according to this thing right here, or they're a little bit overvalued right now, in my opinion. And then it gives you everything like on the fundamental analysis, all the financials, like you look at their revenue, the operating income, the net income. But the one thing that really, really caught my eye, guys, it was very Palantirian from the standpoint that this company doesn't have any debt, dude, and they got quite a bit of money on the balance sheet. And I like companies that financially it's very hard for them to go out of business. Like to me, if there's a place where I want to start with a company is okay, cool. I'm a sucker for a story. Like I'm a story sucker. Like I'm a story stock guy. Tell me a good story around the campfire and I'll be interested. But more than the story for me is like the money. Does the company make money, A, and does the company B, and really A2 or A1, does the company have money to pay its bills? Like what kind of runway do they have? And this company has money, and they not only make money, they generate a profit and free cash flow, and they don't owe anybody a lot of money. The deal that they stroked with PepsiCo or Pepsi, whatever you want to call them, is actually a pretty sweetheart of a deal. Like they didn't have to drop their pants to do business with them. It's almost like Pepsi wanted to do business with them as much as Celsius wanted to do business with Pepsi. And I'm like, dude, they're kind of like in the driver's seat of this whole thing right now. And I like companies that are pretty healthy financially, and they got the good vibes going. Like people love the product. They swear by the product. They have their own fridges as well. And their placement, dude, like if you go into just a gas station here in Texas, like their product placement is so freaking awesome, dude. I have no idea how they manage that, or maybe like the Valeros of the world they have like the stripes here in Texas. I'm not sure if it's like that nationwide or not, but it's like, do they place these things to where like people are grabbing them, or you go to like into the Costco, dude, and these damn cases are everywhere. They're just like, they're staring at you. And then obviously you can buy them on Amazon as well.
Yeah, I actually was just reading up on that I think I might have showed it on the stream, but Amazon said that they were the #1 energy drink seller on Amazon, and second was Monster, which is actually pretty interesting. And it was actually an increase of 40-something% year over year. So pretty cool to be actually able to see that. And I don't know, my hope is that it continues to do well. I was a huge Monster guy, and I think another thing with Monster, which is even pretty interesting, my buddy started messaging me about these Reign, and these are a little bit better than say the normal Monsters, but he started messaging me about these Reigns, And I was like, I wonder who owns these, right? Because now I'm in the market for potentially buying into Celsius, and I'm like, it's actually Monster who owns this, which is actually pretty interesting. Like, you don't, all these different things that come out into the market. It's like people probably sitting there being like, man, I should buy Gatorade. And you find out Gatorade's owned by Pepsi, and it has been for God knows how long, right? So it gets you to think a little bit, like, what other brands?
I think
can Celsius
that's
buy?
why Warren loves Coca-Cola so much, because Coca-Cola is not just a damn soft drink. Like, they own a lot of other shit. They own bottled water companies. You know what I mean? Like, it's their reach is a lot bigger than what we think. But the one thing that does give me cause to pause with, because everybody like gets all on the hype train, right? Like the good. Well, I think this part is a little bit ugly, and that's the reason I have cause to pause right now on valuation, and I'm not initiating my buy right strategy. Where like I'm like bullish on a stock, like when Palantir was sub $8 and $9, I was just buying the shares outright and start selling cover calls that way because I want to participate in capital appreciation. I'm unwilling to do so on Celsius because over the last year, there hasn't been any insider buys, only sells to the tune of $870 million. So this company, the insiders know their company more than we do, I feel. And I'm like, dude, if these people are selling at these levels and 870 million, you can't tell me that's just a tax bill.
But as of what date is this, right?
Because this is during the last 12 months. So the last transaction was made December the 6th.
So if you could look into specifically the transactions, because the previous owner and founder died in August this year. And so the thought process is, and maybe this is what a lot of people are talking about, is that the insider sales specifically have been because they are in the place of and it could be very well like a bunch of different people, right?
Yeah,
but
so it's so I'm putting it on your stream right now. Like, these are all, this alpha spread gives you like a lot of cool shit, dude. And it's this thing was like 120 some bucks a year. I needed a little tax write-off, so they suckered me. You know what I mean? Like, and anything that give me anything pretty, because on my channel I just show the portfolio. So it's like, now I finally got some charts and graphs and shit because people like this kind of crap.
I know when I spoke with Jonah on Celsius that this was one of the major risks, is the heavy concentration in a few insiders.
Right.
And to the point where, like, if a couple of insiders started dumping the stock, they own like 30% of the stock or something like that. And but I mean, that won't always be the case, right? This company is still very small. It's just $10 billion, $11 billion. Institutional holding is like nothing on this company. And there's always the, call option of whether or not Pepsi is going to come in and buy them out at a pretty healthy premium. And so I think you are getting some type of compensation for the risk that you're taking on in the heavy institutional owner or heavy insider ownership that we have right now. That's going to get equalized. It's going to get bought up by the market, even if it is like, even if we're seeing a drawdown, from whatever it went from 170 to like 150, or I guess from 70 to 50 now, it's going to get bought up by the market. And then you still have the long tail of institutions coming in, of Pepsi coming in. I don't know if it's too expensive for Pepsi, but I mean, it's only 10 billion, right? Pepsi's what, 200 something billion?
Yep.
And I got this little card too. My co-host from Power Hour gave me this card. It says Celsius NASCAR number 7. I don't know if they actually have this car running or not. I haven't, because I just got this in the mail yesterday. So I don't know if Celsius actually sponsors NASCAR number 7, or this is just something that he got on Amazon or wherever he bought this. So that's a lot of exposure, dude, because there's a lot of eyeballs on NASCAR is what I'm saying. Like, I'm not a fan, but dude, a lot of people are like ape shit over cars racing in circles.
And I also saw that they were increasing their exposure into F1, more specifically Ferrari. And so there's a lot of eyes on Ferrari,
right?
And that goes global, right? That's 20 some races a year that goes around the world. And a lot of people follow Ferrari. I'm a Ferrari guy personally. I can't afford one because I'm not Tevis rich, but at the end of the day, I think that's going to put a lot of international eyeballs on it. And if 4%, 5% of your sales are coming from international, that could be an avenue for increased exposure. And those things aren't cheap. Those advertisements and connections with Formula One are not a cheap investment.
I will push back on that. I'll say that at this point where they are right now, they would probably be better served with like an NBA team or even like NASCAR, like something that's like just US alone, because 95% of their user base is in the US and they still have a lot of runway to go with regards to advertising in the US. If I follow Formula One and I am a Ferrari diehard fan from Italy, I can't get this drink. You know?
You're right.
So Red Bull is international, and Red Bull has their own team, and I get it. But Red Bull is in a very, very different stage of their life cycle than Celsius is.
For sure. I want to talk over. We've talked a little bit about in and out of the fundamentals. Tevis, have you bought shares yet?
So funny enough, so the broker that I'm at doesn't offer shares. It only offered options for whatever reason. So I bought Leafs.
2026 boys?
Huh?
2026 boys or
2025? But yeah, they don't offer shares. So right now I'm looking into another broker to potentially buy shares. Possibly this dividend portfolio is also going to have some Celsius in it just because. But yeah, that's Canada for you guys.
Okay. And then we know, TJ, you said you sold some puts.
Yeah, I have 25. And then on my wife's account, the YouTube account that I show all the time, we got 3 puts at 48.33, and I'm on the second or third round of puts there. Still don't own any shares, and I really, my target to take ownership is at $45. But that being said, one of my core strategies with puts is if I can get away with it 4 or 5 or 6 times at 48.33, and I have a chance to just take ownership there, then it's almost like I acquired them at 45 because I have all of that premium as kind of like my cushion, if you will. So that's kind of another way for me to be able to get into a stock at a higher price by just selling cash secured puts and getting away with it a few times. Because it's just like Tesla. Like, dude, a lot of times I'll sell puts on Tesla at 220, 230, just cash grabbing, hoping for the day that I could get assigned at a pretty good price. But if not, well, I mean, I can get paid for trying, you know what I mean? And then the premiums are pretty juicy on Tesla as well as Celsius. Like the premiums here are pretty decent. I don't know why they have those weird numbers, though. I think that they might have to do with the split that they recently had, Tevis.
Yeah.
They did a 3-for-1.
I hope that goes away, dude, because like on one of them, like the collateral was like 666 or something, and I was like, dude, I ain't doing that.
Like, I'm not touching that shit. That makes sense.
Putting holy water on my computer and shit. Like, what the hell? Dude, like, music backwards. Like, this is just crazy shit, dude. So they need to get rid of that because it just gave me the bad juju whenever that came up on my screen.
That's pretty funny.
No, there's a lot of investors that are like into this numerology thing, dude. And it's like there's certain things that I won't touch. I'm weird. Like I don't sell cash secured puts on the 13th and just little shit that's weird about me. Very seldom will I ever pick a strike price of 13. It didn't matter what the stock is. Like I got weird little shit going on with my superstition.
You're a gambler at heart, TJ.
but y'all both see me on the what the hell is the one where I bet on black? Is that called roulette?
Yeah.
Dude, I'm a degenerate, bro. I'll just break it. Let's go 300 or 400 on black and call it good, you know?
Dude, we played at the roulette table and I was betting on like that numbers, and then TJ was just going like red, black every single time. Just sitting there, red, black, red, black. I'm like, what's the point of this?
It's like about a 48% chance. I was like, fuck it. I want to know right away, bro. I don't want to be there an hour to lose money. I'd rather find out in a second or two. It's like, to me, that's the equivalent of buying calls or buying puts short term. You're gonna know. You know, like I'm not doing anything long term there at the table. Like we're gonna go home a winner or a loser, but let's do it right away so we can get to dinner. And it's a good time with you guys in Vegas, man. We definitely got to do that again. I'm actually doing a Wheelers meetup. I'm looking at next June. I'm targeting June or July, but in Miami though, I want to do like a little yacht party.
Oh yes,
yeah, I'll be there.
And it'll be cool, man. So we can do something. We got a mid. Something's going on with a mid, and then if I can get something going on a regular basis, that way we can all continue to, foster and cultivate the relationships. Because that meetup with the Mint was fun, dude. Like
That was a good time.
for sure a good time.
Yeah, it was a
The
good
other
time.
stocks are all eyeballing, dude. I got a lot of money on the sidelines, dude, and I'm looking. Like I call it stocking stocks. Like right now, like at these hours, I like to stock stocks because the numbers aren't moving, right? So it's easy to look at them with a clear head. Is there anything that you've got your eyes on, Tevis, that you're not already in, or something that you're in that you're underweight on that you're really trying to get in more? And what about you, Matt?
The only stuff for me that I've bought other than SoFi, Tesla, then obviously the Celsius Leaps is Unity and Pinterest. And Pinterest and like Unity's ever since they ditched their CEO has been just straight up, and Pinterest has been like green every single day for like 3 weeks or something. It's just ridiculous.
Is Pinterest a profitable company?
Yeah, they like sort of teeter on the edge, but they are profitable. Unity is not. But yeah,
Is
those
Unity,
are like
one of
more
those is Unity one of those Kathy Wood stocks?
Yeah, it is. Yeah, she has Unity as well.
Yeah, I thought about doing ARC just because this bitch, dude, she loves all the stocks I do. I'm not willing to buy them all. So I'm like, well, maybe if I could do this degenerate gamble on just ARC, and then I could have exposure to all of these because dude, I mean, I like, some unprofitable companies, but not like a whole ETF of them.
She's been buying a bunch of SoFi recently, hey?
Yeah, dude, she buys it at like $9. That's the part again that I don't get. Did I ain't trying to acquire any shares of SoFi after knowing everything that I know over the last 2 or 3 years being in the company. I don't want any shares over 750, quite frankly. You know what I mean? Like, I feel like I have enough information to know where the range of this stock is that's decent. And 2 or 3 years from now, we're thinking, hey, anything under 15 was golden, but we don't know that to be true yet. It's just a suspicion right now. It's a hope. But I feel like historically, dude, if you're in it for even under 8, I think you're golden. But I don't know why she's scooping shares up at these levels right here. I'm thankful she is, but I just don't understand the strategy.
Yeah. I don't know. For me, I think the problem with my strategy is I generally don't care if I make money tomorrow, right? And
Correct.
I think for me, sometimes these option things can work out, but I think for me, more specifically, I'm looking for the things that'll 5-10x over the course of 10 years or so. Because most of my money I'm just going to park in the S&P 500, right? I think for me, the majority of my money is going to be able to be accumulated through just working my ass off and putting it to the side. And eventually I'll find some opportunities like a Palantir or something like that that'll be able to give me some outsized returns. And so there's a few that Chris and I are kind of looking into that will provide some opportunity. Like I think NEXT, which is next decade, that's an LNG terminal that's going to be kind of online starting in 2027, 2028. But that doesn't help you out, TJ, because you're looking for stuff that'll generate income or will potentially go up from a long-term covered call long-term call perspective.
I'm looking for about 30 to 40% cash on cash return via cash puts.
Yeah.
And I'm also looking for a stock that can legitimately double within the next 3 to 5 years as far as market cap goes. I can't necessarily say from a share price because there's so much that goes into a share price that I know today that I didn't know even 5 years ago. Because we don't really understand how these share prices happen. There's so much dilution and all of these other things to take into consideration. Like when people are like the miners, when's Ride going to go to 50? I was like, dude, at this dilution rate, probably never. You know what I mean? Like, and they could be a much better company today, but we're paying the penalty as investors because these companies have to survive. So they're going to sell shares like crack, and we're going to continue to buy them. So it's just, I just feel like I just keep getting more educated as an investor, and I understand that at the end of the day, the laws of supply and demand are ultimately what control the share price. But I can look at market cap, like to me, and I'm like, dude, I feel like SoFi will definitely double in the next 3 to 5 years, so it's golden. I think Palantir will probably double in the next 3 to 5 years, even from these levels. It certainly has done that already for the levels that I acquired it, but I think they're on that trajectory. I think Tesla, if this, when's the Model 2 supposed to happen? Is that this coming year, or what are they saying on the Model 2?
It's not been announced yet, dude.
No, there's a guy that covers it that he had a video.
They're saying it might be announced in early 2024, but it's not.
I'm more excited about a couple gigafactories because that's really what moves the needle down the road.
Yeah,
I mean, it's cool to announce a car, but you still got to be able to build them somewhere. You know what I mean? So it takes a while to wrap up.
This is what people don't get is like with a company like that that's continuously supply constrained, it doesn't matter if they have one product or 100 products. The raw materials of those products are what is the limiting factor there, right? If chips is your bottleneck, it doesn't matter how many products you have or can build.
Right.
Like it's a limiting factor for all your lines, first of all. And second of all, if it is the limiting factor for all of your lines, and you got to pick the line which is the most profitable that you can mass produce on scale. And so, like for Tesla, for example, Cybertruck took 4 years, partially because we went through a chip shortage for like a year and a half, 2 years, right? And so for them, it was like, well, why should we focus right now to rush to get a new product out the door when we are literally not making enough of our current products and have a wait list of, a year?
Right.
Yeah. I can see that.
So my point is, it's not about products or their announcements. Like, would you rather them make an announcement today and then only start producing those cars 4 years from now, and then only have that be materially impactful from a financial perspective 6 years from now?
Right.
Like, what's the point? Just to get a short-term pop on the announcement?
I think what is going to help them short term though is that credit. I think is going to come off the price of the car, the tax credit, versus like you have to file your taxes to get that credit. I think that starts in 2024 because I feel like that's more tangible in the consumer's mind. Like, hey, I could legitimately see this savings right now. And then I just found out that I don't even qualify for that tax credit. Dude, I was pissed off about it. I didn't know that that had income restraints.
So the funny part, TJ, is that Cybertruck is over 6,000 pounds. So there's a ton of people that are going to be
there's another tax write-off that's
yeah, exactly.
Dude, even the Model X though, even the Model X qualifies for that. I forget what that tax rule is.
Does it really? Okay.
Yeah, the Model X qualifies as well, which is really, really cool.
What was I going to say? Yeah, another one, not to deviate because I know you guys talk about Tesla, but another one that I'm looking at a lot is Rocket Lab, and I know that's probably going to be pretty volatile, so it might not help you in this vicinity.
No, but let's look at my, because dude, I've made changes over the last year. So like here, let me just read off. So like Amazon's 1,200 shares, Enphase is 11,000. So this is where I'm going to get a lot of the capital because I'm going to scale back the Enphase from 11,000 to 5,000, which is all I ever wanted. I just got caught with my hand in the cookie jar. Then Google's at 1,000. I want to double both the Amazon and the Google positions. Obviously, if I can get a decent entry point. I picked up one that I really don't believe in as a company. I just couldn't say no at these levels. And that I recently took on 5,000 shares of Pfizer. And it's hard for me because I cannot stand big pharma. Like just fundamentally, I feel like they're like the biggest drug pushers. Like they make Pablo Escobar look like a corner boy. You know what I mean? Like it's just like I just have issues with the company in general, but they also do some good, because they put out some medications that
is prolong. Pfizer like at 2012 levels?
I think they might be at 98 levels, I believe, dude. It's like really bad. And I just feel like right now my average is at 28.75. I just don't see a world where that loses money long term. The dividend's pretty decent too on Pfizer, so that part's good. And then the premium's not great, but it's okay. And then again, at these levels, and then I'm willing to go as deep as 15,000 shares with Pfizer. So if it were to go to like $20, I would like load the boat there. And you just got to be willing to be wrong. In order to be right, you got to be willing to be wrong. That's just the reality of investing. My biggest regret in the portfolio, guys, is Palantir. I can't believe I just didn't like truly load the boat, because that was probably the one company aside from SoFi, because I'm just a big proponent of Anthony Noto, dude, I was just so sure on the research that I did off camera on my own at 1, 2, 3 in the morning, because this is when I do all my work at these hours. You know, you want to hunt when nobody else is hunting, so you can grab what they're never going to get, right? I was just so sure on Palantir, dude. Like I just saw Alex Karp and his passion and learning who Peter Thiel was and all of that stuff and what they were doing and trying to understand what they were trying to accomplish as a company. I was like, and then their balance sheet was, I mean, these are the things that you can teach a class on. Like, I mean, you can teach a class at the university. Like, if you're going to start a company, let's have a balance sheet like Palantir. It pisses me off that that's not at least 25,000 shares. And then the other one, I feel like my best entry point and discipline out of any company here is I've been following PayPal for 2 years, and I recently just took on a position, and I have a cost basis of 56.76 on 5,000 shares. Like that's my maturation as an investor, because the old TJ would probably have those 5,000 shares at probably like 125, because I thought PayPal was a damn good deal at 125, but I was like, I'm gonna wait for some sort of like I wanted to like really, really go sideways. I want him to take on a new CEO because I wasn't a fan of the other guy, like just me personally. And then when all those things started happening, and then I heard the last conference call, I was like, dude, this guy he's our Noto. Like he's the guy that I think is really going to steer the ship in the right direction. But keep in mind, it's a really fucking big boat. So it's going to take a little while. Like PayPal's not, I mean, it's not the size of Apple or anything, but it's not a small company. But the fact that they are buying a bunch of shares at these levels, it's kind of like what you were talking about Apple earlier, Matt. That's like a surefire way for them to return money to an investor, to a shareholder. Is, hey, we'll just buy back the float. I was like, sign me up for that, for hopefully to the tune of like 10,000 shares eventually. And I've got a bunch of open. I just had my wife do this yesterday. If you guys look at row 48, my wife did this for me because I was at the hospital. We have a $290,000 cash secured put on PayPal right now. Let's see if I can pull it up right here. Here we go. So she wrote 50 contracts at $58, expiring on 12/29. And I'm not rolling, bro. If we get assigned those shares, I'm going to take on those shares and just start selling covered calls on them, because I just what's that? Was that asymmetrical? Is that is that the right word? Am I using the right word where it's like I feel like the scales are tilted in my favor. Like I feel like the chances of it going up are a lot higher than the chances of it going down, or the floor is like, it's like the stock is here and I feel like the floor is here, but the ceiling's like way up there. So it's kind of headed in my favor, I feel. And even if I'm underwater a little bit for a while, I'm okay with it, because I have a 3 to 5 year legitimate time horizon on PayPal. So I want y'all to grade that trade. How did I do? Was I paid? Because I feel like I was really patient. And we're sitting on the 5,000 shares. The current share price is 61 according to this thing. Our cost basis is 56. The adjusted cost basis is taking into account all the premium, and that's at 52.23. We have the open call contracts that are sitting at trying to find it here at $65 for January of 2024. So we're in decent shape there. And then we have the open cash secured put. So what I'm showing you guys is a covered combination strangle where you'll have shares and you'll sell covered calls, but you're also selling simultaneously cash secured puts. So you're guaranteed to win one side of that bet. And if you're okay with any possible outcome, then it's a win-win situation for you.
Yep. Man, I mean, you're basically selling strangles at that point, right? I mean, you're hoping that it just stays kind of within that boat and you can just continue
in a perfect world, I wanted to trickle a little bit lower because then my covered calls are like out of harm's way. And then I can always manage the cash secured put. And if I can grab those 5,000 shares at say 57 instead of 58, well, that's a much better entry point long term, because that's going to match my original cost basis. Because here, if I go here, it shows you where I acquired all the shares. Like on 10/3, I got 1,000 shares at 57.52. I bought them outright. On 10/4, I got another 1,000 shares at 57.86. On 10/6, I got another 1,000 shares at 57.81. And then on 11/3, I got 2,000 shares at 55.30. So they've all been in that general area. So it took me a month to accumulate those shares, but it's been I've been in this trade over a couple of months now, so I'm feeling more comfortable with it. And the earnings are coming up. They're going to be coming up again here in the next 4 to 6 weeks, right? So this is going to be another full quarter of what's his name, Chris? Is that the CEO's name? Real confident guy, borderline cocky. And I really took a liking to him. And then I read about his track record and what he was doing at Intuit. And the reason, guys, I know it's silly again, but it's all superstition shit for me. But my very first investment in the stock market was Intuit. So it just seemed like the stars kind of all aligned. And then I just became a bigger fan of PayPal that day when I started reading that this dude was really instrumental in the success that Intuit had and the stuff that he was doing. So I'm just a big fan of the guy, man. I'm telling you, I feel like he's the Anthony Noto for this company. He's the right guy for the job. And I can't see anybody else doing what this guy's going to do with PayPal. So I'm just super stoked about it, man. And I'm hoping we get put these shares. And I don't say that a lot because I think being in cash and knowing how to sell cash secured puts is the best position you can be in. But when you're absolutely sure of a company that will double in the next 3 to 5 years, which I feel from these levels PayPal will, not just market capitalized, but share price because they're buying back the float. Sign me up. I want those shares. I want those shares. So objectively, Tevis, because I know you've covered PayPal somewhere. Are you in PayPal or have you considered it or where are you at with PayPal? Because I know Tanner's a big fan of PayPal.
Yeah, I just have leaps on PayPal. I don't have shares. I have 2025 leaps.
So what do you think about that entry point, though? Pretty good considering YouTubers have been pumping this shit for the last couple of years when it was north of 200.
Yeah, no, I think it's great. I think anything that, I don't know, I might eat my words on this, but anything before the FOMC meeting was pretty much that bottom or the last chance before that market rebound. I mean, the market could turn around or something, black swan-y could happen, but more cash is going to flood into the markets by and large out of treasuries into equities. And as a result of that, you're just going to form higher lows for all of these names. And so if PayPal bottomed out at 52 or 50, let's say, and you bought it at 52, then you nailed it.
All right. I didn't do that. I got it at 55. I've never, has anybody ever really claimed to buy the bottom, bro? If I've ever bought the bottom on a stock, I promise you it was an absolute accident.
Yeah, me too. 100%.
I don't even try, bro. I tell people, if I was good, if I was really good at what I do, I would just buy calls.
Speaking of, actually, so today, I mean, technically, I guess it's December 18th because it's past midnight, but on Tuesday, it'll be December 19th. And I have a tweet already scheduled to go out in the morning. Basically, on December 19th of last year was when Anthony Noto loaded the boat on SoFi. His buy price was 4.6.
Good for him.
Which was the exact, almost the exact bottom.
Yeah.
Basically. So a lot can change in a year, man.
Yeah. Oh, just look at Palantir. Isn't Palantir up some 170% or something crazy, Matt?
Something. Yeah, something like that.
What do you think
it's
about
the
Palantir, bro? We're just between us girls.
Yeah.
Forget about the however many people you have on the stream. What do you think about the valuation right here, right now on Palantir? Am I the only one that thinks it's a little bit rich? But I can see why it's valued where it's at because I feel like I know where it's going. But I'm just talking about I feel like if I buy more shares right now, I just feel like I overpaid. But then it's just the going rate. It's you're going to these fancy, stupid stores to buy purses for your woman, and you're getting ripped off. But that's just what the Louis Vuittons go for, right? What are you going to do?
Yeah. I mean, I think Palantir will be one of those companies that always trades at a premier valuation because of the industry that it's in and because of kind of the multitude of industry that it spans across. Is it software? Is it defense? Is it AI? Is it tech? So I think with respect to that, you probably wouldn't be too bad to sell maybe on a quarterly basis, like 30% below whatever you think is the too high price. Because if it depending on where you think it's going to go, like I wouldn't mind selling puts here at $12, right? And obviously, you know, you're not going to get much premium, but say it does kind of pull back and, you know, you eventually get the opportunity to buy it at $12. It's like, well, you're not going to pass that up. So I think it all just depends on, you know, really where you think it's going to go long term. But I think people understand that this isn't just another company in a very saturated industry. I think people are starting to recognize that this is a company that is going to be able to differentiate itself, and it's not just another cloud provider, right? It's not somebody that's just helping connect points and data flows from point A to point B. It's somebody that's legitimately trying to build you a customizable operating system for your business, which is very different than what Snowflake and Fabric and a lot of these other companies are trying to claim that they do, but they can't. And so I think in the medium term, other companies will do really well. I think Fabric will pick up. I think Snowflake will continue to do well. But I think in the long term, a lot of those customers that think that they got a good deal by signing up with Snowflake and signing up with Fabric will realize that they only solved half the problem. They solved the data flow problem, which I think everyone is experiencing right now with the continued increase in Internet of Things, and everything is digitalized and on the internet and on Wi-Fi right now, delivering all this data. But I don't think people are appropriately categorizing that data to a place where it's actually meaningful to understand the relationships and what it actually means. And so when you set up all these pivot tables and crap and Microsoft Fabric, it's pretty much meaningless unless you have the right kind of language for your data to speak to itself. I mean, unless you have very competent data analysts or you know, data engineers, it's going to be very difficult for the data to be utilized appropriately. Otherwise, it's just going to be hundreds, if not thousands, of lines of data that's just completely useless. And so it's important to kind of set up this architecture and way to cycle your data into your organization, to which you can operate off of a very prudent and meaningful way. And that's what I've observed at, you know, where I work. You know, I think it's something that I think a lot of other companies will leave to be desired. So for that respect, I think it's always going to be like that. I think it's always going to be priced similar to Tesla. I think at this point, now that it's profitable, it's never going to be a company that trades at a cheap valuation,
Right.
because now it's making money. But I still think that we have a ways to go in terms of where its long-term valuation will be. I still think it'll be $150 to $200 billion company. And so will they start buying back stock in 2 to 3 years? You know, all these certain things that are kind of still up in the air, as they have no debt, as you are well aware of, and they're going to continue to generate a crap ton of capital every single month. So anyway, food for thought.
What are you familiar with Enphase at all, Matt? I know you are, Tevis, because of Stock Tank.
I did some deep diving on Enphase.
Have you ever gotten caught with your hand in the cookie jar the way that I did with Enphase? I mean, dude, I was down $750,000 on this stock, and I could not believe that I was just was legit able to just keep my composure. And there's something to be said for investing in a real company. Like being down in a real company that's generating millions of dollars feels different than fucking ChargePoint or something tanking. Yeah, dude, this company's got less than a year of runway. How am I going to really manufacture this win? Whereas with Enphase, I'm like, dude, I feel like the market overreacted on both sides. I don't think it ever deserved 330 or 40 bucks a share, but I also don't really think it deserved 70 bucks a share either.
Yeah.
But I think that's what the market does, right? It's real crazy in both directions.
Yeah. Well, before I answer that, shout out to the 81 people that are still hanging out this late at night, listening to us chat. But I've never been caught in terms of magnitude and that big of doo-doo, I would say. But I mean, there's been like Palantir for a while. My cost basis was in the 13s, and now it's down to the 12s. And you know, a lot of that was through buying throughout that time period that was allotted to me. So at some points, I was down over 50%.
Yeah.
But I think it's just knowing the long-term potential. And same thing with Rocket Lab. Like Rocket Lab was in the 3s at one point, and in my one account, I think the cost basis that I have for that's like $8.50, and the other, I think it was in the 6s until more recently when I added more, and now I think it's into the low 5s. But you know, so with anything, I think that sometimes you need to just be cautious and buy over time, and if you truly think it is the way it is. But to me, you know, I can understand the why Enphase was mooning like it may have been. But when everyone was talking about it and you know, everyone started to catch on, hey, this is a good stock, and it was probably overrun at this point. At that point, there was 3 quarters of back-to-back revenue flattening. And for me, I was like, I don't foresee this with the environment that we're in continuing at the pace at which it was. It was trading at like a price to earnings of like 22 or something like that. And I was like, I would personally wait until revenue gets kickstarted again before I put my hand back in. And so that was like in the June, July timeframe. I'm not saying I'm a wizard or anything like that, but it's just like you were looking at a company that everyone was evaluating as revenue will keep going up and up and up. And here you are seeing an environment where it's now flat.
Right.
That means that you have to have some sort of large retracement. And it already had a pretty large retracement, but my fear is like the environment was still kind of iffy. You know, oil prices were coming down. So that means, generally speaking, when oil prices are coming down, that, you know, renewables are going to have an outflow. You know, all those things kind of came to fruition. And it got to the point at the end of October where the opposite has kind of happened now, where it's like you've kind of hit a bottom-ish in oil, and hopefully since that point, renewables is going to start to see an upswing, which Enphase has seen, Ørsted, which is in my portfolio, and NextEra has all seen. So I think it all just depends. I mean, if they're able to sustain revenue growth and get back to a good fiscal year 24, I think they'll find their footing. I would still stay away from the stock personally, because I don't necessarily know, as a contractor and somebody that needs to continuously sell things to make money, if that is where I would want to be. Very dependent on regulatory environments and stuff of the like. I'd much rather, from a renewable standpoint, own the people that are providing the energy to the end consumer. That's where I lean more towards like an Ørsted and NextEra. And I might not make as much money, but I can at least guarantee that I'm making the money. So people aren't going to stop needing energy unless there's some sort of nuclear war that stops. And so I'd much rather own the number one utility provider of energy, specifically renewable energy, but just energy overall in the United States, which is NextEra. So, you know, and then I would also like to own the number one offshore wind provider, which is Ørsted. So to me, you know, that's just where I kind of lean. And then also looking at LNG and energy, you know, I think that there's a huge opportunity in arbitrage from buying natural gas in the United States, where it's extremely cheap at $3 an MCF, $2 an MCF, and selling that to people in Europe and Japan for north of $10 per MCF. And I think that there's a huge arbitrage opportunity, and will continue to be until there's more and more LNG coming online, which there will be, but I still think that there's a huge opportunity for that, which is why I think stocks like Next and a lot of other companies will continue to do well, and LNG overall will continue to do well. So Shell, Total, Qatar Energy, all those guys will continue to do extremely well because of LNG and the opportunities associated with that. But so when everyone was talking about Enphase, it didn't ring the bell for me. Just like the same thing with PayPal, something about it just doesn't ring the bell for me. And it's not to say that I, am bearish on both opportunities. I think it's just I'm more of a believer that just because everybody's looking at a stock and hopping into a stock doesn't mean that I have to as well. I have my positions that I have a lot of conviction in. Just like I don't expect everyone to jump into NextEra. I don't expect everyone to jump into Orsted, but I'm up, 15, 20% on those opportunities in the last month or two. So, I don't expect people to follow me into those. That's my thesis. And, I see it and I look at it, and I'm also looking for, because I work in the oil and gas industry and just energy providing as in general, I'm looking for what does my future look like as somebody that provides energy to the people, somebody that's passionate about providing that opportunity of being able to heat their homes, drive their cars and everything on a day-to-day basis. Today, that means oil and gas. In 20 years time, that's probably going to be solar cells and wind, bright things and windy things, and also cells, energy cells that provide that opportunity. So I'm looking for, well, everyone might be looking for oil and gas M&A. I'm looking for who's going to be the Saudi Aramco of renewable energies. And is that going to be nuclear? Is that going to be things that are bright? Is that going to be things that are windy? I'm curious, and that's where my head is going. And I think in the meantime, LNG is a good play. But I don't know. To me, that Enphase thing, it seems too shiny. It seems too polished, and I think that for some reason,
I'll tell you what the wife wants. Once we're even, it's going to be like really even. I'm not talking about adjusted cost basis. I'm talking about we don't own shares over 150. She wants to divest half, and she wants to put that money into Tesla, because then we're going to go from something that can be versus in our minds something that will be. And it's going to have the same volatility. It's going to have similar volatility. So the premiums are going to be just as juicy. But it's just there's something about the conviction levels. Like I'd say Enphase is because I don't know enough about it. I mean, I've been in Tesla for years off and on, So I feel like I've just had more exposure and confidence in Tesla. So I feel like my conviction level in Tesla is like an 8 to a 9. But in an Enphase, I'm only like at a 4 to 5 right now because I did the homework. I had Steve come on the channel, do a valuation model on Enphase for me. And dude, I was convinced that if I could get this thing in the 130s, which is roughly where I'm at, that's a hell of a deal. And then boom, dude, Mr. Market was like, no, bro. Like you're getting an F on this research report. You know what I mean? And I was just like, dude, it was very humbling because I was like, dude, if I can get these shares at 130, I just don't see how I'm going to lose money. And when my investment thesis starts saying that in my mind, like I don't see how I'm going to lose money, sometimes that's when the biggest losses happen for me.
But what did Steve say? Did he say buy it in the 130s or what?
No, he just liked the valuation because it is growing. I mean, dude, Enphase is growing. It's not growing the way that it was a couple of years ago because they've obviously run into headwinds, and then they over manufactured, right? Like because their bottleneck is the contractor has to buy their product, but then now the contractor's sitting on all this product that they haven't sold, then. Enphase is like, okay, how much are we going to keep manufacturing? So I feel like there's always that. This
is the problem that I think most people, and hopefully you learn from this, is that energy is very, very cyclical.
Yeah.
And so 2021, 2022 was a very outlierish year. And you can see that in many avenues. You can see that in the earnings from a lot of different renewables companies where they were able to charge out the butt for the dollar per kilowatt hour from a variable rate perspective. You can see that from all the LNG players when they were able to sell things for 30, 50, 60 euros per, million therm that they're selling to, or decatherm that they're selling to everybody. Now when things come back to reality, things shrink pretty quick. Year over year growth rates look awful, but if you look at it on a 5-year basis, it's still probably in a pretty good growth rate. It's the same exact thing happened with, if you were to look at like a lot of these internet companies like Pinterest and Amazon and all these other companies that benefited from the pandemic. It's almost very similar, right? And so you have to think, some of these stocks, they see their day, they see their opportunity, they see their cycle, and they moon up and then they retrace. They moon up. It's just a lot of it's cyclical sometimes. And so I think, unfortunately, sometimes people just get caught in the trap of, oh, it's gone up, there's no way it's going to stop. This growth rate's going to continue. And reality sets in. People have to go back to work, and unfortunately, people aren't doing their 9 to 5 and it's their side hustles using Pinterest and selling things on there anymore. They have to go back into the office 3 out of 5 days a week, and unfortunately, they can't keep up that business, right? So Shopify gets impacted, Pinterest gets, Etsy gets impacted, all these guys. And it's the same thing with the oil and gas industry. Is like, there was or just energy industry in total, there was a massive conflict where a lot of energy gets brought out and depended upon Russia into Europe, and that was disrupted. And that's why oil prices went to the moon. That's why gas prices went to the moon. And so you saw a lot of push for people doing renewables, I assume, during that time period, because one, ESG was a thing. So there was that push from BlackRock, State Street, and many others. And then two, just the cost of normal fossil fuels was awful. So people were saying, let's move as much as we can. And so once it got to the point where you're in a deflationary mode for oil and gas, and things are going on the downtrend instead of the uptrend, people go back to what they're used to and what's easier and what's cheaper. So
right. I think the one thing that I learned about solar that I was unclear on when I was selling all these cash secured puts and just making money hand over fist before I got caught was, dude, the sales cycle was so slow, dude, to buy a solar system. And then the education that a customer doesn't have and that needs to acquire, like the lack of awareness on how the money checks out, like whether or not the math works in their mind. I was like, dude, this is snail speed, because it's a 30, 40, 50, it could be $100,000 investment. And you're going to sell them this notion that eventually their electricity is going to be free. But then the policymakers can move the goalposts. Mm-hmm. Like I was watching the football game today, and this guy missed a couple of field goals that cost me $300. Fucker. The one from the Jaguars, because I needed the money for the points for the over. But I'm just saying, imagine if the NFL moved the goalposts, these NFL kickers would miss with a higher frequency. And it's like, oh, well, now you're not going to be able to use all of these credits and so on and so forth. So like, you were banking on paying all of this money for your solar system because that was going to offset your energy bill or your electricity bill. And then they move the goalpost on you. Now you're screwed a little bit. And it scares me a little bit, because there could be a lot of people that could potentially get in a bind if they're using that electricity money to buy the solar system, but then it doesn't end up working out that way. Well, now what are they going to do? Because they've just taken on a lot more debt than maybe they can handle. And the cycle is just so slow for them to make that decision on $30,000, $40,000, $50,000. And then the clip at an American moves like every 7 years, like they're not in that home that long. And it takes about, 5 to 10 years to pay off your solar system. Because we looked at a house in San Antonio recently, but it was tied to a lease contract on solar. And we're like, dude, we started going through the paper. Dude, it was just a shit show. And I was like, dude, so there's like a lot of other little intricate details tied with solar as well that maybe a lot of people don't know or talk about. And then the other thing that I couldn't find in the San Antonio market specifically is it doesn't add any value to your home. Like it adds absolutely zero value to your home. It's almost like a swimming pool. In fact, it kind of like takes value away to a certain degree because they're like, what kind of damage did it do to the roof? What am I going to have to do when I have to replace the roof, etc. So it's like that part of the thesis is not intact, at least not in the San Antonio, Texas market. Because like the two realtors that I'm dealing with are like, okay, bro, we're going to definitely look for homes that have no solar on the roof because this shit is just way complicated. So they're like just trying to avoid it like the plague. Like, this is crazy to me because I thought this was an added benefit for the home, you know, like you're buying a smart home or something like that. But that part hasn't really happened yet. So yeah, I learned a lot on that end phase trade. And I also learned that Warren Buffett's right. The number one thing that you need to be a successful investor is you need the temperament. Like if you're not prepared for the stock to go down 50%, you probably shouldn't be investing in individual stocks. Because that's happened to me a handful of times now, dude. And I'm not saying it gets easier to deal with, but I'm able to deal with it a lot easier. But it's also easier when you're dealing with a real company, because that is one thing that I will give end phase is I feel like, dude, well, they may be a lot of things, but they're also profitable and they are making money. You know, like that is one thing that they got you know, a bunch of patents and shit on their microinverters. Their technology is pretty damn good. So that part is really, really exciting for me. So we'll see. But anyway, what do y'all think about that move though? Tevis, I think you're going to be a fan of taking the, you know, 50% of those monies from Enphase and sliding them over to Tesla. And we don't even care what the price is, or we'll sell some really aggressive cash secure puts until we get caught with Tesla, just to have like a little bit more of a margin of safety.
I mean, we talked about this in the past around the ecosystem that Tesla can provide in the future with regards to home and car, where they can just bundle it together and then have that be a cycle. I just think that also from an execution perspective, like I have more confidence in Tesla's ability to execute than most other companies out there, simply because just Elon's like a crack addict for business.
Yeah. Agreed, man. Well, dude, I gotta catch some Z's because the market gets here early, and then I gotta get my little live in the morning and act like I want to be there and know what I'm gonna do. No, I mean, it's easy. The portfolio update's easy because you're just telling what I did, right?
Right.
But I gotta find something, and that's the pressure that I have as like a money manager is they ain't paying me to leave money on the sidelines, you know. Like they can do that all on their own. So it's just like, okay, that's what another thing that's been tough. It's like, because, you know, I get like, oh, like I get in this groove with like a PayPal at certain levels and get real comfortable, but then all of a sudden there's a 10%, 15% drop in a day, and now like, holy shit, now I'm managing a big ass trade that went against me. So it's better to be diversified. And I've been playing Google at like the 128 level. That's really been going well for me. This is going on like 3 or 4 cycles now. And Google's been real good to me at those levels, and haven't gotten any more shares though. But the premiums are surprisingly pretty good on Google too, dude. I don't know if y'all have ever sold puts or looked at the premiums on Google, dude. Like Google's a mover and a shaker, and it's a free cash flow machine.
I know when it dropped after 3Q earnings, I sold 110 or 115 put, and because it got down to like 115 and on the cycle up, and I bought it back once it hit like 60% profit. But no, I haven't persisted on that. But it's opportunities
Are you not into those debit spreads? I know that Chris has been getting a lot of people on those Google debit spreads, like the 150, 175 or something like that.
No, I mean, maybe if it does another big dip or something like that, I wouldn't mind selling. I prefer to just own shares and write my covered calls and something I can, you know, I think the one thing that I always am concerned about is like now that I've gotten to a place where I've gotten to a substantial amount of money, that it's not enough for me, but it's a lot and probably a life changer for probably my sisters if I were to ever get like hit by a truck. But something that's a little bit easier to just liquidate and move into something, because for me, I also recognize that things move up in big cycles where it's like Google will probably stay stagnant here for a little bit, and the next thing you know, it's going to run up to $160 a share. And so for me, like trying to time it and sell these things is kind of difficult. So when I see my opportunity, I jump, right? When I see Google or Amazon at $80, I'm like, well, that doesn't make a lot of sense. But when they're kind of hanging out here, they could easily go either way, depending on how the macroeconomic environment looks like.
Right.
And so I think that Google will go up, but I also could see a world where it takes another 5-10% down and gives me an opportunity to add more to my shares, because I'd like to get to 400 shares. I know it's not TJ money, but it's a lot of money for me.
That's a lot of shares, bro.
So,
are you guys? Do you guys subscribe to that narrative that mega caps are just going to underperform small caps in 2024?
I think some of them will, but not like I mean, Google prints money, bro. Like they print more money than the Fed, and I think Amazon.
Yeah, but the thing is,
it's so hard for me to see the bear case in Amazon anymore.
Yeah, the reason why I subscribe to it, or just to present the counter argument, is that 2022 and 2023, where have the hideouts been? Mega cap has been a huge hideout place, and small caps and mid caps have been getting crushed. And so there's value there, right? Like if you pick up, I don't know, like a SoFi at $7 or $6, you can make a very easy case as to why it should double, right? And so it's the same argument that says, well, if money's going to flow out of money markets and treasuries and go into equities, it would stand to reason that money would flow out of mega caps and flow into small caps, because they've been hiding out in mega caps in the downturn. Small caps and mid caps are where that multiplies in the upturn.
I think definitely a portion of that, but as somebody who is a hedge fund manager, you have this customer that you have to answer to, and that's your investors. And if you don't have Apple in there, and if you don't have Google, and if you don't have, like the NVIDIAs of the world, the Magnificent Seven, if you don't have at least 3 or 4 of those companies in your portfolio, and your portfolio goes down like 20 or 30% for whatever reasons, you're losing customers and you're out of a job. So because of their job security, I'm talking about the people that manage these funds, that allocate these funds, because the majority of the funds in the market are managed by a few amount of people, right? Like that's the reality. They're not going to get out of Google and Apple because they're not going to lose their job to go fucking bet on SoFi.
I'm not
they'll
saying
move a portion of the monies, but what I'm saying is there's not going to be a major sell off of those companies. They may transfer some of those over, but I think that, what is there, like $6 trillion on the sidelines right now was the last I checked. I get a notification email that tells me how much money's on the side. I want to say it's like $6 trillion right now.
Yeah, it's around that range. Look, I'm not saying that mega caps.
I can see half of that money going into the small and mids. That's in the sidelines right now. I'm on that camp.
Well, even that, TJ, I think you're supporting the point that I'm trying to make, is that not that mega caps are going to fall, but they're just going to underperform small caps in general.
They're due, bro. If you look at the Russell is just underperformed the last couple of years, and it's due for a breakout. I'm in that camp. I want to say Tom Lee's probably in that camp.
Tom Lee came out and he said, like the Magnificent Seven is going to rise about 15-20%, something to that effect, but small caps he thinks is going to rise 50% in 2024, like as an index. Which is insane.
I'm in that camp, but I would like to have a caveat, and I'm going to say small to mid profitable caps, or on the verge of profitability like SoFi, which is, 3 or 4 weeks away from officially being GAAP profitable, God willing. Those companies I think will thrive, but zombie companies, bro, I think that market, we're no longer in that market. Like right now, like ChargePoint's borderline zombie company that I have invested in the past. I recently just made a lot of money on a swing trade, bought it at 185, sold it at 260. So that was nice. It was 10,000 shares, but it was fun just to make money on that damn company for once. But what I'm saying is the company that has less than a year of runway, bro, the Nicholas of the world, no, dude. We're not in that market. Like, we're not in that 2020 market where people got, well, I don't know what the stimulus check was because I didn't qualify. I'm still sour about all that shit. But whatever the stimmy check was, $1,000 or $2,000, whatever they give you, and all of that degenerate money in the market, and they're just looking to double that money and double it again and so on and so forth. Maybe, I just don't think we're in that market, and we probably won't be in that market for a very long time again. I think we're going to be risk on, but we're not risk rock on. We're risk. We're more rational. I think the market's a little bit more rational now and more aware and educated of what a valuation is, because valuations matter at the end of the day, like the Intelligent Investor says. So I'm in that camp, that small mid caps. That's going to be a real good play, but it's also going to be a stock picker's market, and so you're going to have to do your homework and find those companies that have been overly punished unnecessarily because they just happen to be in an index that has been underperforming.
For sure. Yeah. To dive deeper, I think Luke Francis in the chat hit it pretty perfectly. I think there's going to be several Magnificent Seven that are overvalued. I would say Apple, I would say potentially Microsoft from a price to earnings perspective. It's not to say that they're not going to grow, but I don't think that they warrant a 32 or a 38 price to earnings for Apple and Microsoft respectively. Whereas you have a Google that's continuing to buy back shares aggressively and also grow their EPS at a double-digit pace. And so that should be valued more at like a 25-ish earnings, price to earnings. And I just don't see that it is at the moment. So I think that you have this opportunity for several companies to kind of come up in the Magnificent Seven and grow faster, some to kind of lag behind, which drags it to what Tom is talking about, which is that 15, 20%. And so maybe 10, 15%, whatever you say. But I think that there's outsized returns in doing due diligence on companies that will gain profitability or have already gained profitability. I think SoFi will benefit from this. I think companies like Dutch Bros will benefit from this.
Agreed.
Companies that have been hit massively by the fact that they have debt on the balance sheet. So, there's some companies that are coming off of, at the end of 2022, 80% declines from the peaks in November 2021 to the end of 2022, and have only seen slight increases in their profitability. You look at a lot of these things, like you mentioned pins earlier, Tevis, and you start to see a lot of those things after like the year end 2022 have just been kind of like flat to the point where now they're starting to hit that inflection point of, hey, things are going to start getting cheaper again. From a debt perspective, we're not going to be sitting here afraid out of our minds. People are actually going to start spending money again. And here we go. Right. So, but I think, like you said, TJ, as well, you really have to be selective about which ones.
Yeah, man, we've got to make sure they're not a zombie company, guys. We're gonna have to learn how to read cash flow statements, income statements, and balance sheets. I just think we're gonna have to do that tedious homework, because they're gonna need enough money so that the investment thesis can play out one way or another, without just continuing to dilute, because retail investors are getting more hip to the game. And who's already hip to the game? The institutional investors. Because there's some institutional investors, dude, that will not touch a company if over the last 10 years the float's bigger than it was before. Like, that's like the number one X for them. Like, they were looking for companies that have less shares, because that's just the easiest way to return equity to an investor, to a shareholder is reduce the float. Like minimize the pieces of pizza. Don't have the same size of pizza and just keep cutting it, because then it's just not filling for anybody. And once people can understand that concept, that dilution is a very evil monster in the stock market. You can't have companies that are relying on dilution to stay afloat. They're going to need to already have diluted. So you want to get in after the fact. That's why Tesla over the last couple of years has become a much more attractive investment, is because their levels of dilution aren't nearly as harsh as they used to be as well. Like, a lot of people don't talk about that with like companies like Tesla. And then there's also like the other thing that I look at is I want a company that doesn't have like super massive share-based compensation as well, because it's just like, man, like leave some for us too. Like, I get it that these guys are growing the company, so they need something. So I agree that there's definitely something with these small and mid caps, but I also think it's a harder investment, guys, because I feel like an unprofitable company is a lot harder to value than one that is profitable already, for me anyway. Because I use things like price to sales, and I compare them to other. It's like comparing a house, right? Like I look at what's somebody else going for in price to sales, and when are they looking to be profitable, what's their burn rate, and all this other stuff. And it's just other metrics that I don't normally look at as much on the Googles of the world, because it doesn't really pertain to them. So you're having to look at these balance sheets and income statements and cash flow statements with a different set of eyes. So you have to train yourself to value the NEOs of the world. Because I sell cash secured puts hand over fist on NEO, and bro, it's a hell of a lot easier to sell cash secured put on Tesla. Similar company as far as what they do, but holy shit, man, it's very, very hard to value NEO in comparison to Tesla. So it's exciting because you can double your money in your mind, because a lot of these companies might be undervalued, but dude, a lot of these companies, dude, they're trading down at those levels because they're pretty shitty companies by several metrics as well, so I think we have to keep everything in context. What do you think? What do you think, Tevis? Because you've been covering a company that for a couple of years now in SoFi Weekly that isn't a profitable company, and it is a little bit more enigmatic dealing with these companies than it is, because you got to be a visionary dealing with these companies versus one that's more cut and dry, like a Google, so to speak.
I think the frustrating part around it is that I've found over the past couple of years covering SoFi, retail definitely invests in the prospects of the business, whereas analysts invest in the reality of the business.
Right.
Analysts will judge the stock by how much it makes today, less so around profitability being around the corner. They don't give it the benefit of the doubt the same way that retail does. And as a result of that, you get into this avenue of, having possible manipulation, having all of these short attacks, having all of this shady shit happening. And then all of a sudden, they deliver on exactly what they've been saying they're going to deliver on and go into the black. And then all of a sudden you're having all these funds go in and all of these analysts, praising this company. And it seems as though, the company turned a new leaf, when in reality, this was something that they were chugging along. And, it's like that thing where, you can't drink until you're 21. But it's just like, what if I'm one day until my birthday? No, you can't do it. And then you turn 21, they're like, go get hammered, So that's similar to how I see it with these analysts. It's so, absolutist. Like, hey, on this day that you have to achieve profitability, we need you to tick this box before we can actually start investing money. And I get why that is, because they're dealing with large ETFs that are, pension funds and all of these other sort of restrictions around what they can and cannot invest in. That's just the reality of what it is. But that's also where retail has alpha over these analysts, because like you said, TJ, right? Like, if Apple has a really shitty year, everybody blames Apple. But if you're a fund manager and you invest in SoFi, and God forbid SoFi has a shitty year, everybody's going to blame you.
Facts, man. It's already happened. It's already happened, dude, and it is tough to go into those meetings. Let me tell you. At my level, I can't imagine. These companies that have, fucking, $500 million worth of SoFi, and they got to explain 30 or 40% down in the last couple of months. What do you think, Matt? Do you find it more difficult to try to pick stocks like Rocket Labs versus, staying in your wheelhouse with these divvy stocks?
I mean, I don't really, with respect to what, right? I mean, are you talking about?
No, I'm just saying, like, to where you're comfortable putting a number on them, because at the end of the day, that's what we're all doing whenever we buy shares of a company, is we're saying, hey, this is what I'm willing to own a portion of this company at, right?
Mm-hmm.
And I find it more difficult for myself to put that number on an unprofitable company versus one that's already profitable, because I feel like the comps, it's so much easier to find a comp on a profitable company than an unprofitable company for me. This is just my own journey, right? My own hiccups.
But if that's the case, I mean, I played that game for a while, and it kind of got me to the point where it's just like, well, unless I'm going to be eyeing like a hawk and swing trading, which has its benefits as well, it doesn't make sense for me to be investing in those companies, because over the course of 5 to 10 years, there's going to be the peaks and troughs of it anyway, right? There's going to be the inflows and outflows. You can get in when a stock is kind of seems out of favor by, say, 15, 20%, wait for the rebound, kind of like what's going on at PayPal right now, right? Like, it seems like there's an opportunity to kind of get in there, swing trade it for 20, 30% profit, then sell out and then put that money into. But to me, it's like, if that's the case, I would rather just park the majority of that money in the SPY, let that go with the ebbs and flows of the macroeconomic environment, and focus my time, rather than continuing to try to focus on, let's just say, 10 different positions. I'd rather focus on 5 different positions, 4 or 5 different positions that I think could have excess returns. And I don't necessarily care if it does it because I'm not managing money for people, right? So I don't have to answer to a annualized rate of return. I can wait something out for, say, 2 to 3 years, as long as I still see the thesis playing out, that I'm okay with. Now, the thing that it's gotten me in trouble in the past is I can start justifying something because I have 30 grand in it. Right. Because I'm like, I trust the CEO, or, they're coming up with this revenue stream, but in reality, the stock is nosediving for a reason, and you're kind of investing in a falling knife. So I've been in their situation as well, where you're like, justifying it because you think in the long term it's going to continue to outperform or something of the like. So for me, I'm a little bit more diligent about understanding if the company is actually headed in the right direction. Are they hitting the milestones that they're talking about? Are they innovating? Are they continuing to be visionary? Are they actually somebody that is, providing or dominating in their industry? That is part of the reason why I don't have a large investment in SoFi, right? Like, it's not that I dislike SoFi. It's just I don't see the large outsized, I could see if you bought in at $4 or $5, the opportunity set there. But I don't foresee SoFi taking over as number one bank in an industry, right? Mm-hmm. And so I see there's an opportunity set there, and I'm not saying that I don't think anyone should invest in SoFi. It's just, for my particular opportunity set, I would rather choose something like a Rocket Lab that will be the dominant player in majority of launches, or the number 2 player in a majority of launches in an extremely massively growing total addressable market. Or a number 1 AI player like Palantir that creates something of its own sort of niche. And I'm not saying that SoFi is a bad company. Don't invest in it, right? I know the audience, and that's not a good look. But to me, I'd rather invest in the former than the latter, because I see a lot of competition, right? And so I'd like to focus and hyper-focus on the companies that I think there is at least enough of a moat or anything carved out that it can grow into, versus having to consistently fight against the competition. And I also like to look at companies, and SoFi actually fits this, companies that go from just before profitability
Right.
into profitability, because I think that there's a large swing that happens when that happens. Tesla, that happened for, a lot of other companies that happened for. And so SoFi right now, I think, is an extremely good opportunity if you're looking for something like that. Which is why I have a very small, debit spread for that, but I don't think it's going to make me trillions of dollars. It's just a little bit of fun money. But, to me, I try to get to a point where I have 80% of the portfolio on autopilot, and the other 20% is the thing that's trying to outsize my returns. And then the covered calls as well is generating a little bit of income for keeping me busy and stuff at the end of the night. But um, I recognize very early on that I'm not a very good stock picker. So that's why I've continued to move more and more to just invest in the S&P.
It's funny, Matt, because like a lot of the reasons that you listed for not investing heavier in SoFi are like the exact same reasons for me not investing heavier in Palantir.
Yeah.
And it depends on how you slice it, right? Like what story you tell yourself. But yeah, I get it. I mean, like keep in mind that, I mean, we talked about Celsius earlier on in the stream. Celsius is a bigger company right now than SoFi is. Like they're roughly the same, but Celsius is like 11 billion. SoFi is like what, 9.5, something like that. It's still, super early days. They're still executing well. And I think that a lot of people right now are discounting the tech aspect of SoFi. And then that'll become more evident in this upcoming year and, 2025 as well. That'll really give the company a hybrid valuation. So I think there's still a lot more alpha in SoFi than a lot of other names.
Agreed. I like to pull this up right here, Bound, if you could pull it up. I got Rocket Labs on alpha spreads. What can you tell me about their balance sheet decomposition? Because here they're showing 951 in assets and 365 in liabilities. They are showing 320 or 236 million in revenue, but they are burning a shitload of cash. Like, how long can this company hold on before things like? Because are we dealing with like a lot of I don't know much about the company. I've talked to you a little bit about it, but when I just see like all of this red, I just start thinking about companies that I've been in before, to where like I get in early and I ride them all the way down in some cases, right? And it's like, how long can this company hold on in its current situation until it needs more money, or is it just going to continue to dilute us? Because I'm assuming that there's a lot of dilution with Rocket Labs right now, because I've made a living with these types of companies. And you can't handle the volatility and the dilution and not get angry, because that's just what they have to do, because they're in survival mode until they hit their stride. Then it's going to be a rough 3 to 5 years until this investment thesis plays out for you. So what can you fill in those gaps for me, because I just don't know enough about them fundamentally.
Yeah, so I think overarching the thing that drags down Rocket Lab is the fact that it's in a very cost intensive industry, and so you're seeing a lot of other companies drop out of the race. So you're seeing companies like Astra run out of money and having to go private. You're seeing Velo 3D run out of money. You're seeing Virgin Orbit earlier this year go and literally declare bankruptcy. And you're seeing a lot of these other companies that were very bullish in the 2018-2019 timeframe, when this whole privatization of space comes around, start to drop out. The thing that has been beneficial for Rocket Lab is that it's not just a launch company anymore. It is a space systems company. It's also a small launch company, and they're also pioneering themselves, not pioneering, I guess isn't the right term, but establishing themselves as a medium launch company as well. So to get back to your actual question with respect to cash and cash burn, I 100% understand where you're coming from. I would say right now, the biggest reason for their cash burn And it's not to say their only reason for cash burn, but their biggest one is that they're trying to get their medium launch vehicle up into space. And so when you look at their cash burn over the past year and a half, they are burning about $30 million, sometimes more on a quarterly basis. That being said, it has been mostly associated with their medium launch vehicle, which is going to cost about $200 to $250 million to get onto the pad. And so by the end of next year, they hope to actually get that vehicle on the pad. But in the meantime, they have a profitable Electron rocket, which has launched into space 40 odd times. And they also have a pretty good space systems business that has allowed them to get, I'd say, gross margins in the order of 30 odd percent. And so while I understand the concern about cash burn, they still have $385 million of cash to kind of utilize, right? So they have the 288 that you see there in sort of cash and short term, and then they also have the other current assets that are kind of there, plus the receivables. So in terms of cash and equivalents on hands, it's about 385 at the end of the third quarter. And if they're burning about 30 odd million and shrinking on a quarterly basis per quarter, that gives them about, let's just say, even on a conservative basis, about say 10 quarters, or if you wanted to say 12 quarters, you could say that. Now, keeping in mind, a lot of that cash burn is the medium launch vehicle. And once that medium launch vehicle is actually in service, that's going to, one, skyrocket their revenues. And then two, they're not going to be spending $30 million a quarter, right? To build that rocket, probably the first time is, from scratch. You have to think the most cost intensive part of their business is actually the most cost intensive part of the business right now is establishing the molds and everything that they need to do to be able to make that a consistent, assembly line sort of opportunity. So when they finally do get all these contracts for the medium launch vehicle, they can get off the ground running and sell them at $50 million, $40 million a pop. And so what you're seeing right now, and if you kind of go back to the alpha spread, you can see it's getting to the point where within the next few quarters, they're going to start getting to a place where they're EBITDA break even, cash flow break even, not EBITDA break even, because they're already making EBITDA, but they're going to get to the point where they're going to be cash flow break even and be self-sustaining, so they don't have to go out to the market. And so for me, I see that as the light at the end of the tunnel. By the end of 2024, early 2025, if they're not already cash flowing, then, you might be sitting there scratching your head. But I think that there's light at the end of the tunnel for me, where they're going to continue.
Where does this 236 million come from? Who's their client? Who's their customer?
NASA, Capella Space, Black Sky. They just launched a satellite for the Japanese government. They're going to launch another for the South Korean
they get a contract,
government.
They put a rocket ship together and they send it to accomplish whatever mission. And
they also let me help. They also have a space systems business, which they also create satellites for people on behalf of people. If they can't create their own, they come up with the operating systems for those dashboards and whatever that they need for the space systems. They just collaborated with SpaceX and NASA to create the solar panels that is providing energy to their Psyche satellite that's going in between Mars and Jupiter to visit an asteroid there. So when you think this isn't just a launch company like SpaceX, and I'm not talking shit about SpaceX, I'm just giving some color, is when you think about this, these guys are providing avenues not only for the solar panels that go into space, which are 33% efficient and is thinner than human hairs to be able to power some of these satellites, as demonstrated in the SpaceX NASA mission, but they're also providing other the Photon satellites that they're creating, the small launch vehicle, the medium launch vehicle, and a lot of other different things as well. So that's where that revenue growth is going to continue going into the future that you're seeing there. And in 1Q of next year, they're planning on growing to about $100 million a quarter in terms of revenue. So that'll be a pretty big jump up because they've been generating about 60 to 70 million a quarter for the past 2 or 3 quarters.
Right.
So that's going to be a pretty substantial 50 to 60% increase to $100 million a quarter. They're the second most launched U.S. rocket ship. So think after SpaceX, who is it? It's Rocket Lab. So that's for like the third or something year in a row. So when you think about all these other companies, none of them launched a rocket, or very few of them launched a rocket in 2023. Rocket Lab has, and then they also did it in 2022. They did it in 2021. They did it in 2020. So in terms of cadence and a company that's actually established themselves in the industry, if you're looking for a company to invest in, it might not be SpaceX, but it's the close second behind. And who knows, they might be 5-6 years behind, and they might not necessarily be trying to go to Mars, but they are sending things to Venus, the moon, Mars, as well as to Jupiter, I guess, in this particular case.
And could this be an acquisition target for a SpaceX that I assume has a lot more capital behind them?
I really don't know. I mean, I don't think that I guess it all depends on.
Yeah, I don't know enough about SpaceX, and I live less than an hour away from where they do everything.
Yeah, I mean, I guess it all depends on who it controls the board, but I don't think the CEO would want to give it up. I think that he would want to be able to be the one that puts a lot of these things into motion. I think he's very competent. He's the one that started the company back in the early 2000s, late 2000s, and got to where it is today by bootstrapping his way here. And so, he's not Elon, but he is Peter Beck, and he has demonstrated that he can create a rocket company from his garage. And at the end of the day, I think he's done a pretty damn good job getting this to where it's at. And I think within 5 to 10 years, you're going to see probably a $20 to $30 billion company.
That's awesome, man. Chris, what's going on, my man? You look sleepy there. You just got out of work or what?
No. I'm just hanging out with. I didn't know you guys were still awake. Kept going with this. So I was like, all right, you know what? Let me hop on.
I was watching the football game and I was on tilt because I freaking lost my bet twice today, and I saw that Matt was on and he was talking about Apple, and I was like, I need to find companies to sell puts on, and it's so hard right now when I feel like everything in my fucking portfolio is overvalued right now, dude. I don't mind owning the shares here, but I ain't trying to buy any more. You know what I mean? So I think hard to find a company right now that's beaten down.
It's going to be hard in the short term, only because one, you're right, the valuations have gotten a little bit frothy on some of the more popular names, right. And then also at the same time, the opportunity I think lies more in the small and mid cap space, right. And they don't necessarily have a lot of options volume. So the thing is, like, your strategy works, but you need a lot of liquidity in order to make it work. And I think that's one of the hold on one second. That's one of the reasons why some people they'll ask me like, oh, how come like hedge fund managers and stuff like that, like big guys like $1 billion fund managers don't do more options? And I'm like, well, there's a couple of reasons. Number one, there's not enough liquidity in the market to run certain strategies.
Right.
So you have to understand that. And so a lot of people, once you get into the high
Robinhood, a lot of people don't know is you can only do 200 contracts at a time.
Yeah.
And it's like, oh, 200 contracts, bro. Like on some Mondays I'll do like a total of 20,000 contracts. So it takes me a while.
Bro, you and Robinhood are best friends. I mean, at this point, you deserve a level of what's the word? Like, I don't know, like service that's like beyond what it is, because they've made so much money off of your trading.
I'm telling you, bro, that the fucking payment for order flow is a real thing, dude. Because we just switched monies over to Charles Schwab, and I can definitively tell you, just a few trades that I've done over there, like the bid and the ask it's not that it's tighter, because it's the same for the market, but I get much more favorable fills. Yeah, I'm glad to pay a small commission because I'm making so much more on the actual premium itself.
Yeah.
I'll even see that on my small, because I do Fidelity, and
Uh-huh.
I look at Robinhood because it's so much easier to scroll
It's
through all the
user
different.
friendly. Yeah, of course.
Yeah, it's very
Yeah.
user friendly, and so
Right.
I'll generally go to Robinhood to find what contract I want to buy or sell on, and then I'll go to Fidelity, and I'm getting a couple cents like more. It's like it's the bid and ask says it's going to be 15 to 20,
Right.
and nobody's hanging out in between. And next thing you know, I'm getting it filled at 18 or 19, and I'm like, well, that's a $3 plus, right? I mean, per contract. I mean, you're talking about a couple hundred contracts for you. It's like $600.
It's
right?
huge, dude. It's called slippage is the actual technical term, and I'm sure Chris knows all about it. But that is where this payment for order flow thing. It's like it's they sucker you, right? Because you think it's good for you as a consumer, but in actuality, bro, they're sticking it in you pretty damn hard. Robinhood is. So
Here's a question.
I'm going to transition out of Robinhood completely at some point.
Yeah.
But it's just it's also real friendly for YouTube because it's so easy for me to spell out these trades and stuff for the viewers because their interface, bro. I just absolutely love the Robinhood interface. I went on record a couple of years ago that I don't understand how SoFi and Robinhood aren't just one company and calling it a day.
Guys,
but apparently, I don't understand how it all works or how it could work. But in my mind, I'm like, I feel like if SoFi had the Robinhood Invest platform like that, that could be a juggernaut in the investing world because I just believe it. But I mean, they've done episodes. The Nerds on Weekly have done episodes a couple times on it already, and evidently, it's going to be a no-go.
I'm speaking of the Nerds on Weekly, I'm gonna call it because it is over 2 a.m. here, and you guys are all millionaires, so you guys can afford to sleep in tomorrow. You gotta get up early.
Appreciate you, Tevis, my man.
You're the man, Tevis. Thanks for hopping on, brother.
See you.
The one thing I like about what I don't like about Robinhood that I do like about Fidelity is that you can choose which lots to sell. Because I do have positions that are over a year to 2 years, 3 years, that I bought them. And the thing is, I want to sell them, but I've also bought some positions in that when I'm DCAing. So I don't want to sell the newer ones. I want to sell that old lot so that this way I don't have to pay taxes on it. With Robinhood, you don't get a choice on that. And so I just want to show everyone this really quickly. Long-term capital gains taxes, especially if you're married. Let me just show you like right now how much it's tax-free.
It's a major pay raise, though. If you can hold these shares for a year.
Take a look. So if you look at this, short-term capital gains get taxed at your income level, but long-term capital gains, they get taxed at long-term rates, which means that up to, if you're married and filing jointly, almost $90,000 of capital gains is taxed at zero.
Right.
So I think a lot of people, they don't understand that, hey, this is actually a big plus. So if you do hold something for over a year and then you sell it, you don't have to pay taxes on it. Like, unless it goes above that $90,000 threshold for that year. So I look at my sells very, very carefully when I do sell like long-term stuff and, go from there. And by the way, this actually increases in 2024 to, I think, 90 something. Let me see. Hold on 1 second. There we go. So right here now, no, where is the damn capital gains? Long-term. Hold on. Sorry about that. Right here, it's almost at, if you're especially married, 89,000. So now that jumps up to right here to, well, still 89.25, I guess. I thought it was higher.
Maybe it's 2025.
Yeah.
But I know the Roth contribution limits and the 401k limits are also increasing for those that care about that. I personally only really care about the Roth. The 401k limit, I just do my 7% match. So
dude, I'm learning so much about finances that I don't know anymore. In a previous life, I used to have a Series 7 license. So you're hip to the game and all this shit. Dude, I didn't know that there was income caps on being able to start a new Roth, because like they offer you this opportunity for a Roth on Robinhood, and I'm all cool like the little cat, doing it. Bro, they rejected my ass. I was just like, wait, what? So I called my financial advisor and I'm like, dude, Robinhood's not letting me open up a Roth, because I wanted to do this little Roth challenge for the channel, saying, hey man, before like y'all follow me into all of this shit that I do, I just feel like, half of your money should be going into just steady Eddie, man. I call it no-brainer investing, man. Just putting the money into the SPYs, the Qs, whatever your flavor is, but just putting the money over there. And then in 20 years, if you're putting in, a couple of $200-$400 a month, you're going to look up and you're going to have damn near 7 figures. And that's like the surefire way to have success in the market. And you're not worried about, is Palantir priced right? Is SoFi priced right? You ain't giving a shit about any of that, You're betting on the economy.
Here's the question. What is your guys' end game? Because I have a plan on what my end game is. What's yours?
So you want to go first, Matt, or I'll go?
Sure. I mean, the medium term is really to get myself to which I already have, a 7-figure equity portfolio in the stock market, and then split a large portion of that into real estate. And with that, I'll have rental properties. And my goal will kind of be in the shorter term, when I kind of get that kicked off, is to partner with a constructor and really only sell like 1 or 2 houses a year. And with that, I'll probably take a portion of the money, because I learned something from somebody that's very close to me. They had a very large rental portfolio, and they sold all of it in the early 2000s to build. And what they ended up doing is putting all that money into construction, which had they did and been able to sell, all those homes, they would have turned out very beautifully. But when the market flipped on its head in 2007, 2008, they had many, many homes on the market in the many millions of dollars per home. And so they had a lot of construction loans that they had to continue to feed. The biggest mistake that they told me was that they never took a lot of that profit and put it into rentals, or put it into something that was able to be steady Eddie over time. Because just like a lot of the things we talked about tonight, a lot of businesses are very cyclical. And so when you're making money in the contracting business or home building business, you can print money, 30-40% margins. You could turn $100,000 into 150 into 250, 250 into 350 very, very quickly. And to the point where you're growing a business from a couple 100,000 to a couple million very, very quickly. Now, if the market turns on its end, the next thing you know, the bank is saying, well, we lent you 70-80% of the money. We want that 70-80% of the money back. And you're sitting there like, nobody's buying these damn houses. So the thought process to me would be, have a pretty decent rental portfolio with 30-40% loan to value ratios. So basically only be borrowing about, 50, 60, 70% on each home. And as I get more and more money into those, refinance them, be able to buy more rental properties to the where, I can continue to play Monopoly on that side, but also siphon off a good portion to have in the equity side as well. So I kind of want to have both of those to play with. And the hope is eventually get myself to where I could do that full time, and then maybe open up and focus on YouTube or something full time, or creating a capital fund. I haven't completely, because I'm still young, right? I'm 30s. I'm never going to retire per se. I'm just going to find things to occupy my time. So eventually maybe get, the certifications I need to sell insurance and to sell stocks and become a financial advisor, and eventually get to the point where I can open up an ETF or something like that. So that's kind of the thought process at the moment. Or if I continue to do well at my job, which I think I'm well received, I'm going to probably hit a pivot point in 5 to 10 years where they're going to say, what are you doing? Are you going full time on your own, or do you want to climb this corporate ladder? And I guess it all depends on where I see the future in both, right? Because I think I'm doing rather well at UDOC, and it's going to get to a point where the portfolio is doing pretty good. But what do I see more benefit of, and what's more stable, and what does my lifestyle want at that moment. You know, my life can completely change if I end up having a wife and kids, and stability might be something that's more important than the peaks and troughs of the stock market. So that's where I'm at.
Yeah.
I gotcha.
For me,
I have a crazy number that's probably not attainable in this lifetime, but I think that you have to have goals that are not achievable because it keeps your brain working all the time.
shoot for the moon, right? Shoot for the moon.
So anyway, so I have this crazy lifetime goal of 100 million, just because I think it just sounds cool to say. But I feel like I have a plan on how to do it now. I didn't have that plan a couple of years ago, so I want to continue to sell puts and calls and roll with the best of them. But like once I turned my wife's account into $1 million, we're at about $500,000 now. We started at 295. And I do that fully transparent, over the course of the next couple of years, however long it takes to get there. I'm writing the book on it, like journaling the whole thing on, the wheel deal, manufacturing the win, how I did it on a handful of stocks or whatever. And then I want to write another book on the evolution of the wheel strategy and coupling it with the poor man covered calls and credit spreads and things like that as well, to show just a wider array of the game versus just being like a one trick pony, even though it's a really good trick for me. And then ultimately I want to have the name of I already have the name of my company is called Premium Capital, because we obviously collect a lot of premium, but I want to have wheelers that are on payroll that can essentially trade my bankroll, and that I will mentor them and I will coach them, and I will make it sure that the getting's good, but it will be just like a 2 to 3 year employment opportunity for them, so that they can build their bankroll on a personal level enough to where they can go do it for themselves, because I don't want to be the guy that used a bunch of people to make me more money. I'm doing it with the sole purpose, like, hey, how much money do you need in your portfolio so that you can generate 10, 15, 20,000 a month, whatever the case may be? We'll come over here. Obviously, it's like any other job. You got to help make me money in order for it to be good for you. And then now you can take that money and you're out and go do it on your own. And if I can impact 10, 15, 20 people to do that, then I just feel like my time on earth was well spent financially as far as that goes. Because, dude, the one thing I've learned, that when you start having a little bit of success, the more you give, the more you get. And what good is success if you can never show anybody else how to get it? And I eat really well, and my whole thing is I just want to show people how to fish. Because to me, that's where I want to leave my mark. And that's why I do everything that I do on my little YouTube channel, and I don't charge anything or any of that sort, because it's my give back, man. It's my philanthropy, if you will. And it's like I found this little silly beginner friendly strategy that I've just really honed and made my own. And I'm like the largest wheeler on YouTube. As far as like, finance wise and stuff, there's wheelers that have much larger channels, but I'm talking about actually wheeling for a living. And I want to show other people how to do it, but they always have that excuse that I don't have enough money. But if I could take that excuse away from you, then you're going to realize that money's half your problem, bro. You need the skill set too. So you're going to have to be willing to put in the 5,000 and 10,000 hours that it's going to take to really hone your skills, because this game is not an easy game to really like fully learn. I mean, I'm learning still on a regular basis, just like you guys are. I mean, it's not easy, dude. Like managing your own money, and let alone money for someone else, it's not easy, because it comes with a level of stress that a lot of people cannot handle. Yeah. So that's my end game in a nutshell, man. I want to have that. I want to grow Premium Capital, and I want to have live job interviews on my channel.
Nice. For me, it's somewhat similar, but okay. So my end game is, first, I'm just going to get my RIA. So I need to get a Series 65 license. And then hopefully I can launch an ETF that's geared towards retail investors. But for the most part, what I want to do is I want to have that personalized YouTube experience so that this way people understand why each company is in the portfolio, right? Or if there's a portfolio move that's being made,
Right.
why am I making that move? Like, what do I see? And it's going to be centered around picking just really, really good companies with strong cash flows, and then using some of the macroeconomic conditions that are out there to do the positioning, right? So I think a lot of funds right now, especially on the ETF side, they're primarily focused, unless you're looking at an actively managed fund that's like ARC related, where there's a theme behind it. Mine is basically going to be more on the opportunistic side, where it's like, okay, let's find an opportunity for alpha, and then make those portfolio allocations, but at the same time be able to explain the reasoning why it's happening, right? So like right now, Kathy Wood puts out all her trades like, oh, I bought Roku, I bought this, I bought that. But the thing is, like, there's no rhyme or reason or explanation why. And I think that's a disservice. So a lot of retail investors, they do want to take the money. And I want to make the process as easy as you just go to your brokerage, you type in the ETF name, and you can just, take $10,000 and put it in there, right? And basically there'll just be a small management fee, but the entire time you can always tune into the channel and see what the reasoning is behind that portfolio allocation, right? So I already did the math. I need about 25 million in total assets under management. And I think it's, right now I'm too small to do something like that. My own, and the other thing that I want to do is just make sure that my own personal wealth and fortune is in there with it, so that this way people understand, like, no, I'm not just one of these fucking fund managers that opens an ETF but has no skin in the game, and all they're doing is just milking the clients for that performance fee, that they're going to be getting. So that's not what I want to do. I want to make sure that people understand that, no, like, I'm with you. Your losses are my losses. Your gains are my gains too. The only difference is I really want to use majority of that performance fee to basically pay for the upkeep, because to upkeep a ETF, it's pretty pricey. It costs between, like, just starting up an ETF in terms of capital, between 75,000 to 100,000 just to start it. Like, just, you have that conversation, you need to get all the licensing, all the compliance stuff, you need about that. And then in order to run it successfully, you need about 200,000 to run all the compliance and everything else that goes into that. And so also remember, there's traders that are in the sidelines that are going to be moving assets back and forth as you need. So if you change your portfolio allocation, let's say right now 20% of the ETF is Google, right? And we want to reduce that allocation to 15%. It's not as simple as hit buy and send. It's actually that ratio gets sent to traders, and they have to adjust all the shares accordingly to match your targets. And so it's a very interesting way, but I think it's the easiest way. And this way I can, like I said, my goal is going to be to find a lot of companies that are diamonds in the rough on one end of the spectrum, but then also very undervalued, very knowledgeable companies that anyone could do fundamental research on and understand that, hey, this is undervalued. Like everything that Matt just went through with Google. I think Google's very undervalued right now. They're not going anywhere. No. The question though is, how much of your portfolio should you allocate towards that? And I think that's where a lot of retail investors, they get sometimes a little bit frustrated, because maybe their portfolio is like, they see the S&P 500, or they see like the Robinhood of the world moving 70%. And they're like, man, what am I doing? I'm stupid as hell for holding Google, I should have been buying Robinhood this entire time. And then Robinhood one day moves against them, and now they're down 50%. And then they sell Robinhood to get back into Google. And now you need Google to go up twice as fast or twice as high just to make up for that difference. And these are the kinds of things that, like, a lot of times I see with retail investors that can really screw them over. And I want to kind of change the dynamic a little bit. But at the end of the day, I also want to make sure we avoid a lot of these small companies that are very, very speculative. I mean, you can keep, I don't want to say Rocket Lab, but Rocket Lab they're still a very speculative company. Yeah. So your portfolio allocation should not be 75% Rocket Lab. And a lot of people think that that's the way to invest. And it's like, no, it's fine to speculate, but I'm sure Matt.
But very small accounts are looking for, like, what can I do to double this account? Because they're undercapitalized. And what I always preach, like, my rule number one is you got to treat this thing like a business, and you got to get capitalized like a business. Like if you're going to try to wheel on a shoestring budget, you're already set up for failure, man. Like this is a hard game, and you're going to have to acquire more contracts than maybe you initially anticipated. You're going to get caught. It's just a matter of time, right? Like you're going to get in-phased is what I can call it now, because you always see that I'm down substantially on in-phase. Luckily, it worked out for me because in-phase is a real company. But that being said, I'm still looking to trim the position in half and put it into something just a lot more stable for the portfolio. But you got to be adequately capitalized, man. And then you got to try to stay away from at least a very minimal allocation of these potential zombie companies that, you know, especially like pre-revenue, dude. Like I'm real big. I don't think I've ever said it on the channel, but I'm like, the stocks that I stock the most are these pre-revenue companies, these eVTOLs, Archer and Joby. Because, dude, I just cannot wait to get on one of these freaking planes. I want to own one of those planes. Like, I just feel like it'd be such a game changer, you know, like the Uber of the sky. But then I start thinking, okay, hold on. They're not making any money. I know they got contracts. That's all cool. But they're not making any money. Let's just keep focused on the fact they're not making any money. And then at some point, one of these damn planes is going to crash with like 4 or 5 people in it. So what happens to the company then? Like, they're going to have to go through like a lot of growing pains of the regular airline industry that they're still going through. And I'm just like, oh shit, man, it's exciting, but is it investable? Like that's the part that I'm learning as TJ the Wheel deal is I used to invest in what's exciting and I could see like the growth prospects for days and days and days, but that doesn't necessarily mean that the company's investable or that you should want to put your funds there, because I had money in Joby and Archer, and luckily I made money on those companies. But I was like, you know what, dude, I'm like 3 or 4 years early on these things. Let me just let the story play out. Like I've been in Neo off and on for 4 years now, 3 to 4 years. And dude, like it'd be so much easier to be getting into Neo right now when they're so much further along in their investment thesis, and I wouldn't have had to deal with all the bullshit. You know what I mean? So I think like being early to the party, like if that's one part of my strategy that I'm glad that I got over. Like that's the biggest improvement I've made over the last 3 to 5 years as an investor is I'm not in such a hurry to get into these companies, dude. Like these companies need to start proving to me that my money deserves to be there. Versus like, dude, I'm so ready to give these companies money. And then now I'm like, why, when I have these other companies that have already done me well, why don't I just give them more money? you know, so I don't have that shiny object syndrome anymore, dude. It's hard to pitch me a company now because it's also work, bro. Like doing due diligence on these companies and listening to 5 or 6 or 7 earnings reports and going through 10 Qs and 10 Ks. That shit is tiring for me.
Yeah. And especially if you try to research the market. So someone asked me, Chris, what is the way that you find attractive companies, right? And I usually start, and the model that I use to find really good opportunities is I start with the sector and the industry first. You know, and they were like, what do you mean? Like, you don't just go straight, like you don't go into like a screener and you put in the metrics and you just, I'm like, no, the first thing is find an industry and a sector that you like, that you think is going to be good in the future, right? So right now you said eVTOLs, right? Before you look at Joby, you look at Archer, you look at Lilium. The first thing is this a technology or is the industry going to be a big thing in the future? Because if the industry does become big in the future, then it's worth exploring all the companies in there. But if it's something that's like complete BS, then there's no point. Like you can't tell me like, oh, hey, I have an undervalued coal mine. I'm just not interested. I'm sorry. I don't think that coal is going to be around. I mean, it probably will be, but I'm just saying as an example, it's not the most attractive thing. Like, oh, it's only trading at a 1 PE. I understand, but I have no intent. I have no interest in being a coal miner. You know what I mean? Versus, hey, I would rather be in an industry that I think in the next 10 years is going to be a thing. I think like cybersecurity. Cybersecurity is not going anywhere. Cybersecurity is going to be big. So the first thing is I like cybersecurity. And then after that, you go in a little bit, you know, into the nitty gritty saying, okay, what part of the cybersecurity chain is going to be really, really profitable in the future? Is it going to be just generally just providing like SaaS as a service, or is it going to be something like endpoint security where you have multiple nodes all over the place and you're providing security to all of these little devices, right, at the device level? And that's what I think is going to be really good. So it's going to be like CrowdStrike. So this is where you do fundamental research, ignore the numbers at first, and then you go into it and then you say, okay, CrowdStrike is the company that seems to be doing exceptionally well in this industry. What do their numbers look like? Are they profitable? Are they growing their revenues? Like, what is the target by which they expect to reach free cash flow positive and then double up on that free cash flow positive? Are they a rule of 40 company, which a lot of SaaS companies get? Are they overvalued for where they're headed into the future? These are the stuff that's very subjective, that are very granular, that you as an investor will be able to learn traditionally from books. But the first part, that's the part that you should start with most investors. Before you start picking a company, pick a sector that you actually want to research and enjoy. Because if you don't pick a sector, bro, you're going to be all over the place, you know.
Yeah.
I agreed. Here's one question for you guys. Probably half of the positions in my portfolio are positions that I was determined to be in. Because I wanted in, like I believed in the company, believed in the CEO, the thesis, etc. They were making money. I wanted to be part of it. I wanted to be part of Tesla. I wanted to be part of Google. I wanted to be part of Amazon. So inevitably they make it into your portfolio. That's how investing works for me. Yeah. But how do you guys get into companies when you want to be in them? Like you're talking about CrowdStrike. So I pulled up CrowdStrike. I have the intrinsic value on my alpha spread right now for CrowdStrike, and this thing's like egregiously overvalued right now in my mind. But I want to be in it. So how do you?
The first thing is try to determine: are you using this as a value play or are you using this as a growth play? Because remember, when you are looking at a company, you have to determine, okay, why am I in this? Do I think that this company is undervalued based on its history where it's done exceptionally well? Like my Verizon position right now is a value play. Like I think Verizon is very undervalued considering how strong their business is, how strong their cash flows are. They're reducing down their CapEx. So I have every reason to believe that this company is going to do exceptionally well because the market does not understand that this is actually a very healthy company that is going to be able to make money go into the future. And right now the business is being discounted. So is it a value play or a growth play? I don't think Verizon's a growth play. I don't think it's going to grow 20, 30% CAGR per year. So of course, the metrics that I'm going to use to value this company are going to be around things that are traditionally more in line with that, like price to earnings, right? PE ratios. Like what is the historical PE ratio been for Verizon?
Do you put a hard number on this is my entry point? Like, because right now I've been selling cash secured puts on Celsius, and I've been selling them at a number that I'm actually not really wanting to own it, but I know that I'll use my skill set and I'll roll down. Well, my price target's 40, but I just don't think that Celsius may go there. I'm like, I still want to make money on it right now.
The hard part when it comes with value companies, it's easy to value them because you can just look at their intrinsic value. Look at
these companies going 100% year over year. That's hard, bro.
Yeah,
but like,
Go
ahead, Chris.
I was just gonna say it's really, really hard to determine where this company is going to go in terms of total. You ever seen these DCF calculations where these guys like, oh, the terminal rate is blah, blah, blah. And it's like, no, your fucking terminal rate is absolutely wrong. Like there is no terminal rate for certain businesses. It's going to keep growing exponentially, you know? So that's one thing to just keep in mind. More importantly, with companies that are growing at the pace that some of these companies are, it's so hard to value it. And trying to understand, and if you try to do intrinsic value calculators, bro, it never works. Okay. No. It'll always be overvalued. That's
the thing. Simulations are always wrong, right?
Yeah. Yeah. Now, companies like this, though, the way that I would play it, honestly, TJ, I would just dollar cost average. But then this is the way that I would dollar cost average. When it dips, I'll buy something like 3x the shares that I normally would.
Right.
If it's medium fair priced, in my opinion, then buy 2 shares. And if it's overpriced, in my opinion, buy 1 share. And then as it goes down, do the exact thing again. So if it goes down a little bit to like, it takes, let's say it went right now. If you look at it from a split adjusted basis, this is actually trading below, I think it would be $65. Is that how much, Celsius would be? Right? Let me see. 1 second. So Celsius
right here. Let me pull it
yeah.
up.
So Celsius was at $68 in September.
CrowdStrike's the one on the stream right now.
Yeah.
Here's
Look
Celsius.
at Celsius, right? So if you scroll down, right? So according to the intrinsic calculator, it's 30, right? Now, which high growth company do you know that's ever really trading below its intrinsic value or close to its intrinsic value? It rarely ever happens that way, right? But look at its revenue growth. It's freaking phenomenal. Now,
it's 100% year over year for like the last 2 years. It's crazy.
And the thing is, like, it's a consumable. That I like businesses that are like that are consumables, because that means that it's not one of those things where once someone buys it, they can hold on to it for the next 5 years, 10 years, whatever. It's like listen, it just
solar. Like solar.
It keeps, not just that's like solar.
But this is a prime example of a company. Like, somebody might buy, like, let's say 5 shares of Celsius, and they might look at you and be like, this is my get out of jail free card. This is good. This is the stock that's going to make me a millionaire. It's like, you bought five fucking shares, guy. Like, I think the problem that I see with most people is that they need to start with the end in mind almost. And maybe this is just a lack of experience. Like, I have a buddy, he's like, oh, dude, it's like, he'll message me. I love him to death, and he's trying and he's doing a good job. Most of his money goes into his 401k, which I actually approve of. But he'll just be like, dude, Dutch Bros is going to make us, and I'm like, how many shares you guys? Like, I got 20. And I'm like, I mean, that's not going to move the dial. Like, I love what you're saying, but you kind of have to go with the end in mind, which is like a lot of people.
That's a good point, guys. And I have it highlighted on shares, right? So,
but you kind of have to start with the end in mind. It's just like,
and that's what I'm saying. Like, I'm not there yet. Like, I feel like I have the 1,200 shares of Amazon. That's not life-changing money because it's just not enough. I know it sounds crazy. It's just not enough shares for what I'm looking for.
Right.
So I mean, I think it's cool, but when am I going to be able to buy more shares or add more shares of Amazon? Because I've been in it for a little while now, and that's when it's hard for me, guys, when I have what I'm willing to pay number for the stock. Like, dude, like, I have we talked about earlier, I have the 15,000 shares of Palantir there. And dude, unless Palantir goes to like 14, 15, I will never own another share or buy another share of Palantir. I'm just not willing to do it.
I try not to.
I'm saying what I'm saying is it's so easy for me to average down. Mm-hmm. It's very, very difficult for me to average up.
Gotcha.
And I averaged up on Palantir. Like, I acquired 10,000 shares at 14 in Palantir here because my first 5,000 shares were in the $9 range. Yeah. And then in my wife's portfolio, they were like at 747 or 757. But I'm not willing to average up. And that's where I feel like I need to grow as an investor, because, dude, some of these stocks, when they take off, they'll Tesla on you, so to speak, and it's just, it is what it is. And I'm just saying it's hard for me. Like, I'm always willing to admit my deficiencies, right? Like, in where I feel like I need improvement.
But I think sorry, go ahead, Chris. Go ahead.
No, I was just going to say one thing. I would try not to set price targets don't become too reliant on price targets for one reason. When you do that, you kind of like give yourself this perspective where you ignore some of the other macro conditions that could arise that really can set the company in a wrong direction or right direction. And the thing is, like, it's something that even management can't really control, so like
when
right now,
price targets, you mean when you're buying or where the end value will be?
Both, right? So as an example of, and I'll just go with the end phase thing.
Yeah, because I remember you said you'd buy it at 150, but then things changed. And I had decided I'll buy it in the 130, 140 range, and I stuck to my guns. And boy, if I would have been willing to look at the macros, I could have had this shit at like 100. Maybe not at 80 because I'm not that good, but I might have been at 110.
my logic was this: regardless of the numbers that this company shows in terms of earnings, if the macro is not with you, you're eventually going to get punished in your earnings. So as an example, I said, look, the main source of funding for solar, for residential solar, is the credit market. So if the credit market is tightening, how can you sell more solar panels next year than you did this year? Or solar micro inverters. You
Yeah,
can't
but I
do
mean,
it.
they go on solar panels, so to me, they're
You
kind of
know,
hand in hand.
yeah. So
Yeah.
it ends up coming to be okay. Now I'm a little bit more bullish on these companies. Why? Number one, their values have come down significantly. That always helps because now there's valuation that actually makes some sense. And then on top of it, the Fed is giving you the playbook for the next 3 years that they're likely to keep cutting, which means that people who are interested in getting solar are
Gonna
going to
be
be
good.
able to actually get it. So now
Yep.
it's like, okay, the thesis behind that macro condition, behind that business just
Has
changed.
changed.
And this is one of the unfortunate things when it comes to investing. Like people will be like, oh yeah, I want to invest in like car company. Like I really like a car company. I'm like, okay, but did you consider that right now the credit market is really tight, which means that not a lot of
Right.
people are going to be able to get those cars? Like, how does that impact their sales? Oh, that doesn't matter. I just like the car company. Okay. If that's what you want to do when it comes to investing, go right ahead. But me, I try to now not only look at the micro of the company itself, but I also look at the general industry and where it's actually headed. Because if the industry is being challenged by impacts from non-business related operations, then that's not something that you can even judge management for. Like I'm sure Enphase's management is really, really good, but they can't control the Federal Reserve and their fucking interest rates. You know?
Yeah. I mean,
I'd
I
like
like
to get your perspective on this because this is my latest holding. I just took on 5,000 shares at 28.75 of Pfizer. I just feel like I'm not going to lose money here over the long term, but I do feel like it's there's probably more pain coming because the company is just not hitting on all cylinders. They overpaid, in my opinion, for a couple of acquisitions. And I mean, we can just stem through this real quick. Are you familiar with Pfizer at all? I mean, I know you know what Pfizer is, Chris, but have you looked at it at all a little bit?
I have. In terms of valuation, they are really, really undervalued. But there's one caveat that everyone has to remember when it comes to pharmaceutical companies. Their bread and butter comes from the exclusivity of the medicines that they sell. Okay.
Right.
Pfizer has had a ton of blockbusters that have just been giant revenue generators for them. A lot of those blockbuster drugs are now going generic. So it's like Viagra. When Viagra was exclusive to Pfizer, it was a moneymaker for them. Sildenafil was a moneymaker. But the minute that patent runs out, dude, generics can come in and literally decimate the margins. So what happens with companies like Pfizer is that you would have to be honest, all of the stuff that you're looking at right now is important, but I would ignore all of this nonsense, okay, for Pfizer. And the reason why I would ignore it is because they work in an industry.
But isn't like COVID tied to a lot of these numbers? And then so I feel like you need to look at it like before COVID and look at the numbers maybe like 2017, 2018, maybe 2016.
Can I ask a general question?
Yeah,
go for it.
What's your objective about investing in Pfizer? What's the end goal?
Yeah, so the end goal is to double that portion of the portfolio. So allocated give me a second, I'll tell you right here. So where is my guy? Here you go. So we put in 143 grand is what we paid for the shares, and the objective in 5 years is to turn it into 300. And I just think that Pfizer gives me that legitimate opportunity just from a share price perspective, but the premiums are decent, but it's also a nice dividend play because I think it's about a 5 or 6% dividend annually. And I just wanted a strong, profitable company that was out of favor because I just believe that it sets itself up for a pretty nice turnaround play. And I think Walgreens kind of does the same thing, but again, I've sold puts on both recently, and then I owned shares for a short time on Walgreens, but they just didn't sit well. It turned out that they didn't sit well for my palate, but I feel like I've been in Pfizer before several years ago. and I'm comfortable owning it, dude. And I just think that they're not going anywhere in my lifetime or our lifetime. And I think eventually they're going to go up and to the right again. I don't know that they'll go to COVID levels again, but that's okay. But it's just a solid company that I think they do what 65 billion is what it showed over here.
Revenue.
See, but TJ, look at what I'm about to show you. Can you put my thing on there, Matt, real quick? When you look at pharmaceutical companies, you have to really deep dive into where they're making their money. A lot of their revenues are not durable revenues that go way into the future. They live and die by the FDA approvals and the drugs that end up getting researched and get put on their
but
Pfizer's
pipeline is like as long as Palantir's contract.
Right. But the thing is, a lot of that pipeline is not something that can be analyzed totally. I mean, it's very hard to figure out what kind of market penetration you're going to have with a specific drug, what the total addressable market is for it. Then you have competitors that could be working in the same technology that can also undercut you. The one thing I can tell you is you can actually see when the drop-offs in revenue is going to come from. So like as an example, AbbVie, right? AbbVie is a giant pharmaceutical company. Right. They have 2020 sales at the time of about $20 billion, right? In 2023, when this Humira, which is one of the biggest drugs, actually the biggest,
Hep C, right? I think.
Yeah, I don't know what exactly it was for. I know it's a biologic. It was for.
It's not
something. Yeah. But the point is, its patent expires in 2023. So now what happens is this entire revenue, this $20 billion a year that they were making, remember, and not to mention this margin, the margin that they get on these sales is close to like 90% plus. So It is a lot of margin. So the minute that this thing expires, think of $20 billion in revenue just disappearing overnight from the valuation. And it's same thing with a lot of these companies like Keytruda from Merck in 2028. Right now, they generate almost $14 billion a year in 2020 numbers. In 2028, this expires. What's next for them? And so they have to make sure that their pipeline always has more stuff coming in. So with Pfizer has a lot of drugs that are coming under patent expiration. So it's one of those things that you have to be very careful with. I know Pfizer right now is doing a ton of research into its into like developing its pipeline more, but they also have a lot of patent.
But they acquired Seagen, which is like a huge. I want to say it was like I don't know, it was in the 40 billion or something ridiculous. Like they paid a lot of money for this company, and those revenues aren't really going to start showing up on the bottom line till like 2030.
And believe it or not, they may never. I'll be honest. I've seen acquisitions on companies that people thought, oh my God, this is going to be a great acquisition. It's going to be bolt on. And they end up finding out, oh, this drug actually has a problem. It works, but the FDA could label it with a black box warning. And boom, now all of a sudden the whole value proposition of that FDA approval is complete garbage. Because now every time someone gets it, they have like this giant warning label against it. So doctors don't even want to, prescribe it. So like I said, this is why I'm not a big fan of the pharmaceutical industry on this side of the aisle. I like AbCellera more because it is a moonshot, but those are fixed, durable revenues that I think eventually AbCellera is going to be able to get. But I
wanted a biopharmaceutical play, and I didn't want DNA. So I played that game early.
I'm not a fan of DNA either, dude. I've steered what's his name, Ahmed. I was like, listen, man, this is some speculative shit, bro.
But I'm saying I wanted two profitable sectors in the portfolio, and pharmaceuticals, they are what they are, but they do make money. And then the other one that I want is I want an oil field play because my whole family and my roots are in the oil field. So I've been looking a lot at Exxon. Even Valero, Shell is my first rig that I was on was a Shell rig, and Shell prints. They know how to print money too, and they run a very, very clean operation on the rig. Like I just know that from that side, but I haven't studied like the company as a whole. But I know like Shell does not waste money on an oil rig, dude. Like they're very, very stingy with their money, and that's the kind of company that I want to invest in. I'm extremely familiar with Schlumberger and Halliburton as well. With Neighbors, I worked for Neighbors for 8 years. So one of these companies is going to make it in the portfolio. I just don't know which one yet. I've looked even at Devon Energy because there's Will Snowball sells puts and owns shares of Devon Energy. So I've watched 5 or 6 of his videos on it. So I'm starting to get comfortable. But I'm going to find one. I'm going to make a decision on one. And I just want to have a little bit more diversification in the portfolio, something that is not fucking SoFi or PayPal or, Palantir. Like I want one that, like, I know if it's Exxon, because Exxon right now is the number one contender for me to just go ahead and start building a position in it. I feel like Exxon is going to be Exxon for the next 50 years. I just believe that. I don't give a shit how green, and I'm a component for green energy, but I just feel like Exxon's just not going to go anywhere in our lifetime. That's just how I feel, right? Like that's the basis of the thesis in a nutshell. And they know how to make a lot of money.
Yeah, I think Exxon does a good job. I just think, go ahead, Chris.
No, go. No, you finish up, Matt. Sorry, I always interrupt you. You finish.
I just think that, I would always just try to understand. I mean, if the goal is to just make it so you over 5 to 10 years can get I guess double the value of a portfolio. I mean, I just don't understand why, if you're looking for a little bit more stability, a little bit of diversification, does it have to always be an individual stock? Or could it actually just be, investing in a SPY and writing cash secured puts on that and being able to
and that's coming because there's more funds coming, like just like $500,000 just came in, right? So the portfolio jumped up in value. It's not because I'm that good. That was the deposit. So definitely the SPYs and the Qs and the IWM, those are 3 that are going to be added. So that's going to give me a lot of the diversification I need. But just we all make our bets at the end of the day, dude. And I just believe by like 2026, 2027, those shares, the 5,000 shares that I got for $28.75, they'll be near $60. Or even if they're at 50 with the dividend and the money from the puts and the calls, I would have doubled my money. And if I'm able to double my money in 3 to 5 years, I'm beating the market by like a whole year and a half, because it takes about 6 to 7 years to double your money in the stock market based on the rule of 72. And so, I mean, a lot of people need to be cognizant of that, dude. Like if you cannot figure out how to double your money in 3 to 5 years, then you should probably just invest in an ETF. It's a surefire way to do it in like 6 to 7, and you don't have a lot of stress. You can just DCA into the entire stock market as a whole with the SPY. Like to me, I like the SPY. A lot of people like the VOO. I mean, again, you're going to pick whatever you like for whatever reasons. I think that if I had to just pick one ETF, though, I would always rock with the SPY.
For me, I think I'm trying to find businesses that have non-cyclical growth, right? Where you also see non-cyclical cash flows, where you see constant, like almost like a nice straight line going higher and higher. And then basically this way I can figure out like, hey, this company is undervalued right now, buy some shares and then chill out. And then, it just goes up. So they have strong, durable cash flows that trend in one direction, and that's higher, higher, and higher. Right. So like right now, I'm heavy into cell phone companies right now. Well, cell tower companies, because I see that the value in the cell towers, because I think the transition to 5G is there. We're getting broadband internet access.
How do you feel about Marvell? Because I made $20,000 off of Marvell early on with the whole 5G adoption. Because I feel like they were kind of like leaders in that space for a while. But then I had shares get called away, and I got the shiny object syndrome, and I never revisited the trade. And Marvell's probably up 150% since the time that I was jacking with it.
Yeah, I haven't looked at Marvell nearly as much. Like, I'm not the biggest fan of semiconductors, even though they can be very profitable. They also have like some cyclicality to their business also, right? So they live and die by the market cycle. Any businesses that live and die by a market cycle are one of those things that you have to time perfectly to get in and perfectly to get out. And that's whereas for me, when I look at some certain asset classes, like let's say cell phone towers, I know that the way the cell phone towers work, you need a cell site You go there, you do a 100-year lease with the owner of the property itself. By the way, that's the other business that eventually I want to get into in the future. If I get some connections with the right people to basically buy land and then put a cell phone tower there, get a 100-year contract with fixed guaranteed raises every year, right? And basically just build that up. I have a friend who has his grandfather bought all these little sites all along like Arkansas, and basically now he just works with Crown Castle, with SBAC, with American Tower, and just puts up cell phone towers that he leases out to them for like 100 years. Now the way that he structures it is that initially the first 5 years it's actually very cheap for the person who's leasing it, so the guy actually loses money initially. But what happens is it comes with a fixed escalator, right? So it's every year the price of that rent goes up 3%, and the year after that it goes up 3%, the year after that it goes up 3%, and before you know it, 15 years of 3% compounding rent, dude. The guy right now is just chilling. Like he owns a fucking McLaren, owns some estate in Arkansas, and this is like someone who grew up poor as dirt, not like super rich. Nothing. They worked as like a family, they had like a small family business. But this kind of like industry that I want to get into, where I have real asset ownership with long, durable cash flows that go well into the future. So I think right now, cell phone tower companies, they're so undervalued because a lot of people don't understand two aspects. They look at the balance sheet and they just like, oh my God, this company has so much debt.
Right.
And the thing is like, no, that's how the business model works. They take on a lot of debt initially to finance the construction. And over the next 15, 20 years, they get rental revenue, which then they amortize and they pay off part of it. But then after like 10, 15 years, that entire thing is paid off. In which case now for the next 50 years, these guys are going to be collecting rent on top of rent on top of rent. So like I said, the business model is amazing. AMT, American Towers, actually outperformed the NASDAQ over the last 10 years. And I don't see cell phone towers going anywhere. So
I want to ask you a hard question, Chris, because I've watched probably 50 podcasts that you've been a part of. Because you're with Matt, and then you're obviously featured on Finance Junkies.
Yeah.
Right here, just between us girls, right? Nobody's looking. It's 2:00 in the morning Central Time.
Yeah.
Are you willing to admit that you might have been wrong on Palantir so far?
Nope. Nope.
Bro, I want to go on the record saying that the investment guru that is Chris Patel was wrong on Palantir. I don't understand it, but I'm right to the tune of 18,000 shares at a decent price. But I don't understand.
Listen,
valuation does not make sense to me, but I wanted to make money off of Palantir.
But then again, remember, I'm the same guy that told my dad to sell Tesla in 2012 because I said,
how'd that work out?
Exactly. As much as an investment, like, oh my God, Chris is the smartest guy, I've also missed big on certain things.
But I think that could be a detriment, like being that smart and understanding valuations. It's hard to just
I've been burned.
It doesn't make sense, because when the numbers don't make sense is what I'm saying. Because Tesla has never made sense to me economically. And I'm a big Tesla fan. I'm a huge Elon Musk fan. But Tesla's a fucking car company that has a couple of levers that it can pull. But it's a car company with a big tech component. But a tech company, it is not. It doesn't have Google margins last time I checked, right?
Yeah.
So it's a car company because 85-90% of the revenue comes from cars. It's a fucking car company. But Palantir, I didn't want Palantir to be my next Tesla, if that makes sense. So the FOMO that I suffer from Tesla, I used that to convince myself to take this position on Palantir that's been
I lost, by the way. I paid Adam Bergman the first installment of his Vic, even though technically Palantir and Snowflake haven't like finished, because my bet was that Snowflake would outperform Palantir, right? Even though Snowflake is overvalued, I actually believe in their shit way more than I believe in Palantir. And Palantir is fucking raked me through the coals. So I told Adam, I said, look, it's 2 weeks early, but let me just start sending you this money now, right? And so I actually paid Adam initially, like here's $1,000, Adam. Like we're gonna talk about it at the end of the year once everything settles up, because even I know right now, unless like Kark comes out tomorrow and says, hey,
I'm just getting Chris to admit that he's wrong on Palantir,
fuck
bro.
no, I will never
That's
admit
Chris.
that. No, I will never admit that. Screw that nonsense.
Matt, go ahead. Matt, it's your channel. Go ahead and tell him, Chris, my man, hot Chris, you were wrong, bro. Just fucking own it. You were wrong. It's okay.
Nope. No, fuck that. I will die. I will go to the grave, but I will never admit that I was wrong on Palantir. Palantir is an overvalued fucking SaaS company. They're a consulting company. Okay. I'll just say it right now. They are a fucking consulting company. No matter who says anything different, I don't think that they're a SaaS company.
The only thing Palantir is doing is going up and to the right, bro. That's it. And
it's
not going to make any sense, but it's going to make a lot of dollars.
When it gets back to $12, I will be dancing on all you motherfuckers, bro, and I'll remind you.
I don't own more shares.
I'm not putting it past. I think it could dive down to that as well. But I mean, it's definitely not a consulting company. I would say
it's a fucking consulting company, Matt. Shut up. You know it's a consulting company. They came to you and they consulted with you. That's how a consulting company works.
For 6 months, and for the last 5-6 years, I haven't even seen a Palantir employee. So
that means that they're a terrible consulting company. What does that mean? They don't even help you guys out anymore.
I don't know about all that. I mean, we're still utilizing their operating systems that they built for us from the ground up. To me, I think it's
you need to get on the Snowflake train, bro. Snowflake is where it's at.
Bro, Palantir's got $3 billion in cash and no debt and contracts for fucking years and years and years. If that doesn't make sense, let it make dollars. Who cares about the cents? Let it make dollars for you. TJ, it's a money printing fucking machine, bro. It's a cash flow machine.
TJ, they are also diluting the crap out of shareholders. Okay, that's why they're
so did Tesla. So did Tesla. Unfortunately, that's the entry price of the party, bro. Unfortunately,
man, I can't do it.
I can't compensation on SoFi is offensive. It's offensive the amount these fuckers get paid for running an unprofitable company.
Yeah, that's true, man. That's true. I hate to see that, dude. You know what's funny? Everyone on Wall Street's been downgrading these guys like crazy. You know, I don't know.
Which one? Sorry.
No, I'm saying Palantir, and even they're in. Look at this. Look at these share sales, right? Insider sales, like. Bro, even they know this shit is fugazi. The only people that are fucking like, hey, Palantir is gonna go to $30 are the fucking shareholders, dude. Look at this, man. Everyone is just selling. How do you buy a company with this much insider selling? Please tell me. Please, for the love of God, tell me.
Well, I haven't bought it at these levels. My last purchase was at 1464, and I'm sticking to that price target, dude. I just can't get there. Valuation wise, over
TJ, not a single freaking buy. All this is just one way out the door. They issue themselves a shit ton of shares.
That's the way Celsius is. We looked at Celsius earlier on Alpha Spread, bro. They've sold almost $1 billion over the last 12 months.
You know.
Yeah, I don't know. I think that it all depends on time horizon, right? Always.
Yeah.
I mean, eventually this company will do well. I think they do have a differentiated product, especially in the defense category. But I definitely would not pay $48 billion market cap right now on them based on today's prices.
Probably, yeah.
Yeah, not gonna pay that. Screw that. There's way better opportunities in the market. There's way better ways to lose money than trying to bet on Palantir, dude. I will say this.
What about your strategy? A company that's buying back a big portion of
that's no, that one's different. That's definitely a value play. But TJ, Palantir works for guys like you. You know why? Because they have such a tremendous amount of retail following that there will be buyers of those goddamn calls.
Yeah,
I don't know.
They have a lot of liquidity, bro. A lot of liquidity.
I will never understand how someone can buy like the price of that option contract for I saw some that were just ridiculous, like 2025. What is it, like 90 days out call option at like $25 of stock, and it was getting almost $1 of premium. 90 days out, and I'm like, how is someone fucking buying this shit? but there's active buyers.
I was somebody was in the chat earlier asking specifically. I didn't realize. I thought he had 2025 options, and turns out he had February's, but he has like February 30s. He was looking at selling Pomerant cover calls. But anyway,
share the screen real quick, Matt. I just want to show you the open interest on this Palantir is always fucking retarded, bro.
And
so a 15 put 88 days out, and look at that open interest, bro. Fucking 16,000 crackheads ready to give you money on this shit.
That's fucking
and then SoFi, dude. SoFi is not much different. Like there's so many crackheads on the SoFi street corner. Like if I go something stupid, like let's say $8, 88 days out, which is, arguably would be a pretty good price considering SoFi would be gap profitable by then. $68 in premium. It's pretty decent. And you got 5,278 crackheads on that.
Yeah, but look at on the call side, man. It's even worse.
It's crazy. Yeah, if you go like buy call, it's probably just retarded. Like let's just say you wanted to do a little out of the money, like right over here.
Dude, even if you go further,
5,900 junkies.
Look at, even if you go above, go to like the $14, $15 one. Look at the open interest
fire
on
bets,
that.
Another 4,000.
Look at that. That's freaking crazy, dude.
Oh, it's fucking insane. It's insane.
Now, here's the thing. It would totally make sense if the company was super undervalued. But dude, SoFi's still spec. They're still speculative. They're not trading on fundamentals.
Oh, it's gonna get it's gonna get a little bit better after these next numbers come out.
I'll show you. I'll show you guys something. Go to Verizon. Go to Verizon and look at the VZ.
Right?
Yeah, and look at the $40 call. How many shares outstanding? I mean, how many call option contracts are outstanding?
How many days out?
2026, all the way out. Leaps, baby. Right?
Yeah.
Look at the $40. So it's $40 is about $2.80, right?
Yeah, 2,600 folks. Yeah.
I own about half of those. So I degened into fucking Verizon.
Hey, so you're not doing poor man covered calls on those to bring some.
No, I'm just doing a spread on it. So if you look at the $50,
yeah, so you did a debit spread.
Yeah.
So you bought these, and then which one did you sell?
The $50. The $50.
Okay, so you go this guy right here, and then you sold the 50.
Yep.
So you're paying a couple $100 a pop.
No, actually, I only paid like $1.50 for them.
Yeah, but I'm saying right now. But you did you did it when it was a much lower price.
Yeah.
Because if you look at the underlying, because I used to follow Verizon, I guarantee you this thing's been up a little bit. Yeah. So it's
the key to it is looking at go to the 5-year chart, right? So one of the reasons why it's taken such a big dip is primarily because they have a lot of debt on the balance sheet. Now, only about 25% of that debt is floating. The rest is fixed, and it's fixed at really low amounts, like almost like I think their cost of capital is only about 3.8% on their long-term fixed debt. The thing is, the reason why they loaded up on all that debt in 2020 and 2021 is to do a lot of expansion in 5G. The thing is that expansion cycle is coming to an end, and 2024 they're cutting back about $7 billion of capex. And not 7, I think almost like 4 to 5 billion. And then the year after that, they're going to cut back again on more capex. And so their revenues are all durable. They're not losing that much in terms of revenue. And they're gaining a lot more revenue growth from fixed wireless access from the internet. So like internet subscribers. So that's like helping grow the total pie with these guys. So if you look at their free cash flow, they're just free cash flow monsters. And on top of it, their dividend is like a 7% dividend. So the thing is, people are like, oh, well, you're not going to get a dividend as a stockholder. I mean, as a call holder. And I'm like, I know, but I know that people in a lower interest rate environment are going to go yield chasing.
What do you think about a flyer like Open Door now that the interest rates are coming down? Do you think that these guys have a path to maybe not profitability, but a path to survivability?
Maybe survivability. I'm not so sure about profitability because I mean, their
business model for this one, Zillow tried this shit too, right? And then my buddy of mine worked for a company called Orchard, and they're on the verge of going under. Same type of shit, right? Where they'll
I don't know enough. I mean, to me, it's tough. I'd have to really look into how things are going. But
This
I mean,
was
just
another
based off-
Chamath, wasn't it? Was this another Chamath play?
yeah.
This was Keith Rabois. So basically, this entire business model is like it's basically flippers, right? All they really do is they do the quick buy from the seller.
No, but I'm saying about who took them public, because I feel like there's a trend. Like I think this might have been done via.
Let me see who
Chamath.
took. I think it was done by Chamath. Hold on.
No, I'm just saying, dude, because if you look at you look at SoFi, if you look at Clover, if you look at what was the Chamath did like 5 or 6, dude, back to back to back, and for the most part, they all got.
It was Open Door Open Door. You are absolutely right. Open Door.
It is
I feel
Clover.
like Wall Street has it out for Chamath, dude, because he has said so many comments that were pretty damn.
I don't think that's true. I don't think that's true. He just invested in companies that were kind of not profitable. And the thing is it's very profitable for somebody like Chamath to take a company.
Yeah.
I mean, he's been able to buy it at say a 10 to 20% of what they actually go public at. And
but do you remember when these SPAC craze was going on? Wasn't the floor meant to be $10?
Well, that's the thing.
Well,
I mean, he's able to basically provide $150 million in cash, get, let's just say, however much of the float, and basically get a cost basis of say $1.50 per share. It goes public at $10, and within 60 to 90 days they're able to start selling off their shares, which is why majority of the time 60 to 90 days, or maybe it's 9 months, whatever it is. I mean, there's lockup periods, but as soon as those lockup periods end, they're able to just sell them. And of course they sell the crap out of them because they literally are up hundreds of percent on individual dollars that they provided into the company. So unless you have a very strong business that the people that are holding it want to be in for the long term, it's just the way that they're structured. It's the deal that people get put together, right? Is it advantageous for them to stay in for the long term and a lot of these opportunities? And I would say the answer is mostly not. And Rocket Lab was a SPAC as well. I mean, will it go belly up? I mean, the I guess verdict is out, but you have had opportunities where things have actually become profitable. SoFi was a Chamath, and it's in the verge of profitability. So it's not to say that all SPAC companies are bad. I think it just all depends on, at what point are they going public, right? You have companies like Snyder's Pretzels that went public via SPAC, and that's a very, very profitable business, right? So I think it all just depends on whom is taking them public and what kind of valuation they can kind of milk out of it.
Which company you should look at? Paycom. I don't know if you guys did any due diligence on Paycom, but
you tell me about that one via text.
Yeah.
What is
Paycom? Payc. Payc.
It's more expensive though, right? Yeah.
It got. Look at that where it dropped to, and I was a freaking heavy buyer in the 140s because they literally guided for a little bit of less revenue that they were getting impacted by, and they got oversold like crazy. So I was buying this hand over fist. I told my Patreon people too, like, hey, look at Paycom. The thing is, these guys, their executive comp is heavily tied towards their share price, and they're actually profitable doing share buybacks. It's a crazy great business, man. In terms of Rule of 40, they've been champions of the Rule of 40. I think this eventually gets back to the 300, 400s relatively quick. So
I think another one that I've looked at as well is Fiserv, which actually does a pretty decent job. They do a lot of transaction volume for a lot of the companies that we know, like Clover and many of those other things. So it's like, if you continue to think that the total transaction volume for those guys is going to increase, the small portion that they get is going to continue to do well over the long term. And they actually trade at a pretty reasonable valuation as well.
Yeah. So if you look at, I'll just share the alpha spread thing with you guys. So if you look at this is for Paycom. You can see they've had long, durable revenues. They're still growing. Look at this. They've been able to grow their revenue like straight like this. Same thing with their operating income, always constantly on the rise, right? And now their operating income is close to almost 450 million a year. and their valuation right now, in terms of like market cap, is only, hold on one second. I just want to be accurate, is only about $12 billion. When it got to that 140 mark, they were at about 8 billion, with still their growth rate what it is. And their free cash flow is also growing. And look at their share count. 1 second. Let me just pull that up. This is kind of unusual for a SaaS company, where you can see their share count is flat, because they don't do a lot of share-based compensation. So where is it in the shares outstanding? So here you can see their equity is growing, right? But their common share count right here went from 5.3.
Can you command positive for it to get a little bigger?
Yeah, 1 second. Yeah. So you can see here that pretty much their shares outstanding since from 2015 on have been relatively flat, and now they're actually doing share buybacks. So that'll help out tremendously with this, So they're growing their business. It's one of those things that a lot of people really oversold, and I think it gets to a great value for.
And what kind of revenue does this company have? What was the revenue?
What do you mean? Oh, their revenue?
Yeah.
Let's go through it. Hold on 1 second. So right now they do about 1.6 billion in revenue.
Yeah.
They do about 1.6 billion in revenue, but this is what I like. You see how it's nice on a TTM basis,
right?
Nice reoccurring revenue with consistent growth. That's what I like. They are slowing down in terms of revenue growth because of like some extrinsic factors, but I'll go over that, with the Patreon people usually. But the operating income, net income, all trending in the right direction. It's a high margin business. So if you look at their gross profit, always constantly going up into the right direction. Their operating expenses, they manage it very well. And so the profitability is there. So, this is a company that I would not mind holding for the next 10 years. And especially because I was able to get it at such a freaking big discount.
Right.
So,
yeah. Yeah, and I think the biggest problem is really people just having unrealistic expectations as to where a company will eventually go to, right? And like, for example, kind of going back to position sizing and stuff of the like, I think people just whimsically will throw money into, let's just take Dutch Bros, for example, because it's only 2.5 hours. I'm probably going to take a nap and go get some here in a little bit and see if I can join a MIT for the market open. But the thought process that I kind of have is like, people will probably buy $1,000 worth of Dutch Bros and immediately think that in time they'll be able to become a millionaire just by that $1,000 investment. And the reality is, in order for that to happen, Dutch Bros will have to go from a $5 billion company today to a $5 trillion company,
right,
for you to become a millionaire off of that $1,000 investment in Dutch Bros. Now, let me ask you a question. Do you honestly think that Dutch Bros will become a $5 trillion company? Yeah. So I think a lot of times people just lie to themselves and don't do the true work that they need to do in order to make it a reasonable investment for themselves. And they'll say, okay, I put my $1,000 in, my work is done. It's just like, well, not really, right? You also need to follow it up with the next $1,000 next month and the money after that. And it kind of goes back to something that TJ said, early, about just having consistent cash flow into it. You have to think about it like a business. You have to feed it. You have to make sure you're not starving your portfolio of capital. And I think one of the things that I always think about is like, people think they want to go from $1,000 invested, never invest another day in their life, and get to $1 million. And it's like, well, what's that mean? It means you have to literally 1,000x your money. Well, what's the easiest way to have the amount of work that your portfolio does is add another 1,000 to the portfolio, right? Immediately you now have $2,000, and instead of having to go 1,000x, now you only have to go 500x. And that literally just have the amount of work that you have to do. Think about how hard it is to even just double your money. And now think about having to do that 1,000 times with $1,000 to get to your goal, right? So I think a lot of people need to just be more realistic about understanding that it's a goal of not just investing one time, but investing every single time you get an opportunity to, whether that's bi-weekly through your paychecks, whether that's once a month, whether that's once a quarter. And I think people just need to be more honest with themselves. Do they actually have the time to put in the due diligence? We just spent 5 hours talking about stocks. And, some of you guys have come in, some of you guys have come out, and that's fine. But I think a lot of times people will come in, they'll show up for half an hour, listen for a ticker symbol, put some money into it, never look at it again. And then 2 years down the road, be in a live stream, be like, hey, I bought that stock 2 years ago. And it's like, dude, that was a short-term swing trade, right? Like, did you even listen to what I was doing for my personal finance that I am directing? And you decided you're just going to utilize it for your own good. And so you have to think about these things, the objectives, time horizon, the risk tolerance that you want in the portfolio, because a lot of these things,
and macro can change, and macro can change, and macro can change.
Yes, and macro can change. And what Chris talked about earlier is like Upsellera, for example. He said that's a 1 in 1,000 swing, right? And you're sitting over there, be like, let me put 100% of my portfolio. Chris said it could 50x or it could 100x. It's like, well, it very well could be. It could end up being a Pfizer and being a $150, $200 billion company, or a $300 billion company if Pfizer didn't just go down 50%. But, at the same time, there's risk associated with some of those things. And I think a lot of times we devalue the amount that risk plays in the portfolio and just assume that everything's going to work out. And a lot of times, specifically in the very small cap, pre-revenue or, pre-profit sort of space, a lot of companies don't ever make it to the point where they can get to profit making and consistently doing that over a 20, 30-year time horizon to a point where you can grow that, let's just say, dollar investment into $10, $20, $30. And so I think a lot of times people just need to look inward and stop being so, all right, I did my part, I put $1,000. It's not that easy most of the time. If you really want to do and have a lot of success in this game, you need to be like TJ, you need to be like Chris, you need to put your time and effort in. Otherwise, just invest in the S&P 500.
Yeah, great. So I just like to show this real quickly to you guys, because my wife and I literally had this conversation earlier today. We were looking at her portfolio, and these are the allocation right now. 10,000 shares of Right, 20,000 in SoFi, the 1,000 in Enphase, and I'll put it on total return so you guys can see. How underwater she is or how profitable she is.
I will give you one really, really big credit, TJ. You are the most transparent person when it comes to showing this portfolio. I know a lot of people, they won't. Like, I personally will.
And it's hard, bro, because I get ridiculed a lot on emails and shit, but it's water off a duck's back.
Yeah.
But what I wanted to share with you guys and the audience here, I don't know how many people are watching or not, but I was talking to her and I go, hey, baby, I don't know if I have the one game-changing stock in the portfolio, or we may not have the right allocation to it yet. So here we have, I think she has 8 stocks. Yeah, 1, 2, 3, 4, 5, 6, 7, 8. Yeah, we call it the crazy 8. so we have the 8 stocks, and we have a pretty heavy allocations over here on Riot, SoFi, and Enphase. But we're trying to get the allocation higher on Tesla. Tesla affords us that opportunity. And then we definitely want to get the allocation higher to Google and PayPal. And then Bros is kind of like our little flyer stock that we feel like we got at a pretty decent entry point. But there's going to be more monies going into the portfolio. But what I'm trying to show y'all is this portfolio has grown. We have it all time at 72. We had a pretty banner year. Year to date.
That's awesome, dude.
Is 136% for the year. Last year, obviously, or 2022 was not a great year. I mean, we've got a lot of premium, but we were down a lot on stock, so that hurts your valuation, right? But what I'm showing y'all here is we don't even think that we have enough shares in the right companies yet to where we can have our quote unquote lottery ticket. And this is someone who's been in the game for 25 years, like not full time, but I've invested in the market since I was 19, 20 years old. So longer now, because I'm 48 years old now. And my wife's only been in the market. This is her first time investing. So this is, 2 years. This was, I think, actually the 2-year anniversary for the portfolio. So it takes it's going to take the right stock, and it's going to take a pretty massive allocation to it if you're looking for that 5 and 10x that some of these companies will give you, but you're going to have to be willing to be in that stock for 5-10 years, if not longer. And what's your game plan along the way? The reason I sell cash care puts and covered calls is because I need to generate cash flow, because if I'm going to be in a freaking company like Riot and SoFi that's, they're not profitable yet, they're certainly not going to pay a dividend, I got to generate some money somehow. Now, why could I ever justify having money in those companies? And I don't know, man, I just need to have a sound strategy that works for you. I'm certainly not saying copy anything that I do, but find something that works for you, that allows you to sleep at night, but also allows you to grow your portfolio, whatever that is for you. Because I think it's going to be different for everyone. Like, I feel like, Chris, it's pretty safe to say that debit spreads is kind of like your bread and butter, right? You find an opportunity, you feel like it's undervalued, and I'm going to do debit spreads, but I'm also a long-term holder as well. So you're like a hybrid investor.
I would say it's only when I see like outsized opportunity that I'll go into debit spreads. Like I feel like sometimes I've popularized the debit spread thing because I showed Amit how to do it, and then Amit like really did well on a few positions, and now like everyone's like, oh my God, I need to start doing debit spreads. Dude, there's very, very unique circumstances where debit spreads actually make sense.
Right.
It's not for every single company. It's not for every single stock. Like, you really need to find companies that have a lot of mispricing on the option side and also the stock price at the same time. And it's really not easy to find that. And you need to find a company that has liquidity enough to satisfy the spreads that you're trying to get under, because just because you have them doesn't mean that they're profitable. And you can actually you could go underwater very quickly, and you can't even get out of it because you've got two legs that you have to close out. I mean, you know already, TJ, how hard it is to close one leg at a decent price. Imagine trying to do that with two.
Yeah, it's tough, because I can show you on now the open cascade puts or in covered calls. You have the Celsius, the Googles, the Neo, the Pfizer, PayPal, the Dutch Bros. These are covered calls now. The Google, Palantir, PayPal, etc., SoFi. And you'd already have covered calls for 2025 because these stocks were so hard to sell covered calls on. Like, they mooned, and I just got out of them, and I used all of that premium to sell short-term cash secured puts. And that's how I'm able to generate these types of returns. Is like, my strategy is to sell a long dated put. Like, this is my bread and butter strategy, right? It's called the backstop trade, where I'll take a huge amount of money. So this is kind of like my Chris Patel bet, like on a debit spread, but instead I'm collecting. I'll take a disproportionate amount of money and sell a cash secured put, where, gun to my head, I know I'm going to come out on the right side of things, and I will collect a shitload of premium up front. So it's an artificial injection of cash. I'm hiding money over here because I'm agreeing to buy a Marathon at $7.50 and it's trading at $17.55. So it's an easy money trade right now. But I had about $50,000 that they paid me up front, and I used those monies to sell short dated cash secured puts. So I'm grabbing that 30-40% annualized return. This one was like a 37% return when I sold it. And that's how I'm able to get those big returns year over year over year over year. This is my 4th year now, guys, where I've locked in over 25% return year over year. Yeah. But that's the basis of the cornerstone of my strategy, is to have that backstop trade in the other portfolio. I have $1.05 million on Riot at $7. So it's like, you take a trade that probably 90% of the population is not willing to do, and you use all of those premiums to sell short-term puts on something else that's a lot more quote unquote reliable. But it's just, my strategy is not going to be for everyone, because people just don't have the genetic makeup that I do, and that's okay, But I'm hoping that I can teach this to someone, because I do want to have premium capital. I want to close, because I got to get some sleep. I want to close on this. For me, is by 2025, I want to have premium capital up and running with probably about $10 million allocated to it. And I'll be looking for 10 traders that can all trade $500,000. I'll run the other $5 million, but I want them to run $500,000 each and give them what I would consider to be an opportunity of a lifetime in the market.
Hey man, throw like 500K into the Chris Patelli team.
And I'm really hoping, that those wheelers come from the channel, because I feel like I would have already established a bit of a relationship with them because I recognize some of the names and things like that. And it would just, I think it could be life-changing for them and also for me, but it's hard. I mean, because think about what it takes to trust people. Now, mind you, I'll oversee like the trades and stuff, but dude, it's hard, bro. It's hard to just be like, hey, Chris, go have at it. You know what I'm saying? Like but dude, there's companies that do it. There's a company called Maverick Capital. They do what I do. They do it.
Yeah.
Like they do it.
Yeah. No, you gotta have a lot of trust, man. I don't think I could trust a family member with that kind of scratch. Screw an independent trader, man. My brother be like, yo, listen, brother, let's have a conversation. Maybe a couple of grand here or there, but
yeah, but man, it's been an absolute pleasure, man. I do got to get a little bit of sleep because I've got the market open here. I do it at like 9 after Amit does his deal, and it's also because I don't trade the first 30 minutes of the market. Because
you never trade the first 30 minutes. That's like the dumbest move, man.
It's crazy.
It's like a fucking free for all.
Yeah, it's like I have no idea what the market's going to do.
The spread is just too much, and it's the first 30 minutes, especially on a Monday.
Yeah, I do.
I'll put a joke.
Futures are pretty flat.
I put in joke bets for openings. What I'll do is I'll put in like some fucking ridiculously low contract, and I've actually gotten lucky, and someone actually like accidentally hit a market pricing, and I'm like, yes, and then literally just wait at the end of the day, sell the bitch for a nice little profit,
Dude, here's one last stock that I'd like to get a little feedback on. I've been selling puts on it for a while off camera. Have yet to get assigned to share. But I've been making a lot of money selling cash secured puts on Alibaba. And it's just, dude, it's a profitable company. I know China, Jack Ma. Trust me, I can read the news too. But I just, again, like I've gravitated towards finding profitable companies that are out of favor versus trying to catch a company before it's profitable because the fundamentals.
Wait, how long have you been selling puts on Alibaba?
For about 6 months now.
Oh yeah,
yet to get assigned, bro. Like there was one. It was a week or two ago where I had 72 puts and they were getting challenged. And then I was about to roll them that day, and then it bounced like 73, and I closed them at like 70%. But I've been closing at like 50 to 70%. I'm not waiting for my traditional 80 to 90%. So I'm just grabbing that money, and because I don't really right now, I'd be okay owning it because I've already made so much money via cash secured puts. But it's not really a stock I want to own. But I feel like at these levels, the risk reward's there. Like if I were to own shares at like $70, bro, I'm not gonna lose sleep.
TJ, one of the things I hate, especially with options, is someone who's like up 80, maybe 90% on the position, and they're just like, all I want is that additional 10%, and I'm not gonna apply any caution whatsoever. And boom, last second, the fucking rug gets pulled, right? So I'm like, bro, if you make a good return, lock in some profit, at least get your principal out,
Yeah, well, it's especially like for you where you're buying options, so you definitely have to do it. We're collecting data; it's a little bit different, but I have this hard rule at like 70%. Like if there's more premium per day that I can collect on a different trade that I feel just as good about, I might as well go ahead and close that one out. It's a taxable event. I know what I signed up for and move the money somewhere else. But that's why my watch list is so important to my game. Like even though there's 8 stocks in our portfolio, there's probably 15 that I'm willing to sell cash secured puts on. And I'm just always looking for the beaten down stock, and I have to have my channels, right? Like I always have my Bollinger Bands out because I use TradingView like everyone else does. So I use TradingView, and I always have my Bollinger Bands up, and I always got my moving averages up and stuff like that. So I know where I can sell my cash secured puts. I want to be under the 250 day if I can on cash secured puts. And if it's a covered call, I want to be above because those serve as support and resistance. Just real generic technicals. But Yeah, man. Alibaba is one that I cannot stop selling cash secured puts on. And then recently divested from Neo in like the $10 range. But when it dipped to like the 7, I started selling pretty heavy cash secured puts at 650 and 7. And Neo's been really good to me at these levels as well. But again, it's another company that I'm extremely familiar with. But I know that I don't want to own it in 2024. In 2025 is when I'm willing to own it again, because that's when they're going to be a lot closer to gap profitability. And then whatever they're really deciding to try to do with all these battery swap partnerships, we're going to have more information. And I'm just being more patient, man, because I feel like I've owned a lot of companies that could potentially be really, really good. I just owned them a little too early, and it just causes unnecessary stress. Like waiting for the story to play out is okay, even if you lose, you miss out on that initial leg up. Like it's not that big of a deal if you're trying to be in this company for 5 or 10 years. So anyway, man, I'll look at Rocket Labs again. I've done a little bit.
Let me put the caveat. I mean, Rocket Lab is not a company for you.
I've already done the puts and the calls on Rocket Labs, and it's an exciting, because that kind of stuff excites me. Like I liked my very very first option that I sold was a company called Virgin Galactic. It was SPCE was the ticker.
Hey guys, I gotta head out. I'll talk to you later.
Yeah, you're the man.
And dude, I bought the shares outright. I sold the covered call, and I had the shares called away. I didn't know how to roll or anything, right? This guy was teaching me how to do it on a driving range in Boerne, Texas. So I bought the shares in the $20 range or so, sold them for like 25, made a grip of money. And that was my very first experience with this company that was supposed to be taking people to the moon or some shit, right? I didn't know much about it. I think it was another Shamat play, probably.
Yeah, it was Shamat's first spec. Yep.
But so it's kind of like those rocket companies, if you will, kind of like are near and dear to my heart, because they kind of created the whole TJ the Wheel deal thing. Because I would just buy, hold, and hope, bro. That's all I knew. And then I didn't realize that I could, like, put these houses up for rent, so to speak, and create another stream of income, because I wasn't just dealing with dividend stocks. Because look at how much money Warren Buffett's made just on dividends, right? It's kind of crazy.
Yeah. So, I think it's just one of those things. It's like, just because I like a stock doesn't necessarily mean it's a good opportunity to write options on, right? I think that a lot of people will immediately say, well, Matt's investing in XYZ company. I'm investing in it because by the end of next year, 2024, I want to be up, say, 50%. And it's just like, well, if that's the case, Rocket Lab's not for you, right? And I'm investing in Rocket Lab for the next 10 years, just like the same thing with Palantir. I wasn't investing in Palantir for it to be up, let's just say 80% of what it is in my portfolio today by 2024. That wasn't the goal. I bought it in September 2020, September 30th, 2020. The first 1,000 shares that I bought of Palantir were because I believe that over the next 10 years, it would be a $150 to $200 billion company. Right. And so that's the reason why I invested in the company. And so, it wasn't necessarily because I wanted it to be, let's just say, up, let's say by $50 billion or something like that over the course of the next 2-3 years. And so I think a lot of times why people need to, or have issues, I think, in investing is, one, they just follow people blindly. And then two, they might not necessarily share the best perspective of why I'm investing in a company. I tell a lot of people, especially if you're looking for less risk in your portfolio, I would wait another 6 to 9 months before even looking at Rocket Lab, because there's a lot of risk mitigation for, I think, not a lot of upside for Rocket Lab over the next 6 to 9 months. And I think that you'll be a 6 to 9 months of cash burn in the rearview mirror, and a lot of other things in the rearview mirror. And then you have a better opportunity to kind of make a decision as to, okay, the cash burn's too much, too little, what have you. And I think maybe you'll be in the high to mid $5 range. So you might have missed out on, say, 15 to 20%, but the capital exposure and capital risk is probably decreased by an order of 40 to 50%. So in that respect,
Right.
you know, it all just depends on what you're kind of looking for. And I think a lot of times people are just like, oh, Matt's buying it, so maybe I should buy it. It's just like, well, Matt also has a portfolio that's pretty substantial. And he also has like, you know, 600, 700 grand just in the S&P 500 alone. Right. So like Matt can afford to lose this $30,000 that's in Rocket Lab versus you put 100% of your portfolio in. And so I think a lot of times people
Crazy.
justify things that way. And it's just like, my perspective is that it's a very small position in my portfolio, and I can stand to lose.
What about Dutch Bros? Because I own some shares of Dutch Bros, and I also sell cash puts and covered calls on it. I mean, I don't think it's going to be Starbucks per se, but dude, I've been to Dutch Bros 5 times now in my life.
Yeah.
And bro, the line is literally just, it's almost like the line at McDonald's, you know, like even more so. And it just, it doesn't matter what time it is. Like it could be at 8, 9 in the morning. It could be at 11. And it's just, the line does not stop. And it's just, that's crazy to me.
I think the thing with Dutch Bros at the moment that I think a lot of people are scared about is the amount of money that they're spending. And I can understand that sentiment, but they are spending $200 to $250 billion this year. And I think they'll probably spend comparable next year in, sorry, not billion, million, in building stores. And those stores after 3-4 quarters are generating a 30 to 35% gross profit. And so I think what ends up happening is right now, I think they're going to end at probably 180 to 190 million in EBITDA for the year. I think next year, or maybe I'm wrong. I'm trying to remember what they're expecting this year. It's been a minute since I looked at the numbers, but I think within the next year, they'll be pretty much cash flow break even with the amount of EBITDA they're generating and the amount of CapEx they're generating.
Yeah, I have it pulled up on Alpha Spread. You want to share the screen?
So from a cash flow perspective, I think in the next 18 months, they're going to start seeing a pretty large increase in influx of cash to the bottom line. So right now they're overspending. They're profitable. It's a profitable business on a GAAP basis. But I think the problem that everyone sees is that their revenue and their, sorry, not the revenue, their gross profit and their net income is not covering their capital expenditures. And so once that actually hits an inflection point, which I think is going to be in like probably the fourth quarter of next year to the first quarter of 2025, that will be the point in which it starts to generate a crap ton of additional cash flow. And once that cash flow starts to be there, then they can start servicing debt. And, you know, but I think that they're still so early in their infancy that, you know, it's a profitable business. It's GAAP income positive. I think it's just the overspending at the moment that I'm freaking everyone out. And with debt and, you know, everything, everyone's freaking out about debt. But I think if you're looking for a company that's outsized returns, this company is going to start, like, if you look at the free cash flow piece, you could see if you increase that free cash flow line out a couple quarters, it's definitely going to get to the place where it's going to be basically on the positive. And if that's the case, then they're actually going to be able to start paying down debt and things of the like. And I think it's going to be a place where, and you can see that operating cash flow, it's down right now on a TTM basis, but I think by the end of this year, it's going to be a place where it's going to be probably closer to 150. Next year, it's going to be closer to 200 to 225, which will be pretty much cash flow break even for a trailing 12-month basis. But in the fourth quarter next year, I'm fully anticipating.
But this CapEx is just because they're trying to get to what, like 900 stores or something like that, or whatever that number was.
Yeah, the goal is 4,000 stores in the next 15 years. And so they're at about 850 stores now. And so they're trying to grow by about 150 stores a year in the medium term. So, I mean, if you think about it, all those stores generate a 30% gross profit. So every time they add a store, that store is basically going to be adding 90 to 100. Let's just say in terms of total capex. So let's just say they spend 250 billion in capex. That store alone is going to be adding 70 million and 75 million. All those stores that they open up within 12 months after they open up, it's going to be adding 75 million to the bottom line. And so it's going to just continue to get to a place where, you know, they are pretty much at a place where I think in the next few years, a cash flow generating machine. Now it goes back to, what do you think it is? Is it going to be as big as a Starbucks? Starbucks is a $90 billion company. Do you think it's actually to get there? Probably not. This now.
Right now, it says Starbucks has 111 billion.
Yeah. So this is a $5 billion company. So do you think it could go to 20, 25 billion? It hasn't even hit the East Coast yet. And their second roastery hasn't opened yet. So to me, I'm fairly confident that, and you know, the worst case scenario is that I'm not right, and the thought process changes, and I'm going to be looking at the quarterly numbers to make sure that we're kind of on track with my thought process. And if something drastically changes, then, you know, I'll probably, you know, be done with the opportunity. But I think for now, I think this is an opportunity to find something that's currently undervalued, will generate free cash going in, and has a large growth opportunity between now and probably 2030, 2035. And so that's just kind of the thought process that I kind of have with it.
Yeah, there are 5 billion, just for perspective, right? McDonald's, that, I don't know, they have one here because I guess they sell coffee. They're 208 billion, but Starbucks, what I think would be like a for sure competitor, or, you know, same type of business.
For sure.
111 billion, dude.
Yeah. But I think a lot of people right now are saying like Dutch Bros is going to zero, you know, kind of as a joke. But McDonald's just opened up Cosmics, which is a single store outside of Chicago. And they're opening up like 9 Cosmics up in Texas to trial out. So I think everyone's just like, well, you know, Dutch Bros is really in trouble. It's just like, what do you think about it? By the beginning of 2025, there's only going to be 10 of these Cosmics that are open. Who knows if these Cosmics are even going to be continuing as a venture for McDonald's. Worst case scenario, they say, you know what, we're going to open up 150 stores within the next 24 months. And you're like, you know what, I'm done with Dutch Bros, and you can kind of sell your position. But I think it's just way too early to tell. They've opened up 1 store versus 900. I think that Dutch Bros has a little bit of a head start.
Yeah. Well, I'm a fan, dude. I think the product's good, and I like the line. So, I mean, I didn't like the line when I was a customer per se, but I'm saying I like the line as an investor because
I think there's efficiencies that they need to make at the stores themselves, but there's always the line. So,
but dude, I parked my car, and then I went to the walk-up window, and I was out of there in 5 minutes.
Yeah, that's what I do now. If there's a line.
So, I mean, there is an alternative, or ordering it on the app somehow and doing, I don't know if they have like some sort of curbside type thing. I don't know, but definitely I don't have 30 minutes to hang out at that line as a consumer.
And I'm kind of looking and then I'm going to call it a night as well. Yeah. For me, the thing that I've noticed, at least in Houston, it's always in the outskirts of town. Yeah. And so they just actually are in the process of opening one that's like closer to downtown Houston, which is actually in Houston, which is everything else is in like Cypress or Rosenberg or Katy or Northeast Houston or Spring. And it's like, they're not actually Houston. So I'm curious to see if in the next 12 to 18 months, they continue to open more in, say, downtown locations. It's the same thing with Dallas-Fort Worth. It's the same thing with San Antonio. They're kind of like all on the outskirts, and I'm not 100% certain why, but I'm curious to see if that continues to infiltrate, eventually gets to kind of like the downtown.
That's kind of like, at least in San Antonio, Austin, that's kind of the way In-N-Out Burger does it too.
Does it? Okay.
Yeah, so there just might be something to that, because maybe that's where the cities are growing, perhaps. I mean, I don't know. Like, I mean, maybe Starbucks already dominates the inner city. I don't know. I mean, there may be something to it, though.
Yeah.
Yeah, I always feel like those people are smarter than I am, so I try not
The
to.
owner, the
figure
owner
it-
says they want a line because of the marketing, and I get that.
Yeah,
But at the same time, it's like you want a balance of having a line and also making sure that you get your drink quickly. And so one of the good things that Chick-fil-A does is Chick-fil-A always has a line, but they always
yeah,
have
they're quick.
two. They have two people with their iPads working, and I've seen a couple Dutch Bros that have two lines, and it
Yeah,
works pretty well. But I'm curious to see if it continues to expand
yeah,
because
but the Dutch Bros that I go to has two lines, but it bottlenecks to one at the end.
yeah,
And then they have the lady with the iPad taking your order. But what I don't like about Dutch Bros, again, the one that I've gone to, is there's not like a full menu when you order. The full menu is not until you get to the actual window, and I'm like, I didn't even know you had all that. I'd have been interested.
yeah. And
So
I think part of it is they want you to use the app.
yeah, but I
And
didn't know that as a first timer. I get
yeah,
it now. I get it now.
yeah, and I have the Dutch pass and everything like that, and you can kind of, and it's kind of cool because it'll tell you like what's seasonal. So I'll probably go
Right.
take a nap, and in 2 hours, 3 hours, when I go to do the market, not do the market open with a MIP, but be up, and I'll
Yeah.
probably end up doing naps all throughout the day. I'll probably go get some Dutch Bros, come back, do a little bit of work, maybe trade in the morning just to see
Yeah.
if there's anything because I haven't really had a Monday off, so I'm kind of excited because it's been a while since I've actually taken some vacation, and so yeah, it'll be cool to kind of see what they have because a lot of times they switch out and they have new stuff all the time.
Yeah,
So
for sure. Well, the one that I'm definitely monitoring this week is because Celsius is in a bit of a downtrend. I'm hoping that it could breach and go to like 46, 47, because then it gets just a little bit more appetizing for me. Because I want it in the portfolio, but I feel like since the portfolio already has enough stuff in it, like it's like now it's like if you're going to be in the portfolio, then it's just going to have to be a good price for me. If not, well, then I'm just stick with what I got. I feel like maybe we don't have life-changing opportunities yet. I mean, I do have that 20,000 shares of SoFi. That's a potential. The 10,000 shares of Right. There's potential there, but there's also a lot of risk with those. So you got to just weigh the good with the bad, right?
that's the thing. It's hard for me from my perspective to see like how to structure a position in your portfolio because like I don't know if you're trying to just because you're doing so many things at once. You're selling cover calls, you're
Nice.
buying shares, you're selling puts. I'm like trying to understand if you're just trying to actually hold these positions long or
Yeah.
if you're because you
So
also
now,
sell closer to the money as well. And
yeah.
it's hard for me to
So it's because I don't know if I've ever showed this. Hold on. All right, I showed this to you. So it just comes down to the wheel tracker, right? So if you go here to the wheel tracker, it's a good question. What's the goal, right? So here's the goal. It's all about getting this adjusted cost basis to zero.
yeah.
So that's the goal. So I've got a long way to go with a lot of these more expensive companies. But if you go over here to the cheaper companies, like on Palantir, I have an adjusted cost basis. I call it the ACB. I got the adjusted cost basis at 1088. This is taking into account all premiums received via cash care puts, cover calls, and or rolling. I've got in the hole with when it's red, that means that the adjusted cost basis is lower than the current share price. So there's there's issues there. Like in other words, I got work to do. But I have 1088 on Palantir. So the goal is to get it to zero. On PayPal, I'm at 52. I achieved the goal on Right. I have negative 1832. On SoFi, I've got $5.42. And Tesla, it's 132.55. So the goal is to get those to zero, or if it's over $100 stock, the goal is to get it to 100, because I think it's unrealistic to think that I would be able to sell enough cash care puts and cover calls on an Amazon or even Enphase and get those to zero unless I just did this for like 5 or 10 years, just mathematically, especially with Tesla when I don't even have an open cash care put right now on Tesla. So here, if you look at row 48, you'll see all the collateral tied to the cash secured put. So if I already own shares, that means that I'm running a strangle. If I don't own shares, then I'm not running a strangle. So I'm running a strangle on on Google. I'm running a strangle on PayPal, and I'm definitely running a strangle on Riot because I got $1,050,000 tied into cash secured puts. So got a lot of open collateral due to 1.6 million in open cash secured puts that are all out of the money right now.
Mm-hmm.
So that's the goal. The goal is to get to, obviously sufficient cash flow. Like I have a goal here, and I almost met it. I always fall short, and that's okay. But I had a. So where's the summary here? Yeah. So the annual premium goal for this year was 1.4, and I'm at 1.347. So I didn't quite get there, and I didn't really expect to, but that's what I was shooting for in that particular portfolio. But I'm just doing on the same stocks. Like next year is going to be the same shit. These are all the tickers on the bottom that I could sell cash secured puts on. But like for instance, Charge Point's out, Clover's out. Like I'm not touching those. Certainly not touching IDEX. Everything else is still on the table. So I may even get to the point where I'll hide those. Like I won't show them anymore, but I won't erase them because they're still tied to the overall performance of the portfolio, right? Like I can't act like IDEX didn't happen. Like I lost money in IDEX, so I have to own what I did right at the end of the day.
Yes.
So that's the goal, man, is to get the adjusted cost basis to zero in a nutshell.
Yeah, I know a guy. He used to call what we used to call. He used to call them colonies, which is like you basically do what you're talking about. He was really big on IDEX, which was basically just buying as much shares of IDEX and then writing covered calls to the point where his cost basis would be effectively zero.
Right.
To the point
and that's
where
what I tried to do. But at the end of the day, it was cool because I made 4 grand on the puts and calls, but then I lost 151 on the shares. So
yeah.
At some point, the strategy will not work if you just pick the wrong underlying. That's the bottom line, right? And it's always about this little, like the WX, that's the real scoreboard, right? So if I look at Amazon, for instance, you look at the cost basis of the shares, the stock P&L, the call profit, the put profit, which gives you the real profit. And then like BABA, I just started selling puts in this portfolio. So I've already gotten 1,350 and don't own any shares. Here's the Dutch Bros, don't own any shares. I've sold 1 round of cash secured puts and made 875 profit. I got 1,000, but then I gave money back to close it out. So I profited 875. And then Celsius, same thing. Just recently started with Celsius, but already at 3,700 in Celsius. We like that one. And then here's the end phase. This one was brutal, dude, because we bought 150 or 1.537 mil. And right now we're down 174 on the shares, but at one point we were down 0.75 mil. But now I've been bringing in cash covered calls, so I've gotten 88,000. And then on the puts, I've gotten 121. So I've gotten 210 in premium. So if I take the 210 or the 174 and subtract it from the 210, I'm actually up. My adjusted cost basis is going to be lower than the current share price. That's why I have an adjusted cost basis of 120 and it's currently trading at 124. So that's the mission, right? Is to manufacture the win in a nutshell. And it's tough, dude, because when you get caught with your hand in the cookie jar like that with end phase, man, you're going to find out what you're made of real quick. Because that was definitely a learning lesson because the macros changed. The writing was on the walls, but I stuck to my intrinsic value calculation that I had done in the 130 range. And I was like, dude, I'll just take ownership of this thing. It's going to bounce. And it ended up kind of bouncing. But I didn't realize that it was going to go to like 70, though. You know what I mean? I was like, dude, it's okay to be wrong. I didn't think I was going to be that wrong.
Mm-hmm.
So, you just gotta own where you go wrong, and that way you can learn from it. Because if you're not ever willing to admit that you're wrong, kind of like with Chris and his pride in Palantir, because that's just Palantir pride is what that's called.
Yeah.
You're not going to grow from it. Because Palantir just might end up being that investment that never makes sense, or for the next 5 to 10 years doesn't make sense from a valuation perspective. But there's so
and to be honest, there's so many opportunities. Yep.
Yeah, but it's because people are euphoric because the one thing that it is delivering, it's delivering a product that some people can argue is second to none. It's delivering contracts for years, not days, and it's also delivering a very, very sticky customer and an amazing balance sheet and pretty good leadership. So, I mean, dude, it's got a lot of positive things going for it. And it also has not just enough people that like it, but enough people that like to hate it. And that's going to give you the volatility if you're a premium seller that you need for decent premiums. So Palantir is a very unique opportunity in the stock market. I just like it better sub 15 personally.
No,
But
I can. There's a little bit more margin of safety, but all right, my man.
the market's gonna give it to us though, bro. Like I've already accepted that. I think it's gonna just go higher from here, and it is what it is. Because do those contracts keep coming in? At some point, that bottom line is gonna start looking juicier, and then that top line starts growing as well. I mean, it's a juggernaut, dude. I really think that it could be a $200 billion company by probably 2030.
Yeah, we'll see.
I'm excited. I got to get a little sleep though, man, because it's going to come early, my man. Appreciate you, bud. You have a good one.
You too, brother. Good talking to you.
Take care.
All right, everybody. I just want to say thank you for those of you guys that stuck around. I see a lot of names in here that have been here for several hours at this point. There's 50 out of you. And if you don't mind, please just take the opportunity to go to the new channel and subscribe. We're at about 240 odd folks. Originally, I was going to try to go live on Cashflow Chronicles, the new channel. And Chris had just gotten done finance because he was going to go have dinner with the missus. So I understand completely. Hopefully in the next few days or so, we can start to get people over there. But at the same time, we want to make sure before we do so, we have the best opportunity to get ourselves closer and closer and closer to 1,000 folks over there as soon as humanly possible. So if you guys don't mind, take the opportunity. If you like hearing what me and Chris had to say, TJ, folks like that, that's majority of the time where I go live is on Cashflow Chronicles. It's at least 3 times a week. We hope to do it up to 4 or 5 times a week. So I will do the impromptu Saturday or Sunday night stream. And so that'll always be nice, or sometimes on the market close on Fridays I will do. But eventually with Hot Chris, we will likely be doing that on the Cashflow Chronicles channel. So if you guys would just do me a favor and be sure to go over there to subscribe. I would love to wake up in the morning and see 250 subscribers over there. And eventually within probably I think he said by the 1st of January, we eventually want to move over there full time. I don't know if that's going to be enough of a plan or not, but really excited. We got to see some people from Denmark. We got to see some people from a lot of Europe. It's pretty cool to be able to be on here 3 a.m. my time, 4 a.m. Eastern, to actually start seeing some folks from the Eastern hemisphere start to come on here. So it's pretty cool to be able to while have some people have their nights kind of drown out and go to sleep here in the U.S. We got to be able to hang out with some folks in the European markets where they actually can see us live for once. And so could be an opportunity for me in the future that I end up doing something like this where, I do it more of like a nighttime stream. I got to figure out at what point the market's really open worldwide. And it could be something where I do like a reverse stream, where people are expecting me to go live during the day, but in reality, I kind of start off the day, whether it starts at 10 p.m. or 11 p.m. and it goes until, 5, 6 a.m. my time as the market kind of opens. You never know. It really all just depends on where the love comes from, But at the end of the day, I think it's a good opportunity to continue investing in the markets as always. And I think the things that we said, whether it was Chris, Tevis, myself, or TJ, I think what people need to recognize is you need to look at stocks for you and you only, right? Just because I invest in a stock doesn't mean it's the appropriate stock for you to invest in. Just because you invest in a stock It doesn't mean it's the right stock for me to invest in. So you really just have to look out for yourself at the end of the day. And hopefully what we're talking about is really just for you to understand your perspective and why you probably are investing in a stock in the first place. So the hope is that we can show you guys that you have the opportunity to find these outsized returns if you so choose so, but you need to recognize, do you have the appropriate time? Do you have the appropriate capital allocation? Do you have the right budget? Are you feeding your portfolio enough for it to grow? And I think that that's a huge piece that I think a lot of people skip the fundamentals and want to get to the end and invest in individual stocks and hopefully grow it to $1 million. They just want to put in $500 and walk away a trillionaire. And that's just not how it goes. We still got Amit coming in. I'm trying to like eke out another 5-6 minutes so we could have a 6-hour stream. But, if any of you guys have some questions, I'll be more than happy to answer it. But eventually, going to call it here, take a nap and hang out with Amit maybe when he does the market open. We're climbing up here again and people entering the stream. We got 56 people joining us from YouTube, 2 people from Twitter. One person's been hanging out on Twitch, and I'm not sure if they fell asleep with the stream open or not, but I think there's a lot of truth to be told. I still see a lot of people following people into trades. And, when people start talking about PayPal, next thing you know, the whole Twitter feed is lined up with people talking about PayPal. And then same thing with me and Rocket Lab and Vince joining Rocket Lab and a lot of other folks. It's like, as soon as I start, pampering Rocket Lab, it's like as if a train. And I know some of that is you find like-minded people on the Twitterverse, but then also you have people coming out of the woodwork that have never traded Rocket Lab before. Next thing you know, they're buying Rocket Lab. It's like, are you buying Rocket Lab for the right reasons? Right? I've been invested in it since March of 2021, and now you're just magically getting involved. And it could very well be that you start to hear the opportunity and it's something that might fit your portfolio. But I think more often than not, it's people lying to themselves thinking, this is my get out of jail free card, and I don't want to do any due diligence. And my due diligence is showing up 1 hour a night and listening to you guys. And it's like, well, you still are missing something, right? When you look at Finance Junkies, you see 4 people on the screen of 4 different backgrounds, 4 different perspectives, and 4 different goals and 4 different lifestyles. And when you come on to the Cashflow Chronicles, you see 2 different guys with 2 different perspectives, 2 different backgrounds, and 2 different lifestyles. And I'm investing one way, Chris is investing the other. So one of us has to be right, one of us has to be wrong. And that's just not the case. The world is more gray than I think most people give credit for. And so I think everyone just assumes there's a black and white to everything. The answer is right or wrong. And that's just not the case, right? And the older I get, the more I realize is that we live more in this gray area than we really truly give credit. And, I try to find a place where, and I still think a lot of times, and I don't know if it's the Matrix or maybe it's just me becoming fully cognizant, but I still think that everyone operates in this world where things are like white and black, where things are right and wrong, and there's a yes and no answer. And I just like, the older I get, the less that there is a yes and no answer, and the less there is a wrong and a right answer. It's just pretty interesting. And to see people kind of enter the markets that way is interesting. And I think it's just me having trouble keeping perspective because I have 10 years of experience in the stock market now. But I think a lot of times the times where you're not supposed to listen and like focus, I think are the times where people listen and focus the most. And the times where you're actually dropping truth knowledge bombs that they really should take to heart is the time where their eyes glaze over and they fall asleep midstream and the numbers start to go down. And it's pretty interesting in that respect. So overall, in closing for the next 30 minutes, not 30 minutes, 3 minutes and 30 seconds, I just want to say I appreciate everybody stopping out for the last 6 hours. It's been a lot of fun. I would love to eventually do a 24-hour stream. I'd love to figure out a way in which we can do it. And I would love to do this more often. So if you guys have the opportunity to follow the new Cashflow Chronicles TV channel, and then also be sure to become a member if you so have the opportunity to do so. That money gets reinvested back into the public portfolio, of which we're managing about $1,000.70. And the hope is to grow that to be a starting seed investment into eventually our ETFs that hopefully Chris is going to start and I'm going to start. And whether or not we start them together or whether or not we go our separate ways is beyond me. But until then, the Cashflow Chronicles will be a Matt and Chris venture. And this is not Cashflow Chronicles. This is Matty Moolah hanging out and chatting with you guys. But as always, a plug for Cashflow Chronicles. But at the end of the day, I think that we're all better together and banding together and listening to each other. And that's the most important piece, I think, of any of this part venture over the past 6 hours is to bounce ideas off of one person or another and try to understand where they're getting to and what their objectives are. And I appreciate TJ bringing up the opportunity to talk about, like, what are your goals, right? Because I'm here and this is where I plan on being in 10 years. And you know, that's all important. And that's why we're here. That's why we're talking about these things until literally 3:30 in the morning after 6 hours on a stream, is to understand whose perspective and what they're going for. And do they align with me? And, you know, because for example, what's a good opportunity that I don't like partake in? PayPal's a good example. SoFi, you know, all these opportunities which I see potential for, doesn't mean I'm necessarily going to jump both feet in. Enphase is another one that I saw a lot of people jump into that I was just kind of like, not yet. You know, there's a lot of opportunities out there to take your time sometimes. And I think it's hard when you have shiny object syndrome. And maybe it's just because I've been burned by, you know, blindly trusting somebody else's due diligence in the past to eventually jump both feet in. And I burned myself as well. It's not to say that I'm some sort of oracle or anything like that. I've obviously made mistakes like Wish and a few other companies, and I've invested too early in Palantir. I invested too early in Rocket Lab. I invested in a lot of stocks too early, to be honest with you. But at the end of the day, I think we're all here to help each other out as much as we can, learn, most importantly. But at the end of the day, don't shut off your ears. You have 2 ears, you have 1 mouth. And hopefully this has been useful. This last 5 minutes, 59 seconds, and 40 seconds have been extremely useful. I'm getting belligerent. I'm probably not making a lot of sense. But for those of you who had the opportunity, please, I'll post it one last time, and I promise this is the last time. Please follow the Cashflow Chronicles TV channel. And hopefully within the next day or two, we'll be able to have our first live stream over there. I appreciate everyone staying for 6 hours. I'm going to go take a nap and wake up in a little bit, go get some coffee, and maybe listen to Amit's open for the rest of the day. And I hope you guys have a great trading week. And let's learn a little bit more about how much we can help each other succeed in this week. I'm going to enjoy it. I'm going to sleep in a little bit after I get done the market open with Hot Amit, and then maybe take a nap. But it has been great. I was not expecting to go 6 hours, but sometimes you just see an opportunity, have some great people come on, and it extended the stream quite a bit. So TJ, Tevis, Chris, I appreciate you guys stopping on. It's been a great conversation piece for you guys, and I will talk to you guys. I don't know. Maybe I can convince Chris to do another live stream tonight, but we will see with that. But otherwise, I can guarantee we will be live Tuesday through Thursday unless something comes up. Stephen Fiorillo said he was going to come on Wednesday to talk about ET, other dividend stocks. So I will see you guys then. Let me make sure I hit end stream, and I will see you guys later on. Thank you for a